Go to the start of cash equity trading. I'm Francine Lacqua here in London, and here are your top stories. Facing the feds, FTX co-founder Sam Bankman-Fried arrives in New York to face criminal charges as two of his associates plead guilty to fraud in connection with the collapsed crypto exchange. Unwavering support, President Biden doubles down on backing Ukraine for as long as it takes as President Zelensky meets with Washington lawmakers in his first trip abroad since the Russian invasion. Plus, Germany's finance minister says Berlin is veering away from over-reliance on Russian energy and outlines his vision for strong transatlantic ties in a Bloomberg exclusive. So let's look at the futures. We are just a couple of days away from December 25th, so a lot of people have already taken today and tomorrow off. The picture means that there's a bit of thinner volumes than usual. We are, though, seeing a high, or if not a high, a gain today, at least after 4 days of losses. European stocks, the futures were gaining 0.3%, and they're opening a little bit higher. Now, we'll wait for equity indices to settle a bit. The other things we're watching out for, of course, is U.S. Treasuries, and then a lot of going on in commodities. We are taking today and also tomorrow to reflect on the pretty incredible 22 that we've had and look forward to 2023. If inflation really came as a surprise to a lot of central banks, and we go back to the mea culpa from Jay Powell, but also Christine Lagarde, I think the RBA governor also said it was embarrassing. That was back in May. We wonder whether 2023 means that inflation could fall back as quickly as it came. So a lot of this will play out, for example, in foreign exchange markets, Euro 106.41, and you can see sterling 121.34. Equities settling pretty much, getting some 0.2%. So let's also look at, of course, that all-important U.S. Treasury yield, the one that really started repricing in January of 2022. The picture for if we have a cross-asset check, we don't only look at the U.S. 10-year yield, but we look at dollar. If you get your dollar call right for 2023, then everything else should follow in terms of portfolio building. So S&P futures in the U.S. getting 0.1%, the U.S. 10-year yield at 3.6378. Let's get over to our Bloomberg M Live Managing Editor, Mark Cudmore. Mark, you're looking at the dollar and Treasury yields, and good morning again.
Yes, Fran, you thought you got rid of me, but I'm back. You're almost going to get rid of me. This is my last few minutes. I forgot I actually had this chart to do. So I think I was finished up a few minutes ago. So look, this is a chart of Bloomberg Dollar Index and US 2-year yields from October 31, 2021 until October 31, 2022. I'll explain in a second why I've cut it off a little bit early. And as you can see, during that period, there pretty much just one trade. 2022 was about the inflation shock that most of the world got wrong. 2-year yields in that period rose more than 400 basis points, and that caused the Bloomberg Dollar Index to surge. And everything was just one trade, and it was that rise in 2-year yields that saw dollar come up very, very strong. This is one of those charts where you're going to go, well, it's easy. This is how you trade the dollar. You just look at 2-year yields and follow their path. However, roll this chart forward to today and look at the last 12 months, and you can see that in the last 2 months, there's been a major breakdown. And what happened is 2-year yields, the dollar has completely collapsed, while 2-year yields have stayed kind of steady at high levels. So why has there been this breakdown? Well, this is the problem with naive overlay charts, as my headline says, is that quite often naive overlay charts can look very useful, but it's not about levels as they might imply. So when you're up to this point, you kind of go, oh, whenever they diverge, I'll trade the convergence again. But that would have been massively unprofitable for the last 2 months, because what this was actually about rate of change, and that is much more important for FX markets, the rate of change of relative rates. And what we've seen in the last couple of months is 2-year yields in the US have stayed pretty steady, but they've actually risen around many other places around the rest of the world. So going into next year, you were talking about dollar being the key asset for next year. I think you're probably right there, Fran. I think the key asset for 2022 was probably getting to your yields correct, getting the inflation call correct. I think for next year, it's not so much getting the inflation call correct as getting the growth call correct, because that will dominate the inflation call. So next year it's about growth, and you're right, dollar's probably more important for yields for next year.
Mark, thank you so much. Now you're off. Have a great, great holiday. Our Bloomberg MLive managing editor there, Mark Cudmore. Now, global stocks gaining after U.S. shares rose on improved consumer confidence and better than expected earnings. Now, as the fallout, of course, from the Bank of Japan's surprise policy change begins to ebb, Treasury yields have also been sliding, as well as the Japanese 10-year. Meanwhile, the yen resuming its rally. Well, joining us now is Wei Li, Global Chief Investment Strategist at BlackRock. Wei, I'm so happy we get to spend a couple of, look at market analysis together before a lot of people break off for the rest of the year. What was the most surprising thing in 2022 that we got wrong, and how does it inform your thinking for what markets do next year?
I think a big surprise for 2022 is the degree to which central banks over-tighten, and also how high yields managed to get to. Obviously, that catalyzed the significant sell-off in bonds and equities, the joint sell-off in bonds and equities in 2022. But the silver lining of that is that we're starting next year with higher elevated yield and income potential from fixed income, which is something that we haven't seen for a long time, which is why we prefer short end of the curve and quality credit, because for once we're getting paid hiding out in these exposures.
So wait, what is the chance actually that inflation falls almost as quickly as it came? Or does it get stuck at 5-6%, which means that central banks will still have to hike rates quite aggressively?
Maybe not 5 or 6%, but 3 is the new 2. So we certainly think that inflation will come down quite quickly as over-tightening takes time to feed through, as well as some of the shelter effects and goods service rotation continues in the US as restart continues as well. But there are structural forces behind why we believe inflation should settle at a higher level versus pre-pandemic level. So things like geopolitical fragmentation, things like net zero transition, and also aging demographics and labor shortage. All of that would mean we're going to have to live with an environment that means higher inflation versus before, but certainly lower than what we saw this year.
So when are you expecting the Fed to cut? Is that, I mean, if you look at the next 12 months, if there's one thing that you have to get right, is it just the Fed call?
Well, Fed call is central to global risk sentiment. So our forecast is that the peak rate is at 5.25%, and they would not cut until 2024. And even when they start cutting, it's a very muted cutting cycle, starting with 25 bips versus market pricing of a rather aggressive rate cut cycle starting late next year. And the reason that we believe that is the case is because we think that this time round, central banks cannot come to the rescue of the economy in the same way that they were able to before, because this recession is going to be caused by central banks to shock the demand side of the equation in order to bring down inflation.
So a lot, for example, on the equity call will depend on what kind of recession we have, right? Whether it's deep and protractive and ugly, or whether it's kind of like shallow and we get over it quickly. What are earnings pricing in? What are equities pricing in right now?
Well, equities right now slightly above 3,800, 3,900 for S&P 500. That is pricing in peak rate, not too dissimilar from our expectation, but it's also pricing in a rate cut cycle starting late next year, which we would lean against. And furthermore, if you work it backwards and say, okay, we hold equity price steady, we hold cash path steady, what does that imply for earnings for next year? Currently, equities are still pricing in mid-single digit growth, EPS growth for U.S. equity market next year, which is way too optimistic considering margin needing to come under pressure, a higher labor cost, higher production cost, and also the fact that we're heading into a recession, right? So our forecast for U.S. equity market next year in terms of earnings is -6% versus the still single-digit kind of earnings being priced in market, which is why we're currently underweight developed market equities. But at some point, we expect to turn more positive, either through dialing up our risk budget, or if markets were to price in the recession more adequately than it currently does.
Wait, I want to ask you about China and what we're getting wrong, and then I want to ask you about Japan. So on China, is there a misunderstanding that actually when they fully open up, we're going to see energy prices go up. We're going to see a lot of the commodities that they need to reopen the economy. And because of the scarcity, we will pay for it in terms of price.
Well, actually, in terms of China reopening and what that means for global demand and inflationary pressure, it's not straightforward. Yeah. On the one hand, you have a supply chain easing a little bit, so that should alleviate some of the pressure on the inflation side. On the other hand, it represents greater demand and through the commodity channel, as you said. So we actually believe that the effect from China reopening to global inflationary picture is nuanced, but the bigger driver for inflation next year is actually what we just talked about in terms of the net zero transition, in terms of the goods service rotation, and so on and so forth. But more broadly, if you look at what's happening in China, reopening is starting perhaps faster than some may have expected, but that is against the backdrop of exports falling sharply, right? So it was at 18% back in July, and then it was at -7% in November. So it's falling significantly, which is why growth policy needs to step up in order to offset the export drag, which is also why balancing all of that together, we're currently neutral China equities versus underweight developed market equities.
So Japan, we had a pretty big shocker from Governor Kuroda this week. How long does it take for that to play out? How much money do you think will come back on Japanese shores?
Well, the big question around Japan is actually specifically around global markets, right? Thinking about the gravitational pull that global government bonds have on each other, and yield curve control has been leaning against that. But what we saw this week is really a beginning of that journey where we perhaps see more convergence rather than policy divergence that we have seen so far this year. Currently, it's just one small step towards that direction. So we're not seeing kind of significant repatriation just yet, but we do expect that this is another reason why investors would apply a higher term premium, higher risk premium for long-dated bonds, which is also why we believe globally government bonds, we need to see that steepen, which is also why we have that preference for short end of the curve versus the underweight that we currently have in long-dated bonds.
And finally, Wei, what do you do with the UK assets next year? I mean, we're going through a pretty tough December because of the strikes, because of inflation, because we don't know really what happens with house prices, but also the job markets. Is 2023 going to be worse?
Well, the UK assets currently we have underweight in UK equities for the same reason that we're underweight developed market equities. Indeed, the economy is challenged, higher inflation, tighter monetary policy that we have seen coming through as well. But at the same time, it has a cyclical tilt that is offsetting some of that structural kind of challenges that we just talked about, which is why it's in the middle of the pack. We're not more negative or more positive versus the other developed market equities. And also specifically in the UK, we see actually the BOE pausing sooner than the Fed, which is one consideration as we think about the whole mix.
Wei, thank you so much, as always, for all of your insight this year. Wei Li, their Global Chief Investment Strategist for BlackRock. Now, we're also showing you live images from El Gordo. This is Spain's annual Christmas lottery draw that claims to be the world's richest. I think El Gordo means the fat one. It's taking place in Madrid's Royal Theatre Opera House. El Gordo, a traditional lottery draw with the thousands of winning numbers sung out by children from a local orphan home. Now, the total annual estimated prize pool is around 2.5 billion euros. I don't know if we'll break the numbers live for you, but certainly we'll keep an eye on it. And we do hope it's a Bloomberg viewer that actually has the winning lottery ticket. Coming up, FTX founder Sam Bankman-Fried is extradited to the US to face charges. We'll bring you the very latest on that. And this is Bloomberg.
China's military power has been growing at an incredible speed over the last 20 years.
A strong country must have a strong military, as only then can it guarantee the security of the nation.
In terms of sphere of influence, we absolutely know that China wants to be dominant in Asia. So there is a target to get to that point, to be a military that is a peer to the greatest militaries in the world by 2035.
The competition for influence is a global one, and through a multi-decade trajectory fueled by planning, money, and pragmatism, China is building a military that allows it to shape the 21st century just as the U.S. shaped the 20th.
No one covers the world like Bloomberg.
My team thinks 2023, we avoid a recession. I'm a little more skeptical about that.
China and the U.S. both do not want to see nuclear force on the European continent.
The regulators here in the Bahamas are ongoing with their investigation into FTX.
With unmatched reach and resources from more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, your global business authority.
Welcome back to the Open, everyone. We are 14 minutes into the European trading day. Thin volumes because we are just a couple of days away from December 25th. The picture overall, European stocks gaining some 0.3%. They did get a little bit of a boost from what we saw in U.S. yesterday. Now, Sam Bankman-Fried has landed in the U.S. to face a litany of criminal charges tied to his role in the collapse of crypto exchange FTX. This comes as the SEC charges Alameda's Caroline Ellison and FTX co-founder Gary Wang with fraud. Joining us now is Bloomberg's crypto senior editor, Anna Herrera. So, Anna, what's the latest? Good morning, first of all. What's the latest on the Bankman-Fried journey?
Yes, so he's in the U.S., and as we figured out that he was arriving in the U.S., we also learned that his top lieutenants, or two of his top lieutenants, Caroline Ellison, who ran Alameda Research, the hedge fund, and Gary Wang, who was the co-founder of Alameda, and then the CTO of FTX, were collaborating with U.S. authorities, and they pled guilty. So this clearly means that we'll find out much more. The SEC, as you said, is suing them both, and has updated sort of their lawsuit, and we discovered many more things because it sort of remained a mystery for a while what was going on behind the scenes. And basically what we're discovering now is that when Terra collapsed in May, like many other funds, Alameda faced margin calls. It couldn't meet them, but they then tapped into the funds of FTX and FTX's customers to sort of borrow and try to pay back those debts that it had with lenders, among the other things that the SEC alleges that Caroline and SBF sort of carried out.
So, Anna, what exactly are the details of the plea agreements from these associates, the FTX associates?
So they pled guilty. We don't really know how much sort of the prosecutors will recommend that they get in terms of sentence. But normally, when you collaborate, if you collaborate well, they will recommend a reduced sentence. I was reading. I think the Caroline faces a maximum of 110 years, which is a lot. And obviously, we're waiting to see if someone else will come forward too. The district attorney has said, we are still waiting. If you worked at FTX or collaborated, come forward. Our patience is in the unlimited, which is, I guess, very ominous.
So, Anna, Bitcoin around $1,700. What is actually the current wider industry fallout from this case? How much worse could it get?
We could still see other sort of dominoes falling. As I was saying, part of this happened because Terra collapsed. There was a lot going on behind the scenes in terms of, what the SEC called like a years-long orchestrated scheme. But, they weren't able to meet their margin calls because Terra collapsed. And so sort of that created a cascade of events. And as we've been saying, FTX was everybody's counterparty, and so was Alameda. So there might be more shoes to drop there. Maybe the lenders won't get paid back. So we'll have to watch.
Thank you so much, Anna, for everything. Bloomberg's crypto senior editor there, Anna Herrera. Now, Ukrainian President Vladimir Zelensky has made a historic speech to the U.S. Congress where he pressed Washington for tanks and fighter planes, along with tougher sanctions on Russia. He warned that the conflict will shape the world for generations.
This struggle will define in what world our children and grandchildren will live, and then their children and grandchildren. It will define whether it will be a democracy of Ukrainians and for Americans, for all. This battle cannot be frozen or postponed.
Now, on all of this, let's bring Bloomberg's Bruce Einhorn. So, Bruce, what are your main takeaways from this visit? The first time the Ukrainian president left Ukrainian soil since the invasion.
That's right, Francine. It was a very dramatic day. It was a short visit. The president arrived at the White House around 2 o'clock in the afternoon, met with President Biden, members of the cabinet, members of the national security team, then met with congressional leaders, then gave the speech to the joint session of Congress. This actually was the second time that President Zelensky has made a speech to Congress. He made one early in the war remotely from Ukraine. Of course, this one was in person. In the speech, he talked about the critical role the United States has played. He said that Ukraine needs more assistance, needs more fighter jets, needs more tanks, other weaponry. And he included references in the speech with the audience in mind. He quoted from President Franklin Roosevelt's speech the day after the Japanese attack on Pearl Harbor. He included a reference to the Battle of Saratoga in the Revolutionary War. Probably well aware that there are members of Congress, Republicans, who are opposed to increasing aid to Ukraine. He talked about how aid to Ukraine is not charity. He referred to it as an investment in global security.
So what does that tell us about how much they're willing actually to spend, how much the U.S. is willing to spend to support Ukraine? I mean, he says it's as long as it takes, but are the Republicans on side?
It's a good question. So we know in the short term that the aid is continuing to flow. President Biden announced while President Zelensky was there in Washington, there would be an additional $1.85 billion worth of aid going to Ukraine, including Patriot air defense system. And Congress is supposed to be voting in the next few days on a big omnibus spending bill, and that is likely to include $45 billion worth of additional aid to Ukraine. The big question is what happens after that, because this is a war that very well may go on for much longer. The Republicans are taking over control of the House in just a few days, and some Republicans are very opposed to this. Some Republicans didn't come to the speech. Other Republicans were there at the speech. A few were not clapping while others were clapping, looking at their phones, other things indicating their displeasure. Kevin McCarthy, the Republican leader in the House, who is hoping to be Speaker, has talked about how the Republicans will be looking more closely at aid, that they would not just approve a blank check for Ukraine. On the other hand, in the Senate, the Republican leader, Mitch McConnell, has spoken very forcefully about the need to support Ukraine. So there is disagreement. This trip to Washington may be a way for President Zelensky not only to address the people in the room in Congress, but also the broader American public with the goal of solidifying support for Ukraine going forward.
Bruce, thank you so much. Bruce Einhorn there on the very latest, of course, in the U.S. Now, coming up, we hear from the German finance minister, Christian Lindner, who has spoken exclusively with our Maria today on Bloomberg TV. More from that conversation a little bit later in the program. And this is Bloomberg.
of a push have you seen from the Kishida government in terms of green funding?
The Kishida administration has committed to doubling the amount of investments in so-called green technologies. I think we need more than just pronouncements. We need real money backing very innovative startups and innovative companies in this space.
What do you make of Kishida's new capitalism?
Well, I think his framework is reflective of the challenges that Japan society is facing, namely that growth has been present, but growth has not been, of course, evenly distributed. But frankly speaking, it's hard to redistribute income if you don't have much income to begin with. If the government and private sector can work together and collaborate to drive more innovative growth startups, that can really drive the income growth that the Kishida government needs to redistribute.
The difference between missed opportunity and actionable intelligence. For in-house attorneys who strive to provide superior counsel and strategic advice, Bloomberg Law offers an unmatched platform of analytics tools and business intelligence. All to help improve productivity, mitigate risk, and inform decision-making. For the comprehensive platform that helps you work smarter and faster, the difference is Bloomberg Law.
Welcome back to the Open, everyone. We are 24 minutes into the European trading day. The picture across the board is a bit one of gains, gaining 0.4% for the European stocks 600. Now let's get straight to the Bloomberg Business Flash, and Micron says it will cut headcount by about 10% in the coming year as it projects a wider than expected loss in the quarter ending February. The biggest U.S. memory chip maker says the layoffs will incur charges of at least $30 million. Now Micron's loss comes amid a slump in demand for computer components. HSBC has won a battle in the UK Supreme Court over allegations it turned a blind eye to suspicious payments made by convicted swindler Alan Stanford. In a split decision, the country's top judges dismissed an appeal by the administrators of Stanford International Bank. They claimed the bank should have known about the fraud. H&M has halted sales of its Justin Bieber collection after the singer accused the company of selling clothes depicting him without his consent. Now, the Swedish retailer says it followed all proper approval procedures, but is pulling the goods out of respect. In other Bieber news, the singer is said to be near a deal to sell his music rights to an investment entity backed by Blackstone. Well, Bloomberg understands Bieber's stake could fetch about $200 million. That's your Bloomberg Business Flash. Now, on the back of some of that business flash, let's also look at what STMicro is doing at the open. This is on the back of Micron. They actually missed earnings. Now, STMicro down some 0.3%. We also saw a story that Citadel is boosting its short position, is STMicro to 0.6%. The other story watching out for is Prosus gaining 1.2%. It did buy back around $266 million of shares in the week starting December 12th. And then finally, Stellantis. This is an interesting one because European car sales continue to rebound as supply chain snarls are also easing. Coming up, we talk about the dollar. This is Bloomberg.
cruise ship is much more than a flotilla of financials and numbers. Naftali Holt showed me around the celebrity Beyond, Royal Caribbean's newest ship, rolling out not the red carpet, instead the magic carpet, an example of investment that's yielding returns in several different ways.
Originally, actually, we designed it because we wanted to have a really nice platform for tendering, because sometimes we can't home port
So
destinations.
functional.
Exactly, value functional. And then we looked at it and said, why don't we just make it a really cool feature spot where people can enjoy it beyond the functional space? And we created this bar. It went up and down.
Now, what does it take to
How
do?
about the Instagram? Can you about that?
I can imagine.
Instagram moment with the sunset, having a drink with your friends or family. I mean, that's amazing.
So what does it take to do something like this? And I'm thinking cost, engineering, time.
Yeah, a lot of effort from a lot of people. So it starts from just the design and the conceptual aspect of it. Then we need to figure out a lot of technical factors, the weight, the wind, and so lots and lots of hours of really hard work. And every time we up the game, we see that customer willing to spend more.
Multi-trillion-dollar industry. There's a lot of ground to cover.
Commodities got absolutely crushed.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ. Monday on Bloomberg.
Welcome back to the Open, everyone. 30 minutes into the European trading day, and here are your top stories. Facing the feds, FTX co-founder Sam Bankman-Fried arrives in New York to face criminal charges as two of his associates plead guilty to fraud in connection with the collapsed crypto exchange. Unwavering support, President Biden doubles down on backing Ukraine for as long as it takes as President Zelensky meets with Washington lawmakers in his first trip abroad since the Russian invasion. Plus, Germany's finance minister says Berlin is veering away from over-reliance on Russian energy and outlines his vision for strong transatlantic ties in a Bloomberg exclusive. So this is a picture for equities across the board. We are seeing a little bit of support with the European stock 600 gaining some 0.3%. Of course, we do have thin volumes, but I guess it's nice. A lot of traders are off from today. It's nice to finish what feels like could be the end of the year on a little bit of a high note. Now, if we look at the sectors that are on the move the most, and we were seeing this in Asia trade, just watch out for anything to do with technology, but also real estate. I have energy, retail, and insurance on the way up, and actually only two lonely equity sectors on the way down, auto parts and real estate. So the dollar lower today as equity gains, damping demand for haven assets. Meanwhile, the yen resuming its climb after a small loss yesterday. Well, Tuesday's session saw it rally the most since 1998. The former Japanese Vice Minister of Finance, known as Mr. Yen, says there's more appreciation in store for the currency.
It is now 135 or something, right? 32 or something. And it will probably slowly, appreciate toward 120. I think it will hold around 120 for some time.
Well, joining us now to talk currency markets well into 2023, Dominic Bunning. He is head of European FX research at HSBC. Dominic, thank you so much for joining us. I mean, I find it quite exciting because you're almost at the end of the year, and you look forward to like what everything could go right or wrong in the next 12 months. So, is dollar? I mean, do you have to get dollar right to really get all other currency pairs right?
Yeah, I mean, I think the last 18 months. To be honest, FX has been a one-way trade. It's just been the dollar on the one side and everything else on the other side of that. And, if you look at cross-currency correlations and cross-asset correlations, they've been super, super high. So getting that big dollar call is the first thing. But I do think as we head into 2023, there is maybe a bit more room for some differentiation. Some of the forces that drove that dollar strength that was so powerful all coming together, they're starting to fade. And that might allow a little bit more room for different views to come through.
So how do you see it playing out? I was actually one of the guests, I think 2 days ago, was pushing back because I was trying to argue that, if you look at what the Bank of England is trying to do and the ECB, they are really starting to diverge. But he says, yeah, but what they're trying to achieve is the same, so it doesn't make that much of a difference.
Yeah, well, I think the central bank approach is becoming really, really interesting at this point, and you're starting to see some differentiation in the FX market as well. So we've had this period of super high inflation. All central banks have turned really, really hawkish. But we're now getting to that point where inflation does seem to be peaking. It does seem to be rolling over. And I think there's a risk for some central banks of sort of staying too hawkish for a bit too long. And the ECB might be going into that camp. If you look at the RBNZ in New Zealand, they've really ramped it up in the last couple of months, just at the time when inflation seems to be peaking. And that hawkishness initially was translating into currency strength, but it now seems to be reversing a bit. And I think markets might be getting a little bit cautious about that risk of actually over-tightening at this point. So that, I think, is something to watch as we go into 2023. For the last year, it was very much the more you hike, the better it is for your currency. That might start to change a little bit.
So is this because it takes, of course, there's a lagging time, especially on unemployment figures in the labor market, for some of that hiking to come through, or is it because you think we've reached peak inflation and it just comes down from now?
I think it's both of those things. There's a lot of lagging indicators that these central banks do seem to be focused on. And when you look at inflation, one thing we've looked at just recently, when inflation starts to trend, it usually happens faster than anyone expects. Right. So on the way up, it goes up faster than anyone expects. On the way down, the same thing happens. So you get this sort of positive surprise relationship versus the direction of travel. So if we assume inflation has peaked, when it comes down, and as it comes down, it's probably going to come down faster than people expect. That's what the historical data shows us. So I think that's the potential story here. Those supply side challenges shift, they come away, demand has already been reduced somewhat, and therefore inflation could drop away quite quickly in some places, and those central banks might be a little bit exposed.
But Dominic, that means, right, if you're right, that it could also open the problem for policy mistakes, because it could come down very rapidly, inflation, but not to the 2% or even 3%. And so then central banks are kind of stuck in realizing, or, and asking themselves whether they need to still hike aggressively.
Yeah, and that's, I think, one of the challenges, one of the risks central banks face as well is the way they've been hiking so aggressively. And with the lags that we know monetary policy kind of needs to take into account, you're not necessarily seeing the tightening we've already had reflected in the market. So I think those lags and the speed of hikes creates the risk of policy. I think more volatile policy making is an inherent risk, potentially create a more volatile economic environment. So it's understandable why central banks have been more hawkish. It's understandable why they've been delivering 75 and 50 basis point hikes. Yeah. But from here, with inflation potentially rolling over, that to me is a potential risk that we need to be aware of.
Okay, go back to dollar. Dollar strength or dollar weakness by the end of next year?
Dollar weaker. I think, like I said, the three things that really drove dollar strength last year, higher US rates, weaker global growth, weak risk appetite, those three things are fading. They're not completely gone, but they're fading. And we're at levels where the dollar's very, very, has been very overvalued. So that overvaluation needs to correct. Yes, US rates are going to remain elevated, but they're not going to keep going up. It's that rate of change that matters. Yes, global growth still looks pretty sour, but it's not deteriorating. Yeah. It's not decelerating at the same rate. And you're actually starting to see some upside surprises on growth relative to consensus, and you're seeing those downside surprises on inflation. So those two things, it's almost the reverse, potentially, of what we've had the last few years, which has been super strong inflation, very weak growth. Those things starting to change, that changes the outlook for the dollar.
What about euro? Has it been sold off too much in 2022?
Yeah, look, we think we go back to 110 on euro. I think it's still quite early days.
Honourable.
Yeah, it's hard for me to be a euro bull, to be honest, but I do think that the euro dollar going back to 110 or so is still very plausible, because that European economy, yes, it's weak, but it's starting to show signs of improving relative to consensus. If inflation does come down that bit faster, you could have into Q2, Q3 a really quite positive story where you've got global growth bottoming out, China reopening, which helps Europe, the rebalancing story as well in Europe. One of the interesting things we've seen, the cheapness of the currency through 2022 is starting to engender a macro rebalancing. You're getting more portfolio inflows, you're getting a bit of a stabilization on the current account. Those sort of dynamics are quite positive for euro at what are quite cheap valuations. So I think there's a bit of euro upside still here.
What about sterling? So we're having a very difficult, holiday. We're having a very difficult December, actually, because of the strike, because of inflation, housing. I mean, we have predictions that it could fall some 30%. Does it get worse before it gets better in the UK?
Yeah, look, it's very hard to be a sterling bull. I've been bearish on sterling for most of my career, I'd say, but in the last couple of months, we have started to turn more optimistic. And part of that's obviously the dollar story. But again, I think there is so much negativity already priced into the UK. Yes, we're in a recession, but everyone knows we're in a recession. You know, you can talk to anyone on the street. Everyone knows that. Yes, we know we've got high inflation, but that inflation's probably peaking. And actually, the Bank of England, in some respects, they've been one of the more forward-looking, more prudent central banks in the way they've hiked rates. They haven't sort of just gone super aggressive at the last minute. They've been a bit more cautious. They've kept that longer-term growth view in play. So, you know, I do think there's some room for sterling to actually do a bit better here. And what almost makes me a bit more bullish is everyone's still pretty bearish on sterling. So it's still quite a counter-consensus view, I think, to be looking for sterling strength. And that's something I do think can play out. It's going to be tricky for the next few months, but as we head into 2023, I think there's room for upside there.
And then, of course, the story of the week is yen. With that Kuroda shocker, not many people are expecting it. What happens next year?
Yeah, look, the timing of that was definitely sooner than anyone expected. We thought maybe it could happen, you know, Q1, Q2 next year. Maybe you might.
When he stepped down.
Yeah, exactly. That was the kind of the obvious point, right? But that's obviously happened sooner. I think a lot of that initial move is probably done here. If you look at the relationship between JGB yields and dollar yen, that is already reflected in the price. But, you know, the yen is still very cheap. And I talk about dollar being overvalued, being quite rich. The yen's the cheapest currency in the G10 space. And so as you get into that environment where US yields, you know, stop going up, maybe even roll over a little bit, dollar yen does have quite a lot of room to correct. And if Japanese investors start to change their hedging strategies, which is quite plausible at this point, you know, that could lead to further dollar yen downside. So yeah, I do think dollar yen has further to go. It's still probably the most, the cheapest currency in the G10 space. So there's a lot of room there.
All right, Dominic, thank you so much. Dominic Running there, head of European FX research at HSBC. Now, coming up, we'll also hear from the German finance minister, Christian Lindner, who has spoken exclusively to us on Bloomberg TV with our Maria Tadeo. So we have more of that conversation coming up shortly. And this is Bloomberg.
Humanity consumes 500 billion cups of coffee every year. That's almost double what we consumed a decade ago. And yet, coffee production is one of the most antiquated industries in all of agriculture. Climate pressures like drought, heat, and blight are affecting food producers in different ways all over the world, as climate change becomes something we can taste. In the past year, hundreds of thousands of acres of coffee plantations were wiped out. What's at stake are the livelihoods of around 125 million people. Because, if you're being honest, this is a plant that cannot hold on much longer in a changing climate.
How did Jeff Bezos realize you could sell anything on the internet?
The web was growing at something like 2,300% a year. Anything growing that fast is gonna be big.
Why did Bill Gates create Control-Alt-Delete?
Kind of become the poster child of, hey, couldn't you have made this stuff a little simpler?
And what inspired Diane von Furstenberg to create the wrap dress?
The wrap dress created me.
On the David Rubenstein Show, I uncover the untold stories of the world's most successful leaders, right here on Bloomberg.
Information you want, analysis you trust. Everything you need to get set for the start of U.S. trading. Watch Bloomberg The Open with Jonathan Ferro. Weekdays on Bloomberg.
Welcome back to the Open, everyone. 42 minutes into the European trading day. The picture across the board, one of gains. European stocks getting 0.4%. Now, an out-of-control energy market, soaring inflation, and trade tensions with the U.S. have made it anything but a quiet first year in office for the German finance minister, Christian Lindner. He joined Bloomberg exclusively in Berlin to discuss the country's economic challenges.
This year has been difficult, of course. We were harmed by the Russian energy war due to our too high dependence on Russian energy imports.
That was a mistake,
of course.
would you say now?
Yes, had been a mistake, but now we have changed our policies. With light speed, we are improving our energy infrastructure. We are bringing more capacity of renewable energy to the grid. And, well, who thought that Germany would be able to build new LNG terminals in less than 1 year?
You have done it. And
I assure you, this is the very best moment to invest in Germany. This is the very best moment to buy bonds.
And of course, the crucial question, especially for Made in Germany, I know you like Made in Germany, you speak highly about it, and I know you particularly like cars, but my question to you is, when you look at the Inflation Reduction Act, can Germany stay competitive when you have the United States coming in with such an aggressive policy on subsidies? Is that something that worries you? Are you on the phone with your U.S. counterparts? What do you want to see out of this?
On the one hand, the German car manufacturers are competitive. I think they
you don't fear Tesla?
No, we mustn't fear Tesla. Tesla produces in Germany as well, near Berlin. But I think the German manufacturers, they are innovative and competitive. And, well, they have plants in the United States as well. So I think they are less harmed by the Inflation Reduction Act than public opinion in Germany thinks. But on the other hand, I take the Inflation Reduction Act seriously. I have my concerns regarding a fair level playing field between the US single market and the European Union. And this is why we need to negotiate. I'm in favor for waivers for the European businesses in the US
So you want the waivers, you don't want a trade war. What you want to get is the waiver in 2023.
We have to avoid any kind of trade war.
No trade war.
Instead of trade war, we need trade diplomacy. We need new free trade agreements. At least we have to make efforts to find a level playing field in the perspective of a free trade between US and European Union.
And what do you say perhaps to some critics in the United States that argue, yes, Europe is in a mess, but this is not our fault. Why should we give you any waivers?
Value partners, who we are, should be preferred trade partners, I think. My vision is a free trade zone of liberal democracies in the world. And one of the first steps could be to improve the trade relationship between United States and European Union. We would benefit both from this idea. And, well, I think there is an openness on the US side when I remind you of Janet Yellen's idea of friend-shoring. And Inflation Reduction Act should be reconsidered with respect of friend-shoring.
And you're optimistic that can happen. Let's talk about today President Zelensky will be meeting with President Biden. Of course, it does feel the Ukrainians worry about lack of momentum and lack of support as time in the war drags on. When it comes to Germany and the European Union, will you foot this bill no matter what? And there's a very serious question about the reparations and what to do with the Russian central bank assets. In your view, who's going to pay for this? Because we're talking about potentially $1 trillion in reconstruction. It's a massive bill.
At the moment, there are the current needs of the Ukraine which have to be met. European Union has decided on the macroeconomic assistance plus 18 billion euros next year to support the state of Ukraine. And we will continue to support Ukraine with military goods, such as artillery. And then in the midterm, I hope the sooner the better, then we will have to find ways for the reconstruction of Ukraine. And okay, there are reparations, there is macroeconomic assistance, we have the multilateral banks, we have the international financial institutions such as the IMF, and the Ukrainian economy itself. I think they have very good perspectives, they have natural resources, qualified labor force, so I think they have a very good perspective after the war.
That was German Finance Minister Christian Lindner speaking exclusively with our very own Maria today. Now let's get straight to the Bloomberg First Word News. And Ukraine's president, as we just heard, Volodymyr Zelensky, has addressed the U.S. Congress, telling lawmakers his country is alive and kicking despite almost 11 months of war. In Zelensky's first overseas trip since the start of the war, he thanked Americans for their support while renewing pleas for more advanced tanks and fighter planes.
This struggle will define in what world our children and grandchildren will live, and then their children and grandchildren. It will define whether it will be a democracy of Ukrainians and for Americans, for all. This battle cannot be frozen or postponed.
Hospitals in Shanghai are struggling to cope with the number of COVID patients, with many pharmacies turning away customers. Months after the city of 25 million endured a brutal lockdown to stop the virus spreading, COVID is making its way virtually unchecked through its population. Most of Shanghai's schools are now closed, and the public transport usage is plummeting. More than three-quarters of U.S. businesses surveyed say the government's Brexit deal has not helped them increase sales or expand. According to the British Chambers of Commerce, Brexit has damaged the ability of companies to compete in the EU, with businesses banging their heads against a brick wall. The research is published on the second anniversary of the agreement between London and Brussels. Well, that's your Bloomberg, First Word News. Now, coming up, one of the worst years for stocks and bonds in more than a decade. We'll recap a pretty wild year for markets. That's coming up next. This is Bloomberg.
Energy prices and a short supply of key chemicals that produce synthetic fertilisers are sending pig, cow and horse manure prices soaring. Even human waste is in demand as farmers hunt for alternatives. Fertiliser helps increase crop yields.
You can see how much moisture is held into this. It's a lot of organic material into the compost, so it breaks down. The manure and the straw breaks down into a friable mix that can be mixed into your soil in the ground and for growing a whole range of different vegetables. Holds the nutrients in, holds the water in, and it really increases the kind of biodynamic profile of the soil.
The recent price spike could mean more farmers going organic for the long term.
Welcome back to the Open, everyone. We are 52 minutes into the European trading day. Look at that. We're seeing a bit of gains. We'll take it. It's a bit of a green, but of course the volumes are quite thin. European stocks gaining 0.3%. So are you ready for 2022 to be over? Well, for investors at least, it's certainly been quite a year. Our markets reporter, Valerie Teitel, is here to recap what we've lived through. Valerie, I mean, you know, what will history remember this year for?
Oh man, Francine, there are so many things that happened this year that I don't think are going to be repeated. But I think the thing that history books will have written is the fact that we've seen the most aggressive central bank tightening ever. And honestly, Francine, it is unlikely to be repeated. Nearly every central bank hiked over 250 basis points, and it came totally out of left field. Let me give you some quotes. One from the ECB a year ago. Lagarde told us that pricing and rate hikes was entirely premature. They went on to hike 250 basis points, and she told us a few weeks ago there's a series of 50 more basis point rate rises in the cards. And then the RBA, this time next year, had extended their forward guidance, told us they were years away from hiking. They hiked 300 basis points, and there's a few more priced in the cards. But look, I'm really looking for a snazzy acronym to sum up this year. I haven't really been hit with any, so if you come up with any good ones, let me know, Francine.
Yeah, I had a good one, which I keep on forgetting, but it's like scaling back ambitions. Because if you look at central banks, they kind of started the year and saying, like, we'll be fine, it's transitory. And then there was all these mea culpas.
Oh, man. They really left us with nowhere to hide. A lot of the traditional hedges really broke down. The big one being the 60-40 portfolio. This is what a lot of 401ks, a lot of our pensions track. You know, it really faltered. At one time, it was down 20% on the year. This is a graph here of the yearly returns going back to 1990. You can see how just big a standout this year was. And why was that? It's because stocks and bonds fell together, and in a momentous way, a way that we've really not seen probably since the World War II. And, you know, a lot of this is posing questions. It really got everyone quite nervous about where to hide out in this crazy year. And whether this is going to actually extend into next year, you know, we have yet to see.
Okay, so I have a new acronym, HCB, humbled central banks, because actually for me it's really the theme of 2022. Where do they go from here? I mean, we had some pretty memorable moments in 2022.
Yeah. I think we were all humbled. Anyone trading these markets this year was definitely humbled. I was incredibly humbled by what happened in June this year when we got a bomb dropped by nearly every central bank. The Fed had to leak to the Wall Street Journal that they were going to hike 75 instead of 50. The Bank of England, Bailey, came out saying they were going to act forcefully, and gilts fell out of bed. And then we had the ECB pull the TPI tool right out of the bag to save the Italian bond market. And the Swiss National Bank came out and hiked 50 instead of 25, all within a course of 5 days, and it ended up with the S&P bottoming in that mid-June date. It was a harrowing week at work, but you know, boy, we had some fun. The other one I want to remember, and that I don't think I will ever forget, is the mid-October when the Bank of Japan did their massive FX intervention in dollar-yen. Honestly, they spent $40 billion in a matter of minutes. I don't think that scale of intervention we might ever see again, Francine. I'll always remember where I was that day. I saw the Bank of Japan ram dollar-yen down 6 handles.
Yeah, it was quite something. I think we had like 7 standard deviation on yen. Our markets reporter there, Valerie Teitel. Now, we're also showing you pictures of El Gordo, Spain's annual Christmas lottery draw that claims to be the world's richest. It's taking place in Madrid's Royal Theatre Opera House. The fat one, El Gordo, is a traditional lottery draw with thousands of winning numbers sung out by children from a local orphan home. Now, the total annual estimated prize pool is around 2.5 billion euros. So that's it for the European Market Open. Surveillance Early Edition is up next, and this is Bloomberg.
everybody want to be a consultant, and what are all these consultants doing?
Well, David, I think that we actually defy the label consultant because sometimes consultant seems to imply that we only give advice. And when you look at what Accenture does, we're really different than the traditional version of a consultant. We're really about relevance and results, and that's what is driving our business.
What about a consulting project? In my example, I'm the CEO, I have a problem, I call you up, I say, solve my problem or give me a solution.
We don't operate as big companies permanently in crisis mode. And so when you think about like how long does it solve things, a lot of it starts with, the company being willing to set aggressive goals. And so what we are trying to do now is work with our clients to work differently and to work faster.
The top names in business are on Bloomberg.
I think you have to assume that we have some bumpy times ahead, and you have to be a little bit more cautious with your financial resources, with your sizing and the footprint of the organization.
So what can you do near term? Test to make sure you see at the margin you can move things around, manage your expenses very carefully and invest in efficiency and effectiveness, but also continue to spend money where you have competitive advantage.
Nobody covers business like Bloomberg, your global business authority. This is Bloomberg Surveillance, Early Edition, with Francine Lacqua.
Good morning, everyone, and welcome to Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Here's what's coming up on today's program. Facing the Fed's, FTX co-founder Sam Bankman-Fried arrives in New York to face criminal charges as two of his associates plead guilty to fraud in connection with the collapsed crypto exchange. Unwavering support, President Biden doubles down on backing Ukraine for as long as it takes as President Zelensky meets with Washington lawmakers in his first trip abroad since the Russian invasion. Plus, Germany's finance minister says Berlin is veering away from over-reliance on Russian energy and outlines his vision for strong transatlantic ties in a Bloomberg exclusive. So let's get onto the markets. It does seem like we're finishing, we're starting on Thursday. I'm getting a bit ahead of myself, but I know there's a number of market participants that are off for the rest of the year. And so S&P futures for the moment gaining some 0.2%. If we were to look at European stocks, it's also similar again across the board. Now, there's nothing fundamentally that's changed, maybe a bit of positioning, also volumes quite thin because we're nearing December 25th. Global stocks gaining after U.S. shares, though, rose on improved consumer confidence and better than expected earnings. Now, as the fallout from the Bank of Japan surprise policy change begins to ebb, Treasury yields sliding a touch, as well as the Japanese 10-year yield. Meanwhile, the yen has actually resumed its rally. Now, we're joined by Salman Ahmed. He is Global Head of Macro and Strategic Asset Allocation at Fidelity International. Salman, I'm excited speaking to you because we look forward into 2023, and I guess if 2022 was the year where inflation surprised and, of course, central banks were humbled, what are you worried about most in 2023 that we could get wrong?
Good morning, Francine. So basically 2023 for us is turning to be a year of the growth damage, i.e., as you rightly pointed out, inflation increased so significantly, and as central banks changed their policy stances, firstly signaling tightening and then actually delivering tightening, and we saw the Bank of Japan being the latest one to do that. We are now waiting for the price we have to pay for this inflation to turn. And that's going to be in terms of growth, in terms of the damage to the labor market. And that's what we are focused on, that how much of this tightening starts to negatively affect the economies, the various economies. And then, of course, for equity markets, it's the impact on earning profile. And for bond market, it's the combination of growth and inflation mix, which will potentially change in 2023.
So, Salman, first of all, give me a sense of where you think, are there any parts of equity markets that are actually pricing a recession, or are they still trying to look through that?
So back in October, our assessment was that equity markets overall were starting to price in a meaningful probability of an average recession. That has changed quite significantly since then. Of course, the CPI release was an important factor, but also the thinking behind that a soft landing can take place. So we are not in that camp, even though a lot of commentators and analysts are saying that recession is their base case, but that's not what you see in equity markets, especially if you look at cyclicals versus defensives. And we are thinking that earning profiles will start to come under more pressure as real data starts getting hit, and that's why we are a bit more cautious and defensive going into 2023.
So what does that mean, Salman? How do you play that tactically?
So tactically, we are underweight equities. We are not overweight cash. We have started buying bonds recently as yields went up, as we thought that this phase of macro cycle will transition from focus on just on inflation and central bank tightening to the growth damage. So we are now underweight equities and we are overweight bonds and especially IG credit as well, as we move towards 2023, which was not our main stance during 2022.
I know one of your key macro themes, which you were kind of alluding to, was navigating the poly crisis. Is there a chance, and I know you believe in a recession, but is there a chance that actually inflation takes everyone by surprise and comes down quicker than we thought it would?
We are looking at that those different factors we've seen, and supply side factors will play a big role there. But the point is that we're making is that that the supply side relaxations are already most of them done. So we have seen core good inflation coming down, and it's now the problem is on non-housing core inflation, as Chair Powell focuses on it, and it's a very demand sensitive component, and that will need some damage to growth. And then the tightening you have seen this year, and you compare it to all the recessions we have seen since 1948, it's a very significant tightening. And it will have implications. And that's why we are cautious and we are skeptical that a soft landing can take place just because supply side issues resolve themselves and we have a soft landing as a result of that.
Are we misunderstanding what a China transition to a reopening economy means for the rest of the world?
The China reopening will be important for China. It has been in a very different economic cycle, as we know, because of zero COVID policy and, of course, the other policy changes which took place. For China itself, it's going to be a very important, significant factor, and it may spill over to the rest of the world through the commodities channel as demand comes through. But we have not seen Chinese pressures or Chinese growth pressures affect the global economy in 2022. I mean, U.S. economy was very strong. European economy was initially facing this reopening rebound. So these economic cycles have diverged quite significantly. And yes, it will probably help from a global perspective, but the domestic tightening is so strong that we think that will be the dominant factor rather than the China reopening.
But Salman, I mean, on the China reopen, does it really push? We're in a scarcity environment. I know we have supply chain issues. Does it push energy prices to almost breaking point?
So the rule of thumb is around 1 million barrel of oil demand, extra oil demand pushes oil prices by around $20 to $25. Of course, you can have volatility around it, and the assessments which have been coming through is that China's ZCP policy has been destroying demand up to $1 million barrels per day. So that's an important source of demand which will potentially come through, and energy will be the factor. But we do think that the core inflation and the core domestic side of the economies will be under pressure, which will be the key factor rather than this headline inflation boost which may come through as China opens up temporarily, boosting the demand for oil.
We also had it's been a big week actually in the markets. I know it's quite quiet, but then we had the Governor Kuroda shocker. How strategically do you play Japan or yen?
So we have been flagging this risk for global markets for a while now, and no matter what the narrative which is coming through is that this is adjustment to the policy, it is a step towards an exit. And you can see that in the JGB yields, they are, they have risen, they have not fallen, despite the fact that the corridor was widened and the firepower now available to BOJ is bigger. The fact is that market is being dominated and it will continue to remain dominated by BOJ. It is an internally inconsistent policy. So we are thinking that this is the first step towards exit, and then dollar looks vulnerable here as Fed maintains its hawkishness and other central banks like ECB and BOJ catch up, and those interest rate differentials will move against the.
Salman, I haven't asked you something that actually worries me, and I hear it more and more from market participants, and that's liquidity. Is there a worry that 2023 markets come to a halt, certainly in some parts, in some asset classes, because of a lack of liquidity?
So, Francine, as you know, all the key central banks which were providing liquidity until 18 months ago or 15 months ago are pulling it back, and the Bank of Japan is the latest one. So we do worry from a top-down perspective that liquidity is being taken out of the system, and that's why we have to reprice some of those risk premiums. But at the micro level, we know that the treasury market liquidity is under stress. And you can have big moves on small data releases, and then of course the shadow banking sector itself may suffer a more wider liquidity shocks. So that's something for sure to look at as we move into 2023.
But on the shadow banking, Salman, are you impressed by the fact that, given all of the crazy news, frankly, that we had in 2022, markets still held it together? Because usually in a big, there's so much leverage out there that in this kind of aggressive hiking cycle that frankly took a lot by surprise, we could have had some really ugly market events, or are they just delayed into next year?
So, we've been looking at the refunding profiles of the corporate sector, which has levered, to your point, quite significantly, especially during pandemic. The good news is that a lot of the refinancing flows we pick up are from 2024 onwards. And 2023, especially in high yield, we don't see a big refinancing wall coming through. That gives time to the Fed, and that gives time to the system to adjust to these higher rates. But these rates cannot stay at these very high levels for much long, because these are like a 5% terminal rate for the US is a very high rate. So as we move towards 2024, we do think that those problems may start to become key focus areas, especially if the Fed doesn't relent and starts cutting rates by middle of next year.
Salman, thank you so much. Salman Ahmed there, Global Head of Macro and Strategic Asset Allocation at Fidelity International. Coming up, our half-hour UK special, 9:30 a.m. We'll be looking, of course, into the state of the economy, recent data highlighting a deepening recession, and how Brexit fed into that. The Chief Executive of upmarket British brand Fortnum & Mason will join us to discuss all of this, as well as share his growth strategy outside of Europe. Don't miss that interview. It's exclusive, and it's at 9:30 a.m. UK time. This is Bloomberg.
China's military power has been growing at an incredible speed over the last 20 years.
A strong country must have a strong military, as only then can it guarantee the security of the nation.
In terms of sphere of influence, we absolutely know that China wants to be dominant in Asia. So there is a target to get to that point, to be a military that is a peer to the greatest militaries in the world by 2035.
The competition for influence is a global one. And through a multi-decade trajectory fueled by planning, money, and pragmatism, China is building a military that allows it to shape the 21st century just as the U.S. shaped the 20th.
The Fed are on Bloomberg.
I do see growth slowing, but remember that's part of the mechanism of getting demand into better balance with supply and alleviating those price pressures.
We're clearly not in a recession right now based on the data. It is an economy that is growing only modestly, and I think it's an economy that's really seeing the imbalances between supply and demand diminishing and inflation coming down.
Nobody covers the Fed like Bloomberg, your global business authority.
Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now, Sam Bankman-Fried has landed in the U.S. to face a litany of criminal charges tied to his role in the collapse of crypto exchange FTX. This comes as the SEC charges Alameda's Caroline Ellison and FTX co-founder Gary Wang with fraud. Now, joining us is Bloomberg's crypto senior editor Anna Herrera. I mean, Anna, there's all sorts of intrigues trying to figure out. Also, I think there are ex-girlfriends involved. What's the latest on Bankman-Fried's journey?
So he's in the U.S. now, and the U.S. district attorney was saying they're trying to get him in front of a judge as soon as possible. And obviously, as you said, meanwhile, as he was en route to the U.S., we discovered that his top lieutenants, two of his top lieutenants, Caroline Ellison and Gary Wang, were collaborating with U.S. authorities, and they pled guilty. So the SEC and the SCFTC have amended their lawsuits to include them, and we've had more details about what was going on behind the scenes, which included Gary Wang, including sort of lines of code that would hide how much Alameda was borrowing from FTX, and also the fact that most notably when Terra collapsed in May, and that caused a trigger sort of margin calls, Alameda was running out of money and they took funds from FTX, so customer funds. So it is quite, a big and a long list and a long list of charges and a long lawsuit.
Yeah, it certainly is. What are the details, actually, that we know of the plea agreements from the FTX associates?
We don't really know much of the details of the plea agreements, but we know that obviously when you do plead guilty and you do collaborate with authorities, the prosecutors tend to ask or will ask if you collaborate for a lower sentence. So, and also that, I guess that also means that, for other executives that were at FTX, anyone else who could have information, the district attorney said that, they should come forward now, that their patience is not unlimited. So we'll wait to see if more names pop up.
So, Anna, what does it mean for Bitcoin going forward? It's currently around $1,700. I mean, is there more fallout than what we've had so far?
We could see more fallout. We could see more people or more companies that were somehow connected to FTX and Alameda, either they were counterparties or not, that might get sort of hit too. In the immediate collapse of FTX, we saw a company called, another company go bankrupt, another lender, BlockFi, because they had been sort of rescued by FTX, and obviously FTX needed rescuing too. But we could see more dominoes fall. It depends whether it will. Obviously, the impact on Bitcoin will depend on the size of that firm, I guess.
Anna, thank you so much. Bloomberg's crypto senior editor there, Anna Herrera. Now, coming up, we hear exclusively from a former Japanese Vice Minister of Finance for International Affairs, commonly known as Mr. Yen, after the BOJ's shock move this week. That's coming up next, and this is Bloomberg.
a push have you seen from the Kishida government in terms of green funding?
The Kishida administration has committed to doubling the amount of investments in so-called green technologies. I think we need more than just pronouncements. We need real money backing very innovative startups and innovative companies in this space.
What do you make of Kishida's new capitalism?
Well, I think his framework is reflective of the challenges that Japan's society is facing, namely that growth has been present, but growth has not been, of course, evenly distributed. But frankly speaking, it's hard to redistribute income if you don't have much income to begin with. If the government and private sector can work together and collaborate to drive more innovative growth startups, that can really drive the income growth that the Kishida government needs to redistribute.
A multi-trillion-dollar industry. There's a lot of ground to cover.
Commodities got absolutely crushed.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ. Monday on Bloomberg.
Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacroix here in London. Now, Esukue Sakakibara says the Bank of Japan may surprise markets again by tightening monetary policy as soon as next month. The central bank surprised investors this week by raising its cap on 10-year bond yields to 0.5% from 0.25%. Sakakibara, also known as Mr. Yen, for his ability to influence the currency during his time as Japan's vice finance minister from 1997-1999. Now, he spoke exclusively with Bloomberg's Kathleen Hayes about where he thinks the yen is headed.
It is now 135 or something, right? 32 or something. And it will probably slowly, appreciate toward 120.
And what's going to drive it beyond there? Or do you think that's the level we're going to see the yen holding at for some time?
Yeah, I think it will hold around 120 for some time.
Okay. In terms of the next meeting in January, is because the BOJ, because Kuroda has made this move, widening the band of yield curve control, is it possible that there could be another shift in policy on the table in January?
It's possible, but I don't see any concrete move at this moment. But Kuroda may move at the next meeting.
And if he did, what would he do? Would he move on the negative rate? Would he widen the YCC band again?
Well, maybe he would widen the band. But, well, it's very difficult to predict that at this moment.
So can we, it's a pretty basic question. Is it clear that policy normalization has already begun?
Yeah, I think so. Kuroda was quite aware of that, and, he has sort of expediting the policy normalization a little earlier.
Well, Japan's former vice finance minister, Mr. Sakakibara, there with his views on the yen and BOJ policy. Now, let's also get to the Bloomberg First Word News. Here's Leanne Gerrans. Hi, Leanne.
Hi, Francine. Ukraine's President Volodymyr Zelensky has addressed the U.S. Congress, telling lawmakers his country is alive and kicking despite almost 11 months of war. In Zelensky's first overseas trip since the start of the war, he thanked Americans for their support while renewing pleas for more advanced tanks and also fighter planes. Hospitals in Shanghai are struggling to cope with the number of COVID patients, with many pharmacies turning customers away, months after the city of 25 million endured a brutal lockdown to stop the virus spreading. COVID is making its way virtually unchecked through its population. Most of Shanghai's schools are now closed, and public transport usage is also plummeting. More than 3/4 of UK businesses surveyed say the government's Brexit deal has not helped them increase sales or even expand. According to the British Chambers of Commerce, Brexit has damaged the ability of companies to compete in the EU, with businesses, quote, banging their heads against a brick wall. The researchers published on the second anniversary of the agreement between London and Brussels. And H&M has halted sales of its Justin Bieber collection after the singer accused the company of selling clothes depicting him without his consent. The Swedish retailer says it followed all proper approval procedures, but is pulling the goods out of respect. In other Bieber news today, the singer is said to be near a deal to sell his music rights to an investment entity backed by Blackstone. Bloomberg understands Bieber's stake could fetch as much as $200 million. Global news 24 hours a day, on air and on Bloomberg QuickTake, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Leanne Gerrans. This is Bloomberg. Lovely Bieber news there, Francie.
Yeah, that's what I call Bieber fever. Thank you so much, Leanne Gerrans. Now let's check in on some of the stocks on the move. First of all, we start with STMicroelectronics. Now this is after Micron's earnings actually missed estimates. So let's see exactly how they're moving today. Now the other story on STMicro is that Citadel did boost its short position in STMicro to 0.61%. I don't think it's having a huge, look, STMicro's down 0.4%. In a market where overall equities are up, it's not great, but it's also not a huge move. The other thing we're watching out for is, of course, Prosus. Just a couple of days ago, I think Prosus had the Tencent funded buyback unlocked some $15 billion in value. Today, it basically said it continued to buy back some of the Tencent shares, bought back some $266 million of shares in the week, December 12th to December 16th. Prosus gaining 0.8%. And finally, Stellantis, this is on the back of demand normalizing for a lot of the cars out there because the supply chain is also normalizing. Stellantis down 0.5%. Coming up on Bloomberg UK this week, we hear from the chief executive of London's iconic department store, that's Fortnum & Mason, on how the luxury retailer is doing this festive season. That's coming up next, and this is Bloomberg.
Humanity consumes 500 billion cups of coffee every year. That's almost double what we consumed a decade ago. And yet, coffee production is one of the most antiquated industries in all of agriculture. Climate pressures like drought, heat, and blight are affecting food producers in different ways all over the world, as climate change becomes something we can taste. In the past year, hundreds of thousands of acres of coffee plantations were wiped out. What's at stake are the livelihoods of around 125 million people. Because, if we're being honest, this is a plant that cannot hold on much longer in a changing climate.
No one covers the world like Bloomberg.
My team thinks 2023, we avoid a recession. I'm a little more skeptical about that.
China and the U.S. both do not want to see nuclear force on the European continent.
The regulators here in the Bahamas are ongoing with their investigation into FTX.
With unmatched reach and resources from more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, your global business authority. Information you want, analysis you trust. Everything you need to get set for the start of U.S. trading. Watch Bloomberg The Open with Jonathan Ferro. Weekdays on Bloomberg.
Good morning, everyone, and welcome to Bloomberg UK, a news show with a special focus on the biggest challenges facing the British government, the British economy, financial services, and the markets. I'm Francine Lacroix here in London. Now, on the show this week, with just days until Christmas, the UK is grappling with its worst labor disruption for 30 years. We'll look at how businesses are coping with transport strikes during the crucial festive period. Also on the program, how is the new winter of discontent affecting luxury retail at Christmas? Well, we're joined by the chief executive of London's iconic department store, Fortnum & Mason. Plus, with the UK set to enter a recession, we recap a turbulent year in British politics and finance. But first, we begin with the story that, of course, is dominating front pages in the UK today. Public service workers continue to strike over wages as a cost of living crisis takes bite. It's impacting everything from healthcare to public transport. And it couldn't come at a worse time for hospitality and retailers already struggling with the economic downturn and spiraling prices. There's also no festive cheer from the CBI, warning of a deeper recession in the latest quarter than previously thought. So let's discuss all of this with our UK retail reporter, Katie Linsell, and Bloomberg UK's John Stepek. So thank you both for joining us. John, I mean, when you called also that house prices could fall some 30%, I have to say it sent shockwaves, not only in markets, but all the way to like Brussels. So overall, we've had a really tough year in the UK. We're having an even tougher December. Does it get better or does it get worse?
Well, you see, this is the tricky thing for next year. I mean, there are elements for next year, trying to be a bit optimistic about it, that could actually get better. So inflation, the inflation rate should come down. Petrol prices are coming down. Beyond that, I'm kind of struggling a little bit.
He's trying so hard to be optimistic. John, come on, you can do it.
Well, the problem is, I mean, I suppose, so interest rates, mortgage rates have come down a little bit since the peak in October. But you're still looking at kind of like 1.8 million people coming off fixed rate mortgages next year. That means that, you know, the price that they're paying is going to go up. So that's an additive onto the cost of living squeeze. We have, you know, there is a kind of wider issue as well in terms of the indebtedness of the kind of UK government and how they're going to deal with the strikes and what that means for the public finances. So there's another issue there to be concerned about.
Yeah, and John, I mean, this is, you know, no laughing matter because a lot of people are also struggling. I guess even in your piece, you say mortgage holders are actually maybe better off than they were in 2008. And then I want to talk about retail because, Katie, I know a lot of people are struggling because they can't, or certainly central London bookings like pubs and also retailers aren't getting that footfall because of the strikes. But overall, consumers are still spending.
Well, yes, consumers are still spending for now. I think for sure when we look forward to early next year, it's going to get harder and harder when we have sort of credit bills coming through, credit card bills, and then also looking at mortgage rates rising for many consumers, and that's going to be much tougher. But yeah, the strikes couldn't have come at a worse time for retail and for hospitality. Bookings down, footfall down, I think it was around 10% at one stage last week. And that's down on the period before when we had Omicron last Christmas that put off many consumers going into retail and going into pubs and restaurants. pounds. So yeah, it's a tough time.
So are people worrying about the cost of living now, or are they saying, look, I haven't really had a good Christmas with my family for the last 3 years, I'm going to spend and then tighten the belt in January?
I think it depends on which consumer you speak to. For sure, we're not all impacted equally by this cost of living crisis, and there are those who are very wealthy and who are still spending big time, and also who are saying, Christmas is really important to me. I really want to be able to gift to all my loved ones and have a fantastic time. There are others who are saying, look, let's buy each other the essentials this year, or let's actually cut back from buying each other gifts within our families and really focus on putting lovely food on the table. So it really depends across the population, I think.
So, John, if you break it down, and we know that the UK is very reliant on house prices, and we could see, and you went through the metrics, and actually I urge everyone to go and look at John's newsletter, because it beautifully, lays out the case for a possible 30% a drop in house prices. But if the labour market holds, will we be okay?
Well, I think the labour market holding is the main thing. Now, I still think house prices are going to fall, but I don't think that's necessarily a bad thing in and of itself. Because, about a third of people have mortgages, a third of people own their houses outright, and a third rent. At the moment, we have a massive affordability problem in the UK. So house prices coming down in and of itself is not necessarily a bad thing. In terms of consumer spending, in my experience, people tend to spend as long as they have money and as long as they have jobs. The main issue here is definitely employment. I think whenever we come to the kind of January reporting season, it'll be really interesting to see how the retailers kind of come out then. But the main thing to watch out for is, are companies going to be cutting back, or is the labour market still going to be fairly tight next year?
But the labour market is so tight.
Yeah,
what kind of recession would we have to see for the labor, for unemployment to go significantly up from here?
Well, it would have to be pretty drastic, you would think. But the other reason that the labour market is tight is because we've got a lot of people in long-term sick. We've got a lot of people who have retired and stepped out of the market. We actually have a lot of students as well. So one of the tricky things at the moment is it's really hard to unpack how much of this is a hangover from COVID. I don't think we appreciate how much the pandemic is still basically mucking up the figures. So it's very hard to get a lot of clarity on what might happen going forward.
Yeah, that's the point of central banks in saying, like, look, it was muddled, and this is why we got the temporary inflation call very wrong. Katie, how are people spending differently? So I know you were saying, a lot of buyers are trying to trade down, but also go into things that are energy efficient, like air fryers, and I think energy efficient, what you were saying, like dryers.
Yeah, absolutely. So we saw Currys report, I think it was last week, and they were saying that they are seeing consumers sort of try to trade up to more energy efficient items. So that is air fryers that have done really well. It is tumble dryers and washing machines that are more energy efficient, because people, they're not maybe as worried about the upfront spend as they're worried about their energy bills over time. So they're really prioritizing in that way. We've talked a bit before about electric blankets, other ways we're trying to keep warm when bills are so high on our energy costs.
So are people overall, could we see them buying less, or just, buying as much but cheaper?
When it comes to food shops, we've seen people try and put fewer items in their baskets, try and stretch meals further across a family. We've heard of examples of people having to skip meals within the family. At Tesco's, for example, earlier this year, shoppers were saying, can you stop at £40? Can you stop at a certain spend, because I can't go beyond?
Yeah, and if you look at some of the inflation figures, we're looking at the price of egg, milk. In certain cases, it's like up 15, 20%. Are we going to see peak inflation in 2023?
You would hope so. Apart from anything else, arithmetically, it's kind of got to peak. We probably saw it just there, actually, back in November. Energy prices, this is the other thing that comes down to how much of this cost of living squeeze is going to continue. Yeah. If energy prices come back and food prices stop rising, then you might actually find that next year we get real wages increasing. And that would be really positive. That would be a kind of upside surprise. But again, that all boils down to how tight the labour market remains. The good thing about this the problem that employers have had with hiring over the past couple of years means that even if they take a hit, they're much more likely to try and hoard labour in the coming year, because it was so hard to get the workers in the first place.
John, how much of this has to do with Brexit? So we have, the British Chamber of Commerce saying, first of all, UK businesses are suffering because of exports. And then we had also this think tank yesterday saying it's shaving off 5.5%, I think, of like GDP growth. And that's, of course, also, importing inflation. And that's because we have the strikes.
Yeah, I mean, look, I'll be honest with you. I don't see Brexit as being a massive issue economically. It's certainly not the major factor that's driving all this. One of the problems with think tank reports is that obviously a lot of them have a kind of political bias one way or the other. And it's just very hard to unwrap all this stuff. I mean, if you're telling me that you can seriously split out the impact of Brexit from a global pandemic in which we actually shut down the entire economy, then I'm sorry, I'm going to struggle to believe you. You know, the inflation came as a surprise to the vast majority of kind of economists and analysts around the world. So I don't believe that you can split the difference with Brexit down to 0.5%.
All right, really interesting. Thank you both for joining us. Our UK retail reporter there, Katie Lindsell, and Bloomberg's John Stepek stays with us. Also coming up on Bloomberg UK this week, we hear from the chief executive of London's iconic department store, Fortnum & Mason, on how the luxury retailer is doing this festive period. This is Bloomberg.
Everybody want to be a consultant, and what are all these consultants doing?
Well, David, I think that we actually defy the label consultant, because sometimes consultant seems to imply that we only give advice. And when you look at what Accenture does, we're really different than the traditional version of a consultant. We're really about relevance and results, and that's what is driving our business.
What about a consulting project? In my example, I'm the CEO, I have a problem, I call you up, I say, solve my problem or give me a solution.
We don't operate as big companies permanently in crisis mode. And so when you think about, like, how long does it solve things, a lot of it starts with, you know, the company being willing to set aggressive goals. And so what we are trying to do now is work with our clients to work differently and to work faster.
The difference between missed opportunity and actionable intelligence. For in-house attorneys who strive to provide superior counsel and strategic advice, Bloomberg Law offers an unmatched platform of analytics tools and business intelligence. All to help improve productivity, mitigate risk, and inform decision-making. For the comprehensive platform that helps you work smarter and faster, the difference is Bloomberg Law.
Economics, finance, politics. This is Bloomberg UK. I'm Francine Lacqua here in London. Now, Brexit has damaged the ability of UK companies to compete in the EU. That's the finding of a survey from the British Chamber of Commerce. 77% of firms said the Brexit deal struck 2 years ago was not helping them increase sales or expand their businesses. Now, British department store Fortnum & Mason has also seen its European sales hit by Brexit disruptions. The upmarket brand, which is best known for inventing the Scotch egg, as well as special blends of teas, biscuits, and Christmas hampers, is now looking beyond the UK and the European Union for its future growth. Well, we are delighted to bring some festive cheer, and we're joined by Tom Athearn. He's the Chief Executive Officer of Fortnum & Mason. Tom, thank you for joining us. I mean, it is really Christmas when you look at a Fortnum background, what has been the most surprising thing for you? So we're going through a huge cost of living crisis in the UK. There are strikes in central London. Are people still shopping more than you thought they would?
So, morning, Francine. It's lovely to be here. It is, without doubt, it's a tough trading environment. You know, with the war in Ukraine, inflation running at more than 10%, the backdrop of strikes, as you've mentioned, it's a tough environment. Businesses and consumers don't like uncertainty, particularly at this time of year. I think what surprised me most about Christmas this year is actually the return of footfall into our shops that we've seen. Against that backdrop, I think I've been really surprised about that. And I think to a certain extent what customers are looking for is that sort of moment of joy. I think they've rediscovered the enjoyment of shopping in person. And I think Fortnum & Mason really lends itself to that. You can't help but walk into this shop and for a smile to creep across your face. And I hope you can see in the background that, you know, when we open our doors, our customers come into the shop like a bullet out of a gun. So that's really good to see. I think the other thing that's probably surprised me is the strength of our international trade. I suspect a lot of that is down to the weakness of sterling, or the relative weakness of sterling compared to last year. Don't forget, this time last year we were up against some really a really tough background. We were still emerging from COVID. We had the latest wave, which I think was putting people off going out shopping and eating at restaurants. And I think that this year we're sort of through that. Our restaurants are full. We have a lot of events going on every night, so it's the return of Christmas parties. In many ways, it's the sort of it's the revival of Christmas that we saw pre-pandemic back in 2018, 2019.
And Tom, we're just getting, of course, breaking news from China, which is huge news, and a lot of the markets will kind of listen to this and take pause. China is to cut its quarantine for overseas travelers from next month. That would probably impact, of course, also your news story in Hong Kong International Airport for global travel, and of course the resumption of back to business in this post-COVID world. That's probably positive business. I can't remember. I remember seeing that I think you make about 60% of your revenue in this kind of festive season. How much will that change, or how much have you tried to change that and also be less reliant on the UK because of weaker pound and because of the strikes?
Well, it's interesting. I think historically we are a very Christmas-focused business. I think that's absolutely right. One of our opportunities is to think about how we can become more relevant to more people more often. And I think that there's a big opportunity in the UK for that. Our online business is now anywhere between 30 and 40% of our business. And if I go back to a world pre-pandemic, that was more like 5 or 10%. And I think what we're doing is using our online business as a way of attracting a whole bunch of new UK customers, actually, to a business a business which really has one flagship shop and a number of satellite shops in London. So it's opening up the brands to parts of the UK that don't necessarily have access to our business every day. So I think our online business is a big opportunity for growth. Before I even get to thinking about growth overseas, it's wonderful to see those restrictions beginning to be lifted in Hong Kong. We have a shop and a restaurant in Hong Kong, in Kowloon, which historically has served Chinese tourists from over the border. As you can imagine, that's been very quiet for the last couple of years, but I'm hoping that over the next few years we see a real resurgence in that. And I think a demonstration of our commitment to that region is, as you say, the opening of our shop at Hong Kong Airport last month. So I'm expecting big things from our Hong Kong team over the course of the next few years.
Yeah. So who's shopping in your stores at the moment in London? Is it a lot of people from the US? Is it tourists? Is it you know, British consumers? And have they adapted the way they shop?
So they certainly have. I mean, I certainly think they've adapted the way they shop in relation to returning into shops, as I mentioned earlier. I think that we're also seeing a big international trade this year, probably certainly more so than we saw last year, and indeed pre-pandemic as well. And in particular, those customers are coming from the EU, where we're no longer able to ship directly to the EU, and from America as well. So we're delighted to welcome those international customers into the UK. And of course, they're buying across the range. Not only are they shopping in our shops, they're eating in our restaurants, they're coming for afternoon tea. I'm thrilled to say that our hospitality business is doing really well. And as I said, I think people are looking for a bit of togetherness this Christmas, and there's nothing that brings people together, certainly at this time of year, more than food.
What's your most sold out product? I mean, I'm here with John Stepek, who's probably going to tell me he goes to, Fortnum & Mason for Christmas tea every day. But is there one thing that actually just flies off the shelves that you can't get enough of, Tom?
I think probably the one thing this year, and again, that's really surprised me, is that we've sold out completely of pickled Brussels sprouts. They were $9.95. They've all gone. There are still a few jars or a few bottles left of mince pie and marmalade liqueur, which is absolutely delicious. It's like a mince pie in a glass. It's really good, £35. So they're the two things I would that really jump out at me as being fantastic products this year. And actually, I mean, you mentioned the Scotch egg. We invented the Scotch egg in 1738. It's a really good example of the sort of innovation, actually, you can get from Fortnum & Mason, which is, I think, really the home of extraordinary food and drink.
Tom, thank you so much. Sponsored by Fortnum & Mason. I'm not sure about the pickled. I mean, we need to get that. I need to go online, take it in, have a think, and then get back to you. Tom Atherin, they're the Chief Executive Officer of Fortnum & Mason. Coming up, what were the UK's biggest moments of 2022, apart from Scotch egg and pickle things? Well, we, of course, look through the list of the record-breaking years that we've had so far. This is Bloomberg.
China's military power has been growing at an incredible speed over the last 20 years.
A strong country must have a strong military, as only then can it guarantee the security of the nation.
In terms of sphere of influence, we absolutely know that China wants to be dominant in Asia. So there is a target to get to that point, to be a military that is a peer to the greatest militaries in the world by 2035.
The competition for influence is a global one. And through a multi-decade trajectory fueled by planning, money, and pragmatism, China is building a military that allows it to shape the 21st century just as the U.S. shaped the 20th.
How did Jeff Bezos realize you could sell anything on the internet?
The web was growing at something like 2,300% a year. Anything growing that fast is gonna be big.
Why did Bill Gates create Control-Alt-Delete?
Kind of become the poster child of, hey, couldn't you have made this stuff a little simpler?
And what inspired Diane von Furstenberg to create the wrap dress?
The wrap dress created me.
On the David Rubenstein Show, I uncover the untold stories of the world's most successful leaders, right here on Bloomberg.
Economics, finance, politics. This is Bloomberg UK. I'm Francine Lacqua here in London. Now, from Queen Elizabeth's death to a scorching summer heat wave, it's been a record-breaking year for the UK. Here's Bloomberg's Irina Angel and Celia Bergen counting down to some of the country's biggest moments in 2022.
What a year for the UK. Record after record broken. And new ones being set. Students of the future, you're going to have loads to revise one day when it comes to 2022. Well, we've actually lived through it. So here's a quick recap of the last 12 months. Let's begin with the most somber moment, the passing of Queen Elizabeth II in September. 7 decades on the throne, Britain's longest-serving monarch, 15 prime ministers, and, of course, the queue.
From the longest reign to the shortest run, Liz Truss was Prime Minister for just 49 days. Still, she managed to sink gilt markets and send the pound to a historic low. Now, the government is cutting spending and raising taxes.
Next, prices. Everything going up, 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 and fast. Take an English breakfast. Butter, £3.30, up from £2.60 last year. Eggs, £2.40 from 2. Bread, up 18%, let alone the gas to cook it. Today, inflation is at a 40-year high. That's the worst since the first Indiana Jones film. Want more records? Well, how about record heat? In July, temperatures topped 40 degrees for the first time. Train tracks buckled, fires broke out across London, and all the while, England was experiencing its worst drought in years.
Let's not forget the reasons to cheer. The Lionesses won the Euros, the first English Cup in 56 years. They got to do it here, at Wembley, with 87,000 fans. The most for a UK women's game ever.
Climate, politics, royals, sport, nothing was spared this year. So what's in store for 2023?
If 2022 showed us anything, we'll just have to wait and see.
Bloomberg's Serena Angel and Celia Bergen there on the UK's big year. Now, we're joined again by Bloomberg UK's John Stepek. John, I mean, on the markets, it was also a crazy year. What was the most memorable day or week for you?
I mean, it had to be the gilts meltdown in September.
Was something else.
Yeah, that was one of the most striking moments I've seen since 2008, because the speed at which that unravelled was actually slightly scary. But also, what I found really interesting about that is that unpacking what actually happened is still quite tricky. Yeah. It's very easy to kind of point to the Truss government and Kwarteng, and that definitely was the match that kind of ignited the bonfire. But I think that whenever we look back on this, the fact that the defined benefit pension schemes were so heavily into these LDI, liability-driven investment funds, which again was the product of the low interest rate environment and also regulations. It'll be interesting to see how that eventually gets unpacked.
But John, so if you think about the markets, and this is something that I've been thinking quite a lot, it's pretty incredible that actually when you see at how many companies were leveraged, parts of the market that were leveraged, that you can go from 0.5% interest rates to over 3 so quickly without it having a huge fallout.
Well, I think the most interesting thing there is that since 2008, and this is one kind of weird kind of benefit of the fact that the UK was sort of at the centre of that crash. Like, consumers have deleveraged to an extent, and corporates have deleveraged to an extent. I think the riskiest areas are probably within the kind of private assets low. Because a lot of money is kind of like basically vanished from the public markets and actually in a weird way from the banking system. And then some of this kind of leverage has gone elsewhere. And there's probably a lot of privately owned assets out there that have got, a price tag that says one thing, it's actually probably a lot lower than it really is.
So maybe that's a story for 2023.
I think so.
John, thank you so much. John Stepek there from Bloomberg Wealth. You can read more, of course, from John in the Bloomberg UK newsletter, daily newsletter, Money Distilled. And be sure also to subscribe to Bloomberg's In the City podcast. That's out today. This is Bloomberg.
You've been an advisor to the President of the United States on infrastructure and manufacturing, but on infrastructure, you've been involved with the legislation that was passed not long ago. Why is the United States infrastructure so terrible compared to so many other wealthy countries?
I have been around U.S. politics like you for a couple of decades and have served a variety of presidents from the different parties. And the attitude in the United States is obviously to keep taxes low and keep the public spend under control. And the word control is interesting, but that stops forward thinking in terms of planning, and therefore the short-termism around our fiscal policies has hurt us. I mean, in essence, infrastructure is a long-term return, and to get a long-term return, putting it into private hands is one way of doing it, but really the public side of life has to be willing to do the forward spend. The forward spend on airports and roads and EV charging stations has to come from the public domain. Now, raising taxes to spend money on infrastructure means you've got to trust the people doing the spending. And I think the public-private model is the way to go there, which is actually create an infrastructure bank that is U.S. public sector owned that has private sector matching funds. I think that sort of breakthrough has yet to occur in the United States. So where we go is tax and spend, which unfortunately one side of the aisle disagrees with.
The top names in business are on Bloomberg.
I think you have to assume that we have some bumpy times ahead, and you have to be a little bit more cautious with your financial resources, with your sizing and the footprint of the organization.
So what can you do near term? Test to make sure you see at the margin you can move things around, manage your expenses very carefully and invest in efficiency and effectiveness, but also continue to spend money where you have competitive advantage.
Nobody covers business like Bloomberg, your global business authority.
Against all odds and doom and gloom scenarios, Ukraine didn't fall. Ukraine is alive and kicking.
And the United States is committed to ensuring that the brave Ukrainian people can continue to defend their country against Russian aggression as long as it takes.
If they attack us with Iranian drones and our people will have to go to bomb shelters on Christmas Eve, Ukrainians will still sit down at the holiday table and cheer up each other. All of us, millions of Ukrainians, wish the same: victory. Only victory.
This is Bloomberg Surveillance, Early Edition, with Anna Edwards, Matt Miller, and Kaylee Lines.
It is 5 a.m. in New York, 10 a.m. in London, 6 p.m. in Hong Kong. Our top stories today: unwavering support. President Biden pledges to back Ukraine for, quote, as long as it takes, as President Zelensky presses Congress for more tanks, planes, and cash to defend against Russia. Facing the Fed, Sam Bankman-Fried lands in New York to face criminal charges, while two of his top associates plead guilty to fraud in connection with the collapse of FTX. And Micron posts a lackluster revenue outlook for the current period, indicating the slump in demand for computer components will persist. Welcome to Bloomberg Surveillance. This is the early edition. I'm Matt Miller here in New York. Ed Ludlow with us out of London. Anna Edwards and Kaylee Lines are off today. Ed, we had quite a rally in risk assets yesterday. How are we set up from Asia and Europe for today?
Yeah, it's interesting. More energy in markets. We're limping a little towards the weekend amid low volumes, but we certainly saw momentum carry over from the US into Asia. The MSCI Asia Pacific Index closing up 1.2%, snapping 5 consecutive days of declines. A lot of that energy as well and focus on China. The Hang Seng, the real outperformer in the region, closing up 2.7%. It's all about reopening, really. You look at some of the outperformers within that index. It is those most tied to an economic reopening, retail, consumer-focused stocks, technology also doing well. The story of the week has been the BOJ in Japan, that surprise hawkish policy pivot earlier in the week, although they're not formally calling it that. You look at the 10-year Japanese bond, pulling the yield back towards almost 4% from that upper limit that was set Tuesday at 50 basis points, or at 0.4%. And then the yen, which kind of took a time out on Wednesday, now also continuing to strengthen somewhat against the US dollar. Europe, okay, there's some modest gains. We bring up the picture across continental and Western Europe, major indices largely in the green, but modest gains, very low volumes. We're very close to Christmas, as you know, Matt. And you look particularly at the stocks Europe 600, yeah, we're higher, a few tenths of 1%. There is a drag on the index, though, which is some of the European semiconductor names, in particular ASML, ASMI, or AMI, because, well, it's not just about Micron reducing headcount, it's not just about that tepid forecast on revenue, but they're also going to be cutting CapEx, which is hitting some of those names. And we're kind of chilling out, Matt, on the bond market. Yields kind of holding steady and not so much drama like we had on Tuesday when you, Matt, was still on vacation.
Yeah, I am still on vacation. I'm just taking a 2-day break from my trip. We're kind of chilling out in terms of futures today as well. Maybe that you could have guessed that, considering the big rally that we had yesterday, but no movement on S&P futures. The U.S. 10-year yield coming down about 2.5 basis points. Right now, 363.78 is the level on the 10-year, and NYMEX crude trading at about $80 a barrel, 79.44 for West Texas Intermediate. This commodity has been all over the place since the beginning of November, when we were up at $90, to a couple of weeks ago when we were down at 70. A lot of volatility here that cannot be said for Bitcoin, maybe surprisingly enough. Since the collapse on November 7th of FTX and the drop in crypto prices, we've really seen Bitcoin holding in a very steady range, around $16,000, occasionally breaking up above 17, but really holding around $16,853, which is where we see it right now. So that's what we see in terms of the market setup. Let's get to our top stories and really back to the geopolitical situation, because there was an historic moment in the U.S. Congress yesterday. Ukrainian President Volodymyr Zelensky giving a speech pressing Washington for tanks, for planes, along with tougher sanctions on Russia. He says support is, quote, an investment in global security.
From the United States to China, from Europe to Latin America, and from Africa to Australia, the world is too interconnected and interdependent to allow someone to stay aside and at the same time to feel safe when such a battle continues.
Let's bring in Bloomberg's Bruce Einhorn to tell us what the main takeaways were. And, you know, I guess, Bruce, my thought is there are some Republicans already pressing to curtail support for Ukraine, even as President Biden commits to supporting them as long as it takes. Did Zelensky's speech sway those Republicans yesterday?
I'm not sure that it's going to sway some of those Republicans. There's some Republicans who didn't show up to the speech. There were others who were there who would applaud tepidly or maybe look at their phones. They're the minority, to be sure. There was strong bipartisan support for the Ukrainian president. The speech was in many ways targeted at ordinary Americans, trying to shore up support for Ukraine. The big concern, of course, is that Republicans take over the House in just a few days, and some Republicans have said that the U.S. needs to rethink its support for Ukraine, or at least scale back some of its support. Kevin McCarthy, the Republican leader, who's hoping to be Speaker, has talked about how the U.S. will not just be providing a blank check to Ukraine going forward. So in his speech, President Zelensky talked about how crucial U.S. support was for Ukraine. He also made a point of saying that U.S. support is not charity, that this is an investment in global security. He also talked about the need for more aid, more fighter jets, more tanks, other types of military assistance.
Bruce, President Zelensky, you know, clearly the speech symbolic. He drew laughs at times. He drew support from those that were gathered. But he went for a reason, right? A list of physical things that he wanted, and also, you know, the sort of public support of the president. What sense did we get from President Biden about how much of that Zelensky is actually going to get?
Well, in the short term, it seems that he is going to get a lot of what he wants. President Biden announced during this visit that the U.S. will be providing another tranche of aid worth about $1.85 billion. That includes Patriot air defense systems. This is the first time that the U.S. is going to be giving the Patriots to Ukraine, in addition to lots of other weaponry. Congress is supposed to be voting sometime in the next few days on a big omnibus spending bill that would include $45 billion worth of additional aid to Ukraine. It's still unclear just whether that's going to pass or not. If it does, then that takes care of a lot of the concerns, at least for a while going into the new year. However, this is a war that's not going to be ending anytime soon, and Ukraine is going to need continued U.S. support. And so there is reason to be concerned about just where things would go going forward once Republicans control half of Congress.
Bruce, thanks very much for joining us. Bruce Einhorn there talking to us about the historic speech by Ukrainian President Zelensky to the U.S. Congress yesterday. Now let's get to crypto. Sam Bankman-Fried has landed in the U.S. to face a litany of criminal charges tied to his role in the collapse of FTX. This comes as two of his top associates, Caroline Ellison and Gary Wang, plead guilty to fraud and cooperate with prosecutors. Joining us now is Bloomberg's crypto senior editor, Ana Herrera. Ana, so this was a big bombshell overnight, right? We've got two of SBF's top lieutenants essentially cutting a plea deal or hoping for a bargain in exchange for giving evidence on him.
Yeah, so we know prosecutors have said they will recommend a lower sentence if Wang and Ellison collaborate. We also now know that the SEC and the CFTC have also amended sort of their lawsuits to include Wang and Ellison. We have a little bit more detail about what was going on behind the scenes, which was essentially that when Terra collapsed, this is just part of everything that happened, but a big part was when Terra collapsed, Alameda sort of started getting margin calls from its lenders. It couldn't meet them, and so they had to borrow money and essentially get money from FTX customers.
Anna, I know there's a lot to go through in terms of the process. What was interesting in the Bloomberg reporting was some of the detail about the things that Ellison and Wang did themselves, which the SEC and others claim was at Sam Bankman-Fried's direction. You know, what is it the prosecutors are going to have to do from here? What's the process?
I think what's interesting is they've also said that their patience isn't unlimited, and if you've worked with them before, or you were also an executive and you know things, you know, now's the time to come forward. So it's interesting to also see if we'll have more information even still that will come out, if more executives that haven't been mentioned yet will come forward and collaborate with authorities, or if others will be charged. That remains one of the big things to be seen.
All right, Bloomberg's crypto senior editor, Ana Herrera, thanks for joining us. There's almost certainly going to be a top story, Matt, for the rest of this holiday period. Turning now, though, to Micron. 24 hours ago, I had a hunch that this would be a big story. The biggest US memory chip maker says it will cut headcount by about 10% in the coming year as it projects a wider than expected loss for the current quarter. Micron's loss comes amid a slump in demand for computer components. And joining us to discuss is Bloomberg's Joe Easton. The headline's kind of the cut in headcount, reduction in workforce, but there was quite a long list of worse than expected news and CapEx. You look at some of the European market reaction, top of mind as well.
Yeah, exactly. So Micron really spoiling the festive spirit for the tech sector. But I think if you look at the root causes of it, it's really interesting. So I think the tech sector chips, specifically memory chips, have probably been oversupplied for around 18 months, really. But then you kind of had all these supply chain issues, which meant that the inventory wasn't able to be shipped. And that really artificially kept prices high. Then that supply chain disruption eased at the same time that we've seen demand coming off now, with companies predicting lower smartphone sales, lower computer sales, and a whole consumer downturn. And those have combined together and resulted in this really negative report from Micron.
So it's crazy that, you know, last year we were all concerned about there not enough chips to make the products we want. Now, at least on the PC side, we see a glut. Is that the sort of bifurcation here? Is that the difference, that these are for PCs and not for cars?
Yeah, exactly. I think that's the main thing. As you mentioned, we were always talking about how car makers couldn't get their hands on enough chips, and now, you know, that's completely gone, and the story has moved over to the personal devices. And I think that Micron will have a big impact on the industry, given they're such a big supplier, with that 10% reduction, with the reduction in CapEx spending that Ed mentioned. But it won't really be enough to change the supply dynamic unless other companies follow suit. And you'd be looking at companies like Samsung and the really other big firms around the world, not just in the US, to do the similar thing. And that would really adjust that supply situation further. But we could be a way off that happening now, I think.
All right, Joe, thanks very much. Bloomberg's Joe Easton there. We're going to have more on this Micron story and what's going on with the entire chip industry later on in the program. William DeGale, lead portfolio manager for technology at Blue Box Asset Management, will join us. First off, though, I want to take a look at some of the other stocks moving in the pre-market. Of course, Micron is down in early trading today. We see Tesla actually rising this morning. It's offering U.S. consumers $7,500 to take delivery of one of its two cheapest models, the Model 3 or the Model Y, before year end. It's a move likely to foment more debate over the extent of the car makers' struggle with demand, and also brings into question what the U.S. government is going to require in order to give consumers a tax credit for electric cars. Carnival gaining after reporting a narrower than expected quarterly loss per share yesterday. Its CEO, Josh Weinstein, said booking momentum has continued into December. Well, here you see the shares slipping now down a little bit, about 0.25%. Not a lot of volume, as Ed pointed out, ahead of this holiday, ahead of Christmas. Oric Pharmaceuticals shares are surging this morning after the company entered into a clinical development collaboration with Pfizer and agreed to sell 5.4 million of its common shares at a price of $4.65 apiece to Pfizer for proceeds of approximately $25 million. It's a small stock, but you can see it's up almost 50% in the pre-market. Ed?
All right, coming up, Nina Skero, CEO of the Center for Economic and Business Research. Lots on central banks, I'm sure. And German Finance Minister Christian Lindner is betting on Germany's economy. Check out our full exclusive interview online or on the Bloomberg terminal.
I have to ask you this question very briefly, yes or no. What's going to recover faster, the German economy or the German national team? Because the World Cup was not good for you.
The economy.
The economy, wow, that's a strong bet, because you have 2 years until the Euro Cup, and you host it right here in this country.
Economy will recover faster.
Steve's ability on the course may not be etched into any record books, but following him around, it's clear that it's not for lack of trying.
Jeez.
We were constantly hustling behind him as he caught up with executives in the portfolio companies and reminisced with former and current players.
He's a day trader. He taught himself, self-made day trader.
Yeah.
And so he's on the bus after a game in New England, and he's day trading on the bus, and Bill Belichick sees him and cuts him on the spot.
You know, in many ways, it's a convention, right, of the people that I don't see maybe once a year. And so it's kind of all come together. My firm, our charity, fundraising efforts, and then the friends that are around. My dad and my brother, it all happens right there as a confluence of all these parts of my life that have found its common center.
It is now 135 or something, right? 32 or something. And it will probably slowly, appreciate toward 120. I think it will hold around 120 for some time.
That was Mr. Yen, his real name, Isuki Sakakibara. He sees the yen strengthening to 120 per dollar and expects the Bank of Japan to surprise markets again by tightening monetary policy as soon as next month. The BOJ's recent moves have been some of 2022's most memorable market moments. Our markets reporter, Valerie Teitel, is here to recap. So, Valerie, what will history remember from this year?
The BOJ definitely gave us a lot of them. My favorite one was their October intervention where they shoved dollar yen down 6 handles in a matter of 45 minutes. Turns out they spent near $40 billion doing that. It was Friday, 3:30. I was at the gym. I nearly fell off the treadmill. That was a big one for me. I don't think I'll forget that soon. The other memorable moment was that week in June where we had a bomb dropped by almost every central bank. Powell had to leak in the Wall Street Journal that they were going to go 75 instead of 50. The ECB had to pull that TPI tool out of the bag to save BTPs. The SMB hiked 50 instead of 25. And the Bank of England, Bailey, came out saying they were going to act forcefully against inflation. It all happened in a matter of 5 days, and it also coincided with the S&P bottoming on that June 16 date. But look, this year is really one for the history books. I'm still out there on the acronym that it appropriately fit this year, because I can say confidently, in my lifetime, I don't think I'll ever see central banks hike this quickly, this fast. Nearly every central bank hiked over 250 basis points this year, the one outlier being obviously the Bank of Japan, but they might not be far behind.
So, if you look at this tightening cycle as once in a generation, Valerie, we had something similar for the previous generation or 2 or 3 ago. Obviously, the Volcker tightening cycle is probably still the most infamous in U.S. history. How do you compare the two?
Look, I still think that's yet to be written because we don't actually know the recession we're headed into, the growth slowdown we're headed into. Is history going to look back on this kindly, saying they did the right thing? Or are we going to have a massive hard landing in the U.S. and we might be, scratching our head thinking Powell acted too fast too soon? It was only a year ago, Matt, that we thought the Fed hiking 50 basis points was a big deal, let alone 4 75 basis point hikes in a row with a near 425 cumulative tightening coming from the Fed. We still have yet to see what the effects for this going to be, and I cannot wait for 2023.
Okay, our markets oracle, Valerie Teitel. By the way, guys, my 2022 is very different now in San Francisco. You guys don't remember the Meta crash February. You don't remember the retailers anyway. We'll get into it another time. For more market analysis, you can, of course, check out MLive Go on your Bloomberg terminal. This is Bloomberg.
While Teslas and the like make for good headlines, the reality is that even if every car on the roads today went electric, it wouldn't be enough to curb global emissions to avoid catastrophic climate change. Greenhouse gas emissions from transportation account for about 29% of total U.S. greenhouse gas emissions. So what about the other 71%?
Buildings across America burn fossil fuels to operate. What we want to do is make that all electric. Instead of burning oil and gas to give us the energy and electricity we need, we want to do 100% clean energy, all electric. We want to turn buildings into Teslas. Just like a Tesla or an electric vehicle is all electric with no fossil fuels, we want to do that with our buildings. And if we can do it in one building, we can do it in all buildings. And if we do it in all buildings, we'll reduce 30% of U.S. greenhouse gas emissions.
In a multi-trillion-dollar industry, there's a lot of ground to cover.
Commodities got absolutely crushed.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg. A lot's happening on Wall Street.
I'm quite encouraged. The center is holding.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
A lot of these areas still have very, very good valuations.
From businesses most influential and instrumental.
It's knocking it out of the ballpark.
Now's not a great time to be speculative. It's time for a pivot.
We're talking about a significant hit to our standard of living.
Bloomberg Wall Street Week, live Friday with replays all weekend on Bloomberg Television and Radio.
This is Bloomberg Surveillance Early Edition. I'm Ed Ludlow in London with my good friend, Matt Miller, in New York. Now, keeping you up to date with news from around the world, here's the first word. Hospitals in Shanghai are struggling to cope with the number of COVID patients, with many pharmacies turning customers away. Months after the city of 25 million endured a brutal lockdown to stop the virus spreading, COVID is making its way virtually unchecked through its population. Most of Shanghai's schools are now closed and public transport usage is plummeting. BHP has made a binding offer to acquire Australian copper producer Oz Minerals for $6.4 billion. The deal is set to consolidate BHP's position as one of the world's largest producers of copper, a metal, of course, used in the clean energy transition. BHP says the bid will now go to shareholders for approval by early April. And H&M has halted sales of its Justin Bieber collection after the singer accused the company of selling clothes depicting him without his consent. The Swedish retailer says it followed all the proper approval procedures, but is pulling the goods, quote, out of respect. In other Bieber news, the singer is said to be near a deal to sell his music rights to an investment entity backed by Blackstone. Bloomberg understands Bieber's stake could fetch around $200 million. And in London, pubs and restaurants say last week's rail strikes cut their sales to almost half pre-pandemic levels. Trade group UK Hospitality says revenue was down 46% compared to the same week in 2019. Industrial action is sweeping the UK with walkouts by workers in the Royal Mail, health sector, airports and various parts of the civil service, as well as those by rail and bus staff. More transport disruption is expected over Christmas and into New Year, Matt. It's been a difficult political story this week in the UK, a difficult economic story at a time where the country faces budget issues, but also many of these workers are those that were hardest hit during a tough 2 years with the pandemic.
Right. Well, I mean, I've lived in the UK and I endured many rail strikes. They seem fairly commonplace, but the healthcare strikes to me are shocking because a year ago you were all applauding these healthcare workers. That didn't keep them warm or feed them, and now they're asking for a raise, but I guess no can do. Are there people who think healthcare workers are overpaid?
Well, one UK minister accused the ambulance union just 24 hours ago of deliberately putting people at harm. So, you know, it's a tough one.
Wow. All right, very interesting. We'll continue bringing you the top headlines. Nina Scarrow joins us next, CEO of the Center for Economic and Business Research, to talk rates. This is Bloomberg.
BP DHL is sending a consistent message with its investments. The company spent 123 million euros to upgrade its logistics centre at the Cologne Bonn airport, designing it around key strategic goals.
What I love about this building is it actually shows the big mega trends which formed our strategy 2025, which was inaugurated in 2019 when this building opened. So globalization, connecting the world. E-commerce, we have a lot of sortation facilities here for smaller e-commerce shipments. Sustainability, it's a very sustainable building with solar panels on the roof and everything. And digitalization, and well, you can obviously see that it is quite automated.
How did the team pitch this investment to you initially, and how hard was it as a sell for them? How quickly did you turn around and say, yes, this is worth the 123 million euros?
Of course, you always have to make sure that you have the right capacity for the growth in the network. And at that time, they came and said, hey, we will really see a strong growth in e-commerce volumes on top of the regular B2B growth. We need more sorting capacity. We need this building. And of course, there are always debates. Does it really have to cost 123 million euros and so on? But fortunately, they convinced us, because then with COVID and the volume surge, we urgently needed the capacity.
This is Bloomberg Surveillance Early Edition. Here's what you need to know. Unwavering support. President Biden pledges to back Ukraine for as long as it takes, as President Zelensky presses Congress for more tanks, planes, and cash to defend against Russia. And facing the Fed, Sam Bankman-Fried lands in New York to face criminal charges, while two of his top associates plead guilty to fraud in connection with the collapse of FTX. Plus, Micron posts a lackluster revenue outlook for the current period, indicating the slump in demand for computer components will persist into 2023. I'm Matt Miller in New York with Ed Ludlow in London. Anna Edwards and Kaylee Lyons are off today. And Ed, it was a big rally yesterday for risk assets. Today, there's not a heck of a lot going on in terms of U.S. futures. We're looking at a drop of about 0.1% to 39.02 on futures. You know, a week ago, we were up above 4,000, so we've come down considerably from there. But we do have investors buying the 10-year bond. That pushes yields down now 2 basis points to 364. They're also buying NYMEX crude. That pushes oil, at least West Texas Intermediate, up to almost $80 a barrel at 79.60. It's been a very volatile month for oil, up to almost 90, down to about 70. It hasn't been that volatile for Bitcoin. Since the November 7th collapse of FTX, Bitcoin dropped to about $16,000 and has held there. It's gone down below that and up above 17, but basically hanging around this level for over a month now, a month and a half. 16,838 is the level there. As we continue to get news on FTX, it doesn't seem to impact the underlying, well, the OG of the cryptocurrencies, at least. We've got a lot of pre-market movers today. One is Tesla. Those shares actually gaining about 0.5% as news comes out that U.S. consumers are going to get $7,500 off of either the Model 3 or the Model Y. I guess you could have $7,500 off both if you order them both, as long as it's before year end. You only have a few days. December 31st is when this deal supposedly runs out. It's likely to cause more debate over the extent of the car makers' trouble with demand and put pressure on U.S. authorities to give us details about what we're going to need to get a $7,500 tax rebate, which is a separate rebate for electric cars. By the way, cruises, Carnival is down about 1/3 even though Carnival reported a narrower than expected quarterly loss per share yesterday. The CEO, Josh Weinstein, said booking momentum has continued into December. Nonetheless, at least in the pre-market, those shares are off. Oric Pharmaceuticals, if you've never heard of it, well, you're paying attention now because it's up almost 50% on the session in the pre-market after the company entered into a clinical development collaboration with Pfizer. It agreed to sell Pfizer 5.4 million of its common shares at $4.65 apiece. You can see it's trading at $4.39 right now for proceeds of approximately $25 million in total. So not a huge stock, nonetheless getting a big boost here in the U.S. pre-market. Ed, what do you see in Europe? What are the open markets telling us about this session?
We've had a bit of a change of direction in the last few minutes, actually. You can see now that the Stoxx Europe 600 basically flat, having been higher, consumer discretionary, a little lower, acting as a drag, but actually tech, the biggest laggard in terms of the sectors. You look at semiconductors in particular. This is a basket of the 4 main European semiconductors, including ASML, down by a percentage point. Probably because of Micron's warning about cutting capex. Those names in Europe are particularly focused on chip-making equipment, and if Micron's cutting capex, they're unlikely going to be investing in new equipment from some of those European names. There's a little more energy in bond markets here in Europe than perhaps we had 24 hours ago, when everyone was kind of taking a time out in reaction to that hawkish tilt by the BOJ. A lot of commentary out there, Matt, on the Bloomberg terminal. I don't know if you've seen the comments from Louis de Guindos of the ECB saying actually 50 basis point increments going forward. That's likely. Of course, we've zeroed in on what's happening with the Fed. I would say there was a kind of energy and euphoria around that US consumer confidence data out of the US Wednesday, coming in at 8-month high. But looking at the bond market, I suppose we're kind of treading water, thin volumes, particularly in equity markets. It is Thursday, Friday, and then you have Christmas over the weekend. So if you're at your desk and working, watching the show, reach out, say hello to us, but I don't think many of you are right now.
Yeah, it's a very good point, Ed, and I appreciate you bringing us back to that, because the consumer confidence news really flies in the face of a lot of other stories that we're hearing, anecdotal stories about layoffs, data points that we're seeing in terms of inflation. Yes, it's coming off, but it's still incredibly high. So it begs the question, why are consumers becoming more confident? Joining us now to talk about that, as well as obviously all of the central bank news that Ed just mentioned, and the BOJ, of course, is Nina Scarro. She is CEO of the Center for Economic and Business Research. Nina, talk to us about the state of the U.S. economy first. It's obviously hugely important to global growth. Why are consumers here more confident, even as the Fed hikes into what most people expect to be a recession?
You're right that the U.S. is very likely heading into a recession, but it does seem now like that recession is going to be relatively brief and relatively shallow. So we could either see sort of a, not quite a recession, but an economic downturn, or if we see a recession, it's said to be relatively short, relatively mild. As you say, sort of there is this comparative element to how is that downturn in the U.S. going to compare to what we're seeing here in the U.K. or across Europe. There are certainly a lot more downside risks on this side of the Atlantic relating to the Ukraine situation, to energy prices, to the fact that central banks are a little bit further behind in their hiking cycle and probably have a little bit further to go. But it seems that the news out of the U.S. is we're by no means out of the woods. Things will get worse before they get better, but there is a light at the end of the tunnel.
You mentioned the UK, and we got some disappointing GDP news out of Britain today. At the same time, Ed tells us the government doesn't even have enough money to give poor healthcare workers a raise. How bad is it?
It's a difficult situation in the UK. We're definitely going to see recessionary conditions, certainly in the first half of 2023. And in fact, the UK is, of course, we're still waiting for more data, and there will be revisions to GDP data, but we're probably already in a recession, or at least on the brink of one. And you're right, there's already been so much attention on the UK's fiscal position in recent months following the mini budget. There are now new questions arising given the extent and the prevalence of strikes across healthcare, rail, mail. I mean, pretty much any sector you can name that has a union in the UK is on strike or about to go on strike. So there are new downside risks emerging and questions around, is the government going to have to reconsider what they've committed to meet those wage demands?
Let's consider some global downside risks. Talk about China. It's interesting. President Xi seems to be balancing this equation where an economic reopening will offset what appears to be very challenging circumstances with the spread of COVID-19. What's your assessment of China, not just for their own economy domestically, but the feed through to the global economy as well?
Earlier in the year, we were looking at China and saying that our guess is that after party conferences had passed, what we would see is sort of a quiet, gradual reopening. You know, given the rhetoric that they've had since the beginning of the pandemic, we weren't expecting, you know, this big blockbuster news of, okay, that approach was overly conscious, we were wrong, we're opening. But we were expecting this sort of slow, you know, quarantine is being cut, this gradual reopening, and that is exactly what we have seen. Now, what is happening at the moment is that is overlapping with quite an unfavorable health picture in China. And because China is sort of on its own health cycle, let's say, given the issues they've had around getting vaccination rates up, given rising hospital admissions, the problem is now that this economic reopening and travel reopening is overlapping with a worsening health picture, which could mean a new sort of global wave, certainly not to the extent we've seen in the past, but we could see rising cases as a result of China reopening when they're having COVID issues.
Bloomberg broke what appears to be a very important story this morning: China to cut quarantine for overseas travelers from next month, according to sources. I guess my question is how stimulating is a successful economic reopening in China for the rest of the world? I remember sitting in this chair, and how often do we say that China is the engine room of the global economy? Are we going to get back towards where that is the truth once again?
I think we are, probably not to the same extent, partially because changes that have happened over the recent years and the sort of the supply chain disruptions, some of them are going to persist, and I would say they have probably made China a little bit less important in the global landscape. But I mean, given its size in the global economy, we're looking at this transition away from China being such a focal point, taking, you know, probably still close to a decade or anything rather than anything more immediate.
Nina, let me get to the BOJ and ask you what you expect after the moves that we had, the market had been pushing for, and it looks like the dam is finally breaking. What's next?
Certainly, BOJ has been an interesting story throughout all of the year. It really sort of, you know, dancing to the beat of its own drum, I would say. I would say that I can't comment in detail on what we're expecting from the Bank of Japan, but certainly in terms of the Western central banks, we're expecting continued hiking, but that cycle coming close to an end. But in terms of what's happening in Asia, it's a very different situation and a lot harder to predict, given what we've seen in the past year.
Still, in a sense, the big outlier. Nina, thanks so much for joining us this morning. Nina Scaro there of the Center for Economic and Business Research. Coming up, we're going to talk about chip makers because Micron's results came in worse than expected. We'll discuss the future of the chip sector next and talk about the bifurcation in microchips. Do we have enough for cars, but way too many for PCs? What's the deal? We'll tell you next. This is Bloomberg.
CFOs are reshaping the C-suite. Bloomberg's chief future officer shines a spotlight on these dynamic leaders.
Today's CFO has to be much, much more than a bookkeeper.
One of the most important things is looking around the corner.
We have to let go of the traditional legacy department store.
Their impact goes far beyond the balance sheet. And on Chief Future Officer, they focus on much more than just revenues and margins.
You also have to be credible business leaders in order to really impact the business and steer the direction.
We are, like, by
technologists. We need to deeply understand the financial DNA of a company.
People just come with a playbook and say, okay, we're going to roll that. Don't do that. Think longer term.
It's an amazing time to be in this role. It's a lot more than the profit today. It's building the future of tomorrow.
Get passion, perspective, and more from the chief future officers of some of the world's most influential companies. A new episode every month, only on Bloomberg. The top names in business are on Bloomberg.
I think you have to assume that we have some bumpy times ahead, and you have to be a little bit more cautious with your financial resources, with your sizing and the footprint of the organization.
So what can you do near term? Test to make sure you see at the margin you can move things around, manage your expenses very carefully and invest in efficiency and effectiveness, but also continue to spend money where you have competitive advantage.
Nobody covers business like Bloomberg, your global business authority.
This is Bloomberg Surveillance Early Edition. I'm Ed Ludlow in London with Matt Miller, who is in New York. Now, Micron says it will cut headcount by about 10% in the coming year as it projects a wider than expected loss in the current quarter. The Micron miss comes as the chip industry battles plummeting demand, in part. Joining us now is William DeGale, lead portfolio manager for technology at Blue Box Asset Management. You invest in and cover the chip sector broadly. I don't believe you hold Micron shares. This is a company that kind of pre-warned us in November, right? They already cut production on the DRAM side. They kind of guided us that things would be worse, and then things got even worse. Why is that? What did they get wrong in the short term?
Well, I think this is actually their fourth miss of the year, so not just two, but I think four, and they've been cutting capex for a while. I'm not sure they got anything wrong, just Micron's in a very, very difficult market. You know, computer memory, whether DRAM or NAND, is essentially a commodity. There was one very, very strong player, Samsung, and if you're up against Samsung, life is extremely difficult. And also, it was a sector that saw no particular shortage, so there was no real shortage of memory that I'm aware of as a result of COVID, and now there's a slowdown in demand. Clearly, we are entering some sort of recession, generally in most developed economies, and if you have a slowdown in demand, then people don't need as much memory chip. It's a very easy thing to cut, so you can spec your computer tomorrow and just put less memory in it, and that's immediately a loss of sales for the memory maker. So it's very susceptible to economic fluctuations. It's very much consumer-facing. It's very short-term. It's a difficult business.
Right. Miller's going to want to ask some pretty granular questions about the end use cases for some of these DRAM chips and other chips. What I want to ask you, we started this year, those of us that cover the chip sector closely, being promised multiple years of expansion, that the boom and bust cycles of eras past wasn't going to play out this time, but that's exactly what's happened. So why were we wrong at the beginning of the year?
So I think you've got to realize that the semiconductor industry is not one sort of homogenous whole. It's made up of various very, very different elements. And at one end, you've got the extreme commodity, leading-edge memory market, which is an absolute nightmare to market to operate in. And the other end, you've got the trailing edge, where you have things like microcontrollers and analog and sensors being made on pretty elderly equipment, because it's actually very difficult to shrink these components. They're very sophisticated, but you can't make them on the leading-edge equipment. You make them on equipment that was, new in the 1990s. Demand for that trailing edge has been building slowly, steadily, and quietly for the last 20 years. And capacity is completely limited. No one's been building 1990s capacity since the 1990s, and it's simply run out. There's no more. All the second-hand equipment has been used up. All the old fabs are in use, and using new equipment, building greenfield for this stuff, just completely changes the economics. And so I think COVID just pushed this problem that was growing steadily right over the edge and created a really dramatic shortage, and that's still there. So there is still a serious shortage of trailing edge semiconductors, and it's going to be very difficult to fill that. So I think investors are focusing on the wrong end. They're looking at the leading edge, which is very difficult, and they should be focusing on the trailing edge, which is where real money is being made and where the economics are changing in a very favorable manner at the moment.
Well, and it's such a diverse industry. It's such a diverse book of goods, right? Because I don't really care about DRAM at all. It's a commodity that's going to have boom and busts, and it's pretty much fungible. What I do care about are the chips. 3,000 chips are used in a modern car. When Claudio Domenicali builds a Ducati Multistrada, he needs a lot more chips than even the CEO knew he needed, 2 years ago. these are the chips that matter, and I can't understand why companies that make these aren't doing so much better. If I look at the SOX semiconductor index, every single company on that index is down year to date. Why doesn't the market differentiate as much as it could?
Well, so the stocks that are most focused on the trailing edge, sort of analog devices, text instruments, and so on, they aren't down anything like as much as the leading edge plays. So that is, the market is differentiating. It's probably not differentiating enough. And if you are building a very sophisticated vehicle, the chip that you're short of is probably not the highly sophisticated central processing unit. It's probably a number of pretty cheap and cheerful microcontrollers or analog chips, which only cost a few cents normally, and might well now be changing hands for tens, even hundreds of dollars. Because they're just so scarce. You know, I've been talking to lots of managements of US companies in the last few weeks, and they're all talking about the golden screw. And the golden screw, the bit they just can't get hold of, is often a comparatively cheap device, but it's just very, very scarce at present.
All right, William, it's great to hear about the differentiation here. I think we could do an hour-long program on all of the different kinds of chips. Is there one statement you could make about the whole industry as we head into 2023? Is there one position that you want to take on chips for next year?
So the last Micron pre-announcement, so the third one, they took half of their capex spend off from wafer fabrication equipment, so the equipment to make these things. That knocked about $4 billion off maybe the annual spend on that equipment. And 5 days later, they announced a completely new project for $100 billion for a new fab complex in New York State. And people are focusing on the $4 billion loss. And they're ignoring the $100 billion gain. And it's not just Micron, it's Samsung, it's TSMC, it's Intel, it's Texas Instruments. They're all building completely new greenfield over the next 5 to 10 years. And that's an enormous driver for semiconductor equipment. So just ignore the cycle.
Well, William, really quickly, let me jump in here. Let me jump in here really quick, because I think I'm right in saying you do hold TSMC in your funds, right? And that's what I'm asking you. These are names that are pledging to invest and build in multiple jurisdictions. Is that what attracts you to them?
Yes, well, TSMC is just an incredibly important company, becoming increasingly important over time. There isn't anyone like it. It has a uniquely good way of dealing with multiple customers as a foundry, so supplying chips to companies that have designed them. And there's no one really can keep up with that. And also, at the moment, they have a technology edge. So they're in a very, very strong position indeed. And they're cyclical. All of these stocks are cyclical, but they are growth cyclical. And some of them have got very, very strong growth profiles. So I would ignore the memory market because it's a very difficult market to get right, and it's not massively value creative. And I would focus on the much longer term, more solid stories, which are just going to cruise through this. They'll have a weak year, and then they'll go back to their trend again. And that trend is very, very good indeed.
All right, great to get your intelligence, William. Appreciate you coming on the show. William DeGale there of Blue Box Asset Management talking to us about the chip sector. Coming up, we're going to run you through some of the key events that are coming up today as we get closer and closer to Christmas. This is Bloomberg.
When you think space, you probably think one space agency that travels under the radar is ESA. which is surprising considering what the European Space Agency has achieved and how vital it is to the global space industry.
We've collaborated with pretty much everybody who is involved in space exploration.
But ESA wants to be a leading force in furthering humanity's mission into space.
Commander Ground, do you copy? Copy.
If we want to have successful human missions to Mars, we are going to have to learn to live and work off-world in a different way. The place where we are going to learn to do that is on the moon.
Can ESA help humanity take its next giant leap?
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
This is Bloomberg Surveillance Early Edition. I'm Matt Miller in New York and Ed Ludlow in London. Let's take a look at what's ahead today as we approach the Christmas holiday. At 6 a.m. Eastern, we will get the Turkish rate decision, expecting a hold at 9%. President Erdogan pinning the success of his re-election on low rates. And as we learned about an hour ago, also a 55% increase in minimum wage. At 8:30 a.m., we get an initial jobless claims number and the third print of third quarter GDP in the U.S. Unless there's a serious revision, probably no reaction there. Later on, we're waiting to hear more from Sam Bankman-Fried or his attorneys. His top two associates, they pled guilty to fraud and are cooperating with U.S. prosecutors leading the FTX case. So Gary Wang and Caroline Ellison are going to turn state's evidence, essentially. And I think this is incredibly interesting because we hadn't heard almost anything about them for the past 5 or 6 weeks. And all of a sudden, they are going to be key witnesses, it seems, in a case against a multi-count case against Sam Bankman-Fried.
And it's also the relationship between them. Gary Wang they met at math camp. They were roommates at MIT. They started these businesses together. We've been moving towards the extradition to the US for days. But this overnight, this was a surprise. This is big.
Yeah, I mean, you know as well as I do that when you make friends at math camp, that's a friend for life. But in this case, that friendship looks like it'll be cut short. The same is true of Caroline Ellison. They were romantically involved, apparently, and nonetheless, at least according to SBF, didn't really share details about what she was doing running his investment firm, Alameda, while he was running the exchange that was giving Alameda like $8 billion in margin. So it'll be very interesting indeed. Really a situation not to make light of because so many people lost money and some people may spend a long, long time in prison. Ed, I know you've got to get off camera and go cover earnings for Bloomberg. That's it for Early Edition. Bloomberg Surveillance, the OG, is up next. We'll hear from Peter Hooper at Deutsche Bank. This is Bloomberg.
been an advisor to the President of the United States on infrastructure and manufacturing, but on infrastructure, you've been involved with the legislation that was passed not long ago. Why is the United States infrastructure so terrible compared to so many other wealthy countries?
I have been around U.S. politics like you for a couple of decades and have served a variety of presidents from the different parties. And the attitude in the United States is obviously to keep taxes low and keep the public spend under control. And the word control is interesting, but that stops forward thinking in terms of planning. And therefore, the short-termism around our fiscal policies has hurt us. I mean, in essence, infrastructure is a long-term return. And to get a long-term return, putting it into private hands is one way of doing it. But really, the public side of life has to be willing to do the forward spend. The forward spend on airports and roads and EV charging stations has to come from the public domain. Now, raising taxes to spend money on infrastructure means you've got to trust the people doing the spending. And I think the public-private model is the way to go there, which is actually create an infrastructure bank that is U.S. public sector owned that has private sector matching funds. I think that sort of breakthrough has yet to occur in the United States. So where we go is tax and spend, which unfortunately one side of the aisle disagrees with.
Markets countdown in Europe. From the financial centers of the world, Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis. Weekdays.
Not forecasting a deep and very long recession, but let's not be too optimistic.
This year has been historically difficult, to state the obvious.
I think central banks really need to be careful here.
There's room, I think, for the Fed to step down.
You look what the bond market's telling you. It's telling you the Fed is going to win the battle against inflation.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowitz.
Good morning, everyone. Jonathan Ferro, Lisa Abramowitz, and Tom Keene. We welcome all of you on a Thursday. Claims at 8:30, but far more of that. Getting to the holiday season, the oddity of a weekend, Christmas Eve, Christmas Day, it's a different season. I mean, starting with Hanukkah, Lisa, it's just a whole different feeling across America.
It's supposed to be over. The longest year in the history of the world is supposed to be over, one that has been incredibly tumultuous, and yet we've gotten a number of really big announcements that haven't necessarily faced markets as much as I would expect, and that, to me, is the year-end mystery. Is this just that people are asleep and away, or is this something bigger that means that perhaps the tail risks are changing next
I'm
year?
a big believer in the year-end lift, and we certainly saw that yesterday. We're going to look at economics, finance, investment today, some Bitcoin talk as well off of Mr. Bankman-Fried coming back from Bahamas, and of course, all that Amory Horton witnessed yesterday in Washington. But it's tough to stay focused, and to me, not the guilt of it, not to sound like I am, but there's a part of America celebrating a buoyant economy, participating in the economy, and there's another part that's just not in the script, and that's seen in the economic data.
Yeah, and cutting back, although the sentiment data, did you see the sentiment data yesterday that came out? Much better than expected, a huge upside surprise. How much is this being driven by the fact that gasoline prices are the lowest in the U.S. going back to July of last year? How much of this is actually true momentum? The bigger story to me, and I'm going to kind of rip up the script, but to me, the biggest story of the moment really is China's massive U-turn that has gone undiscussed in terms of the ramifications. The fact that suddenly they are open, full force, despite all the hospitalizations. Now this morning, did you see the announcement? They're not going to have to force foreigners to quarantine.
And you know, I read it with family in China, and what's so important here, folks, and this is Bloomberg reporting this morning, and Bloomberg reports that there's quarantine adjustments in China. We thank our Pacific Rim team for that. To me, it's a little bit of gobbledygook. It's like 8 days down to Q+3 and all that. I don't pretend to be expert on it, but this is a daily unfold, as you say, as we stagger to 2023.
Gobbledygook, yes, in the sense that it's hard to understand exactly what's going on, except the economy is suddenly much more in the forefront, and suddenly the Band-Aid has just been lifted off. I mean, it's been ripped off. All of a sudden, just out of the blue, there is no more COVID-0. It seems like the public testing, et cetera, the implications of that, people had been saying were vast, and yet we're not necessarily seeing them in market action.
We've got an important guest to start off with. We've got really interesting, really quality guest set for you today through the 10 o'clock hour. Lisa will be in for John 9. Farrell, where's Farrell? I mean, we believe he's like leaving on a jet plane back to the mother country.
He's actually celebrating his Christmas tree because it is beautiful and well adorned, and it has been for a long
they could
time.
leave they could leave it up while he was gone across the Atlantic because I don't think it needs to be watered. I mean, I'm taking
really?
a reach there.
You're going to throw shade at his
I'm throwing massive shade
tree.
at it.
Really? I think that there is something to be said for not having shedding pine leaves.
Actually,
pine needles.
We should get Steve and the team out, and they can film me watering the tree at 3 p.m. every day.
You're so resentful.
You want some comedy action.
Resentful about this tree. Come on.
The tree, the squirrel comes down and sits on my head while I'm watering the tree. I want to do a data check here before we get to Jens Nordvig, and Lisa, help me out here. I'm going to look at the one single statistic I care about, and this is also the one that Chairman Powell cares about, and that is any form of financial conditions index. We use the Bloomberg Financial Conditions Index is a stunning negative 0.444. That index in its summation, including a buoyant stock market, Lisa, moves in an accommodative way.
And it has been pretty steadily with this lift that we've seen heading into year end. What I find most interesting is the stasis that we're seeing in the dollar-yen cross. This question of what have the ramifications been of the Bank of Japan's move. We saw a little bit of a rebound yesterday after the biggest decline in the dollar versus the yen going back to 1998. We're just kind of hanging in there, waiting for the next shoe to drop. I want to just give you a sense. There isn't that much going on, but 8:30 a.m. we do get initial jobless claims in the third reading of the third quarter GDP read in the United States. At 11 a.m. we get Kansas City Fed's manufacturing index for December. How much does that slow down? This follows on what we heard from Micron yesterday in terms of demand not picking back up in order for them to become profitable. And I do have to say, you know, we're on weather watch, and that's what I'm watching is the bomb cyclone that people are looking at, and all of the well, it's actually a technical term. I did a lot of research on bomb cyclones, partly because I'm going to be among those trying to travel, and I expect to be delayed and marooned in airports and possibly
isn't a bomb cyclone called February in Detroit? I mean,
it's actually,
what is a bomb cyclone?
It's when the weather changes very quickly and very intensely, and that's what people are talking about. And basically you're talking about sudden shifts in temperature that's 50 or 60 degrees in terms of a delta, and you're talking about snow and winds that rival Category 1 hurricanes.
We sit on a lawn in August at Jackson Hole. It's really beautiful, and it's usually very cold, like 45 degrees, and it's not funny. This morning on that lawn, it is minus 26.
See?
It is minus 26 in Wyoming at some point this morning. Be careful out there, and I know in New York City it's very cold. It comes Saturday as well. Jens Nordvig won't be steeled from the cold. He's lived it in Denmark, and Mr. Nordvig joins us from Exante Data with wonderful knowledge, particularly of the transatlantic dynamic. Well, this is a question John Farrow had asked Jens. What is the European, UK, U.S. dynamic next year? How will that play out in the litmus paper of the foreign exchange system?
Well, so we've had a situation where we had an energy crisis in Europe. The euro was under very significant pressure. People doubted that the ECB was going to really lift interest rates almost at all, right? And now we actually have a situation where the energy crisis is still there, but the tail risk is being removed. Prices are coming down. And the ECB is actually sending more hawkish signals than the Fed. Like ECB is saying we're going to go 50 basis points for a long period of time into 2023, whereas the Fed has kind of signaled that they may want to slow down, right? So things have changed very dramatically over the last 2-3 months.
Well, let's go to your book, The Fall of the Euro, which changed the dialogue 10 years ago, I'm going to say, Jens. And I don't need to know the gloom of the fall of the euro. I'll leave that to Lisa. But what I do want to know is, does Christine Lagarde have a nominal GDP spirit like Chairman Powell has in the U.S.? I don't observe it.
So I think Christine Lagarde's problem is that she's trying to convey a governing council opinion that is actually split, right? So when she stands up and delivers her remarks, she has to find a balance. And in one press conference, she sort of tilts a little bit to the doves, and in other press conferences, tilts clearly to the hawks. So that becomes a bit confusing for the general public to understand. The bottom line is that with inflation this high in Europe, the ECB doesn't really have much of a choice, and the ECB is operating like a Bundesbank type bank and focusing entirely on inflation. And that's what we're going to continue to see in the next 6 months, most likely.
How much does the China reopening story really accelerate the need for the ECB to remain really tight, really hawkish with respect to their policy?
Yes, I'm glad you're bringing that up. I think I can see you were tweeting about China, and I think it is there's not sufficient focus on how quick the reopening in China is. Everybody was forecasting during some kind of period in 2023, there was going to be some gradual reopening, right? And what we're actually seeing is that we have pretty much full reopening within a couple of weeks. Like the timetable is massively accelerated. And that means we're going to get probably a peak in COVID cases imminently, right? It's COVID is actually pretty easy to forecast if there's no government intervention. It runs a certain cycle. And then we're going to have mobility behavior on the ground change again within the next 1-2 months. So China is going to have a pretty big bounce in consumption activity over the next few months. And that's going to be a big impact on commodity markets. It's going to be a big impact on certainly growth in the region. And that has implications for everything. The most important driver of global markets has always been growth. Right now, we have competition from inflation, but growth certainly matters, and China is super important in that regard still.
Aside from possibly giving a big pop to oil prices, what other implications are there for global markets that are underpriced right now?
Yeah, so I think it certainly makes the challenge for central banks harder, right? All the central banks that are looking for some kind of peak in inflation, some kind of anchoring of the terminal rate, right? If they have another inflation impulse that is coming from higher demand out of China that has been incredibly depressed, that's going to make it much harder for them to call when we actually have a turning point in inflation. So it makes these central banks that want to get more stable on rates, they are facing a much bigger challenge because of this news.
Jens, John emails in. John, thanks, John, for watching today. He's in a bus terminal at Heathrow trying to get to Cornwall. And, I look, Jens, at John's note, and he says he needs to make some money fast. What is the opportunistic pair to speculate in out the next 90 days?
Well, so I think like when you have stimulus dynamics in China and the COVID reopening is kind of working like a stimulus dynamic, crude oil is something that has consistently reacted over the last couple of decades when that happens. And in the currency market, right, you have certain currencies in Asia that really benefit from stronger growth. In China, that would be the Korean won, Australian dollar. And then the places that really benefit from tourism would be Thai baht. So those would be three I've mentioned that directly relate to what's going on with the reopening in China.
Jens, thank you so much for helping us this year. We look forward to the next visit. Jens Nordvig with Exante Data today. You know what John's going through, and I think it speaks for so many people on radio and television this morning, east, west, north, south. I mean, everybody's sort of making it up as we go, given strikes, given weather, given capacity, given just a seat sold. I'm supposed to be leaving here in a day or two. I'm not going anywhere.
Well, yeah, they're changing their plans. They're not necessarily going. How many people have I talked to who were supposed to go away or who would normally go away, who don't want to this year, or who are driving and not flying simply because it is incredibly expensive and it is incredibly volatile, considering the fact that 1,000 flights, more than 1,000 flights, were canceled because of this cyclone, this bomb cyclone.
And what John told me, he's going out to Cornwall, which is tippy like palm trees or something in the United Kingdom. And he goes from Heathrow through Exeter, and I had no idea. It's 6 hours to Cornwall on a bus. I had no idea.
It's not taking a bus.
Far.
I guarantee.
No, he told me. He said he can't get a car. The train's on strike, so he's taking a bus to Cornwall, which I think is,
It's a new TV show.
It's 6 hours, 57 minutes. It's extraordinary.
John,
safe travels. Futures -6, Dow futures -66. We've got all sorts of great guests. For you, with your worries of the stock market, Jonathan Golub joins us. That at 7 a.m. Must watch, must listen. Good morning.
Keeping you up to date with news from around the world. With the first word, I'm Lisa Mateo. UK household income fell for a fourth straight quarter, leaving Britons on course for the worst period for living standards in memory. Adjusted for inflation, disposable income per person declined 0.5% in the third quarter, according to the Office of National Statistics. Gross domestic product also fell. Economists say the cost of living squeeze has likely already pushed the UK into a lengthy recession that may last until the end of next year. A new analysis shows China is likely experiencing 1 million COVID infections and 5,000 virus deaths every day. That's according to Airfinity, a London-based research firm that focuses on predictive health analytics. Now, meanwhile, Bloomberg has learned China plans to cut quarantine requirements for overseas travelers in January. Under the new rules, the requirement to spend time in a quarantine hotel or isolation facility would be scrapped, and arrivals into the country would instead be subject to 3 days of monitoring. Overseas arrivals currently isolate for as many as 8 days. Tesla is offering a $7,500 credit and 10,000 miles of free supercharging to U.S. customers who order a new Model 3 or Model Y by December 31st. That's according to its website. The carmaker was previously offering a $3,750 credit, which certain Teslas were expected to be eligible for as part of changes to the federal tax credits for electric vehicles under the Inflation Reduction Act. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Lisa Mateo. This is Bloomberg.
Innovation strikes. Bloomberg Technology is there with the news and analysis you need. Every weekday, only on Bloomberg.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
In a multi-trillion-dollar industry, there's a lot of ground to cover.
Commodities got absolutely crushed.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg. The top names at the Fed are on Bloomberg.
I do see growth slowing, but remember that's part of the mechanism of getting demand into better balance with supply and alleviating those price pressures.
We're clearly not in a recession right now based on the data. It is an economy that is growing only modestly, and I think it's an economy that's really seeing the imbalances between supply and demand diminishing and inflation coming down.
Nobody covers the Fed like Bloomberg, your global business authority.
Struggle will define in what world our children and grandchildren will live, and then their children and grandchildren. It will define whether it will be a democracy of Ukrainians and for Americans for all. This battle cannot be frozen or postponed.
Very interesting day yesterday. Anne-Marie Horton way out front on this story, saying it was a stun to Washington to learn that Mr. Zelensky of Ukraine would visit. Lisa, what I noted here, and it was so important to allude to Churchill, Roosevelt, August of 1941, floating off Newfoundland, where the United States had to simply say to Britain, "We'll be there." Something like that happened yesterday.
There was a pledge to help Ukraine and to continue helping Ukraine no matter what as a result, not only to help in the war against Russia, but for some of the issues that he put out there for democracy. Question is, the bill was actually delayed last night. The $45 billion in aid as part of this entire package that's getting caught up in Washington, D.C. end of the year drama. So we shall see how things unfold.
Part of the drama and the leadership here is Tony Capaccio, who's our expert on weapons for Bloomberg and also alluded to in the Washington Post this morning, is who wants what. Anne-Marie Horton briefs us on the path forward for Mr. Zelensky and, for that matter, the President of the United States as well. They're not going to get M1 Abrams tanks. They're too fancy. They're too complex, Anne-Marie. But what are they going to get into? Does Europe have Mr. Biden's back?
I think it's pretty clear Europe does have Mr. Biden's back, the president's back, but this president is the one that is really at the center of keeping this alliance strong and steadfast. It's the reason why President Zelensky was in Washington, D.C. yesterday. He was not in Berlin, he was not in Paris, he was not in London, he was not in Brussels. He was in Washington, because Washington is the only place that can really make sure that Ukraine is going to continue to get everything it needs. And what the big thing, obviously, and the takeaway from yesterday is the Patriot missile system. And obviously there was some tension in that press conference. You're looking at the pictures there, because he says, "What do you ask for next?" And Zelensky joked, "Well, another Patriot missile." I mean, the biggest takeaway from Zelensky, whether or not it was the press conference or his speech at the joint session of Congress, is the fact that it was, "Thank you so much. We are very gracious, but we need more."
I spoke to General Kimmett yesterday of tangible military experience, and Anne-Marie, he was heated. Don't prosecute a winter war. With this success, does Mr. Zelensky want the weapons, including Patriot missiles, now to attack or defend in January and February, or can he wait for the advised spring offensive?
Zelensky wants whatever he can get his hands on immediately, and that was pretty obvious yesterday. I'm unclear on the timeline that Patriot missile battery is going to be able to get into Ukraine and be operational. Remember, Ukrainians need to be trained on this, but it is that type of weapon he wants. And the president said yesterday, this is a defensive weapon. And the president alluded to the fact that what Putin is doing, and the president's words were a weaponization of the winter. They want to be able to shoot down these missiles and drones that are attacking their civilian infrastructure. And that is going to get worse in the winter, because it's the winter time when you're really desperate and need electricity and heat and clean water.
Anne-Marie, at the same time, even after the warm welcome by Washington, D.C. of Vladimir Zelensky, they did not pass the $1.7 trillion omnibus bill that included the $45 billion of aid for Ukraine. What's the holdup?
They didn't pass it yet. Let's see what happens today. But they were supposed to vote yesterday, and what you have is Senator Mike Lee wants to put forward an amendment. This would be about Title 42. What they want is for Title 42 to continue. This was the pandemic era provision and restriction that if you were an asylum seeker crossing into the southern border, you can be expelled immediately to Mexico. The Republicans want this to come to a vote. The issue the Democrats have is, even if some Democrats in the Senate could sign up for this or allow this amendment to come in, this would be, as one aide put it, toxic in the House, and would not pass with the progressives they need to get on board to pass this bill. Because remember, House Republicans are lining up against this bill. So this is a big hurdle right now for this bill. But potentially we will see. They have been negotiating, and I believe it was Senator Schumer who said they are getting closer at around 2 a.m. But this could potentially extend into next week, and then that would mean more likely you would get a stopgap funding measure. But they are going to be working on it today.
There's a broader issue here, Anne-Marie, which is the question around immigration and whether or not to open up immigration much more, especially in light of the labor market shortages that we've been talking about nonstop this year that have fueled some of the wage gains that some people are concerned could become a wage spiral. Is there bipartisan agreement on opening up how many people are allowed in?
Well, Kirsten Sinema is trying to work on this alongside Senator Thune to try to get a bipartisan immigration reform. Listen, it doesn't matter, Republicans, Democrats, many have spoken about the need for immigration reform, but when it comes down to the details, this is something that has been very tricky and difficult for a bipartisan way to get passed forward. But Lisa, you bring up a point, which is that we are facing a very tight labor market, and many have been calling for at least a readjustment in the immigration system because the United States needs workers at this time.
How does immigration policy change, say, January 15th?
Well, I think it'll just become much more difficult if the Democrats were able to get an immigration policy through that needed some Republican support, because come January, this is now a divided Congress. You have a democratically held, controlled Senate and a Republican House. What also changes is that at this moment, Title 42 is about to be lapsed, and that's what the Republicans are trying to change.
Anne-Marie, thank you so much. Anne-Marie Horton will continue this discussion, particularly on history made in Washington yesterday. We'll do that in the next hour as well. Lisa, I want to look at the 10-year yield suddenly, 3.64%. And, you know, I don't know, are we sleepwalking into next year where we're going to revisit that tension above 4%? Remember, we're even modeling out 5%. No one's looking for that.
Especially the oddity here, and I feel like a broken record. Just a month ago, there was analyst after analyst saying that the one bear case for bonds was if Japan abandoned their yield curve control and if China reopened. Both things appear to be more likely than ever, and yet we have not seen a material move up in yields. It is a question that I think is the question heading into the first month of next year.
You were quite taken by the pageantry yesterday in Washington.
Well, this is his first visit outside of Ukraine since the war started. This is his plea for more aid, for more focus on trying to end this as they head into a difficult winter. And it is notable to me, the pageantry coming at a time of war for the rest of his people.
I was thunderstruck yesterday, and maybe I missed this, folks. I did not see a lot of the evening news work, but to me, it harkens back to Southeast Asia and action by democracies over a domino effect. And this time the domino effect is a little different, but it migrates from the south and on the Black Sea up to Estonia and maybe even across to Finland. I'm not going to go there, but from Kyiv to Tallinn, and that's why we're doing this. And I just don't think that was discussed yesterday. The idea of the West and of President Biden, we got to get out front on this now for short money to protect that line going north.
The trade lines, the question about the alliance lines, the strategic lines, this is all shifting.
Alliance lines, well said,
and, you know, what we're seeing is not only are some of the alliance lines shifting, but the trade lines. There was a story about how there's a new route being created between Iran and Russia through the mainland in order to avoid some of the sanctions. The world is changing, and that I think was highlighted by some of the discussion yesterday.
Right.
This is going to be an ongoing conflict with ongoing ramifications.
You know, there's different roads on that. To let you know, in our first announcement, our annual visit with Ian Bremmer, look for that. We'll do that early in January with his Eurasia group. And I'm sure Dr. Bremmer will talk about the many roads out there and how they change. We will change by telling you that the data today, red and green on the screen, futures at -9. The VIX with a 19 print earlier. Stay with us. Good morning.
visibility on the course may not be etched into any record books, but following him around, it's clear that it's not for lack of trying.
Jeez.
We were constantly hustling behind him as he caught up with executives in the portfolio companies and reminisced with former and current players.
He's a day trader. He taught himself, self-made day trader. Yes. And so he's on the bus after a game in New England, and he's day trading on the bus, and Bill Belichick sees him and cuts him on the spot.
You know, in many ways, it's a convention, right, of the people that I don't see maybe once a year. And so it's kind of all come together. My firm, our charity, fundraising efforts, and then the friends that are around. My dad and my brother, it all happens right there as a confluence of all these parts of my life that have found its common center.
Good morning, everyone. Lisa Bramlett and Tom Kane, John Farrow on assignment. We welcome all of you here sliding into the holiday season, but with that, some serious information flow. Bloomberg News reporting this morning the quarantine eases up in China. We'll have details on that through the morning as well. On the data front, I'm going to call it a churn of the market, but clearly an accommodative Bloomberg Financial Conditions Index, something Chairman Powell does not want to see. Dollar churning here as well. The yen, as Lisa mentioned, off that history move of the few days before, 132.13. Maybe it's stasis in a Bramo kind of way. This is a joy. We welcome Peter Hooper. He is Vice Chair of Research at Deutsche Bank, but far more than that, team leader for the greatest economic call of the year. Rarely do you put together a directional call with a timeline. Under Dr. Hooper's guidance, Deutsche Bank made a mistake and did both 9 months ago and absolutely nailed that the recession would happen later than sooner. Peter Hooper, congratulations to you and Matt Lazzetti on that call, which appears to be still in place. Review why the recession is delayed.
Tom, the recession is delayed primarily because of the lags and the effects of monetary tightening on the economy. We've known for quite some time that monetary tightening operates with long and variable lags, shortened a bit by forward-looking financial markets, except the financial markets are not playing the role that you would normally expect here. Their financial conditions have tightened some, but not enough. We still see quite a bit of momentum in consumer sector and certainly in the labor market.
Are we beyond pandemic shock? Are we beyond various and sundry supply shocks?
Well, we're living with the aftermath here, and certainly seeing a shift, a recovery in services spending that was depressed for substantially by the pandemic. That's still coming back, and that's still supporting consumer spending significantly. So the recovery is a factor that's working against the Fed right now, trying to deal with inflation. The services, the supply side of the economy has improved enough to reduce inflation pressures on the goods sector. In fact, we're seeing goods prices declining now. It's the services side and the catch-up there that's really driving this momentum that's keeping the expansion going quite a bit longer than perhaps the Fed would like to see it.
Deutsche Bank predicts that U.S. equities could drop 25% from current levels in the next downturn, particularly in the first half of next year. Is this going to be entirely induced by Fed policy as people realize just how committed they are?
Yes, Lisa, I think that is the primary factor underlying that call. Certainly, as you go into recession, multiples get down to around 15. That would imply an S&P 500 getting down to around 3,000 at the low.
But we also expect the recession to be relatively short, maybe several quarters, and you'll see a recovery before you get out of the recession. The stock market should be back by the end of the year, close to current levels, if things work out as our call anticipates here.
How do you push back, Peter, against people who say that we're already seeing a deceleration in activity, we're already seeing a deceleration in consumer appetite to spend, we're already seeing a disinflationary impulse that will give the Fed breathing room that has created a shift in tone from Fed Chair Jay Powell? How do you push back and say, no, that is not what you're going to be focusing on come next year?
Well, I mean, I think that view is driven in part by this recession we're already seeing in the goods sector. Goods spending got way above normal. That's come off now. But it is the recovery of services, which is more than 2/3 of the economy, that is going to keep things going. You push back because the labor market is still very, very tight, as Chair Powell keeps saying. We have a long ways to go to get pressure out of the labor market. The Fed has been saying now that it thinks that the NARU, the natural rate of unemployment, has been moving up. We've been saying for some time we think it's in the 5.5% range. So we're going to have to get at least to that level to begin to relieve the pressure in the labor market to bring wage inflation down from levels that is supporting inflation at least double the Fed's target at this point. So that's the struggle. I mean, the pushback is not too difficult when you look at the labor market and you look at consumer spending on services at this point.
I feel like this has been the story for a couple of months now. And I'm really struck by the lack of attention given to the fact that there has been two big sea changes that people were looking at as potential tail risks for next year. The potential abandonment of yield curve control by the Bank of Japan, which hasn't happened yet, but there has been signs that perhaps that could happen, and a reopening of China, which seems to have already been done in full force. How has that shifted your view, considering that both of these things seem to be happening faster and more rapidly, more suddenly than people had expected?
Well, it was really interesting to watch the Bank of Japan's move this week. That was a surprise. Surprise that they would take a risk in breaking the dam a bit at a time when the labor market in Japan is really very tight, we think, and wage inflation there is going to be driving price inflation perhaps above levels of the lake. Something very unusual for Japan at this point, but no question. That is a factor down the road. We don't expect YCC to be abandoned until new leadership comes in around April next year at the Bank of Japan. On the opening in China, certainly that's going to be disruptive for a while. No question, the pandemic is going to be a factor that holds back activity for the near term. We're expecting growth in China to remain relatively subdued well into the year ahead. But then as they hopefully get improvements on the vaccination side, on vaccines, things will be able to open up more normally.
Peter, I went back and actually looked, and we spoke to David Folkerts-Landau on March 2nd last year in the shock of a Putin invasion. And he was heated that down the road there would be a great rebuild in the shock of fiscal stimulus. Now, obviously, it's not there right now. Some would say there's even elements of austerity. But is the great unseen out there that can give us optimism is almost spending on a post-World War II level?
Well, when you're talking about packages of $40 billion in support for Ukraine, certainly from the Ukrainian standpoint, there is a major rebuild coming. Although we have the end of this war is not in sight at this point, and it's going to be destructive for some time to come, I would think. But looking beyond, yes, from a Ukrainian standpoint, there is a major push coming down the road.
You mentioned Japan earlier with Lisa, and there's still the shock of the other three major central banks. What should we look for? Not so much the next meeting and the parlor game that you force Lazzetti to look at every day, but in a broader sense, what is a central bank strategy to get to the summer or the autumn of next year?
Well, I mean, I think both the Fed and the ECB are dealing with, they have some headwinds in dealing with the inflation problem. Headwinds, the financial conditions are not yet getting to the point that we're going to see the amount of slowdown, the amount of pressure coming off labor markets that needs to occur. Same for the ECB. I think Christine Lagarde gave hints that the ECB could see another 2 to 3 50 basis point rate hikes, pushing the terminal rate in Europe above 3%, potentially. Our call has been 3%, but we certainly see the risk to the upside there. Likewise for the Fed. I mean, Matt's call for some time has been 5.1 on terminal for the Fed, but with upside there, certainly if financial conditions are not moving in the direction we need to see them moving, and if the labor market remains firm, the Fed could well be pushing into the 5.5% plus range as we get into late spring, early summer.
Dr. Hooper, thank you for visiting today. Peter Hooper is Vice Chair Research for Deutsche Bank as well, working with David Folkerts-Landau on a world-class team, I should point out. Lisa, let's drop on oil here right now. I think it's one of the biggest shocks of the year. I was trained never, ever forecast oil. It is the toughest thing to call on, and yet people have it at Deutsche Bank and other firms. They have the legendary Adam Szymanski decades ago, but others, Paul Sankey was there, and Curry, you know the names and victims. What a stunning year for oil, 120, 130, oops, down to 80.
I know, it's just sort of shocking, especially considering that people were talking about $120 to $125 a barrel of oil by the end of this year. Also, kind of piggybacking on that story, especially ahead of the travel weekend, gasoline prices now $3.11 on average around the United States, which means it is the lowest going back to the summer of last year. Just giving you a sense of the shift and the sort of unexpectedness of this.
Then why do car rentals cost so much?
Oh, that's a whole other story. Yeah.
To me.
Supply and demand.
They come in with a number and you're like, well, that's okay. And then you give them back the keys.
Well, yes, they have gotten really expensive. Well, you understand. Well, part of this is also just because they didn't have the same shipments of cars during the pandemic when nobody was traveling anywhere.
So you bought their line, huh?
So
we have a shortage of cars?
Well, they stopped buying as many, and the resale values of the cars that they did buy were very high, so they continued to replenish their fleets. And now there just are a certain number of cars, and everybody wants to have experiences.
Yeah, somebody asked me the other day, did I get rid of the Nash Rambler when used cars went up? And the answer is I didn't. It's still in the garage. It's got the chains on it. I'm ready for the snow.
Oh, good.
But, usually Carl Weinberg, the great Carl Weinberg, I'll get the Nash out and go up to Taconic there. And it's like,
when was the last time that you put chains on your tires?
Oh, it was, I probably in the park. Folks, you really want to know? Okay, yeah. we're going there right now.
Okay, yes, please.
In the parking lot of the Wobbly Barn. And yes, I was putting the chains on. I was a little wobbly as well.
I'm shocked. And that was the last time. I'm sure that there's a reason behind the last time of chain
did that
arrangement.
I think John Poussette-Dart was playing. I can't remember exactly.
Yeah, well,
chains.
I'm going to be probably using some of those this weekend.
Are you?
Yeah, in Snowland.
Travel safe. We hope all of
yes, please, everybody be safe.
All of you travel safe. I'm seeing some images out of Logan and others on Twitter. I guess it is a hectic airline season. We'll talk about that. Hey, thanks, Helene Becker, for her briefing on airlines.
It was depressing.
Mary Schlangenstein as well. Yeah, it is.
It's going to get worse. It's going to be more expensive.
It's a great country. Why is it like this? Is a good question. Futures -8, down futures -79. This is Bloomberg. Good morning.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. Hospitals in Shanghai are struggling to cope with the number of COVID patients, with many pharmacies turning away customers. Months after the city of 25 million endured a brutal lockdown to stop the virus from spreading, COVID is making its way virtually unchecked through its population. Most of Shanghai schools are now closed and public transport usage is plummeting. BHP has made a binding offer to acquire Australian copper producer Oz Minerals for $6.4 billion US. Now, the deal is set to consolidate BHP's position as one of the world's largest producers of copper, a core metal in the clean energy transition. And BHP says the bid will now go to shareholders for approval by early April. In London, pubs and restaurants say last week's rail strikes cut their sales to almost half pre-pandemic levels. Trade group UK Hospitality says revenue was down 46% compared to the same week in 2019. Industrial action in sweeping the UK with walkouts by the workers in Royal Mail, health sector, airports, and various parts of the civil service, as well as those by rail and bus staff. More transport disruption is expected over Christmas and into the new year. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Lisa Mateo. This is Bloomberg.
While Teslas and the like make for good headlines, the reality is that even if every car on the roads today went electric, it wouldn't be enough to curb global emissions to avoid catastrophic climate change. Greenhouse gas emissions from transportation account for about 29% of total U.S. greenhouse gas emissions. So what about the other 71%?
Buildings across America burn fossil fuels to operate. What we want to do is make that all electric. Instead of burning oil and gas to give us the energy and electricity we need, we want to do 100% clean energy, all electric. We want to turn buildings into Teslas. Just like a Tesla or an electric vehicle is all electric with no fossil fuels, we want to do that with our buildings. And if we can do it in one building, we can do it in all buildings. And if we do it in all buildings, we'll reduce 30% of U.S. greenhouse gas emissions.
The top names at the Fed are on Bloomberg.
I do see growth slowing, but remember that's part of the mechanism of getting demand into better balance with supply and alleviating those price pressures.
We're clearly not in a recession right now based on the data. It is an economy that is growing only modestly, and I think it's an economy that's really seeing the imbalances between supply and demand diminishing and inflation coming down.
Nobody covers the Fed like Bloomberg, your global business authority.
Putin has no intention of stopping this cruel war. And the United States is committed to ensuring that the brave Ukrainian people can continue to defend their country against Russian aggression as long as it takes.
The President of the United States, really history made yesterday. Thank you, Anne-Marie Horton, for getting out front on that story yesterday morning. I think we did a great job, including General Kimmett on short notice to give us perspective as well. Lisa Bremowitz and Tom Keene, John Farrell on sabbatical this morning. Well-deserved, I would say. He's lost in an airport somewhere. You know, and somebody said to me, they said the hardest part about getting to Cornwall on bus is you get to Exeter and you think you're almost there. And it's just that far. Like, it's almost to France, really, the way it goes down. Anyways.
Merry Christmas. We wish him the best.
No, well, surveillance helicopter is tied up, so he's on a bus to Cornwall. We'll see how that goes. The pride and heritage of Bloomberg surveillance is to find experts for you on issues at hand. Leanna Fix is one of those. A fellow at the Council on Foreign Relations barely describes her knowledge of the odd relationship of Germany with the rest of Europe. That's an important brief right now, particularly after hearing from Mr. Zelensky on Capitol Hill yesterday. Liana, this year for you in international relations wasn't in the textbooks at the London School of Economics. There's no international theory that can explain this. What will be the new theory for the German people after 2022?
That's a very good question. And I think, first of all, Germans have to say goodbye to an old theory, because this old theory that dominated German politics throughout the end of the Cold War and after the end of the Cold War was change through trade, that it is possible to change Russia and also to change China by forging closer economic and trade ties. And for the United States, for example, the lesson from the end of the Cold War was peace through strength, the formula that Ronald Reagan used. So I think for Germans in 2023, perhaps they should look more towards Ronald Reagan and towards peace through strength rather than change through trade.
The moment yesterday in Washington, almost like Churchill Roosevelt floating on a boat in Newfoundland in 1941. I don't want to make it an equivalent, but it's there. What is the equivalent visit that we're going to see of Germany and France? How do the two of them stagger forward in year 2 of this war?
But Germany and France, they do have to catch up. It's not without reason that Zelensky went to the United States first, because the United States is just the indispensable nation in this war. And this visit has demonstrated that the United States is back as the leader of the free world. But this means also that other European countries like Germany and France have not been able to step up to the historic occasion of a war in Europe. At the moment, Europe is very much leaderless. Europe is leaning into US leadership. And of course, President Biden is playing a big role, but it would be good for Europe and also good for Ukraine if both France, Germany, but also Warsaw would play a prominent role as a UGT, as a united Europe in helping Ukraine.
Liana, yesterday a Ukrainian journalist asked President Biden, why aren't you providing more? Why haven't you basically thrown as much as you can at this effort to help Ukraine? And President Biden said, because he didn't want to anger or create fissions with some of the allies, with NATO in particular, and put NATO in a difficult spot. Does that ring true with you?
It rings true, but I think it's only one reason, because there are escalation concerns in Washington when it comes to relations with Russia too. So it's not only leaders in Europe that are concerned that, for instance, wide-range artillery might hit Russian territory and that other weapons might lead Russia to escalate further in this war. This is a serious concern in Washington too, as is the concern about nuclear escalation, which becomes particularly relevant when it comes to the question, how much of its territory should Ukraine retake? So I would say it is a topic for the alliance, but it's also a concern that is heard in Washington. And the nuclear escalation is also a concern of President Biden, who certainly doesn't want to see a nuclear escalation on his watch.
In the meantime, we are hearing about a mass migration out of Ukraine. We're hearing about power outages, a very difficult winter ahead. How much has the population shrunk? How much are we looking at a very different Ukraine coming out of this than coming in?
So in Europe, we had 4.7 million registered refugees from Ukraine, but many of those have returned to Ukraine over the summer, which has relieved the burden for Europeans. Now, when we're looking towards this winter, it's exactly the strategy that Moscow pursues to put Europe under pressure by making Ukraine very much uninhabitable and by forcing Ukrainians to seek refuge once again in Europe. And that's a strategy that Europeans try to counter by air defense, which is important. But at the same time, Ukraine needs offensive capabilities to continue counteroffensives.
Dr. Fix, one more question on Germany. Is there a new Angela Merkel out there? Is there someone within domestic German politics that can fill the shoes, the emotion of the heritage of Angela Merkel?
Well, actually, Olaf Scholz, the chancellor now in Germany, was compared to Angela Merkel at the beginning of his term. But let me remind us that Angela Merkel also got this very special appeal, this admiration from the outside world only towards the end of her chancellorship. That was not the case at the beginning. So Olaf Scholz will need 16 years perhaps to get to this point.
Dr. Fix, thank you so much. Greatly, greatly appreciate it right now. We're going to digress here, folks, with the Council on Foreign Relations, and they're particularly on Germany. We're going to look at the data here. There's lots to talk about as well, the accommodative tone of the Bloomberg Financial Conditions Index. John Gollop will be with us here on the equity markets. But, Lisa, I have to stop, and I'm going to go back to my youth, where long ago, someone very young without a bow tie on had to deal with sudden infant death syndrome. And it was done out of the best university for this in America, which was the University of Washington in Seattle. They've gone on from 50 years from their ownership of the immunology, the virology, the microbiology of that era to owning COVID data. The work there of the IMHE in the last 2 days, and this is a lot of this is funded by Bill and Melinda Gates and all that, you know, the Washington State funding. Their numbers on China are just stunning. There's no measurement, there's nothing we can grasp here, all of us watching in the Western world, of what's to come in China, basically based on the smartest people on the block, the people at the University of Washington.
So there are a number of estimates that people are trying to put out there because the real data, the sort of state-backed data, I'm not going to call it real, has been basically rejected based on empirical data with hospitals full and with some of the crematoria in full operation. China is likely experiencing 1 million COVID infections and 5,000 virus deaths every day. This according to Airfinity, which is a London-based research firm. The bigger question here is, how long is it going to rip through a population, fill hospitals, lead to deaths, lead to pain, lead to the emotional turmoil that Xi Jinping tries to offset with stimulus? This is sort of the push-pull that we're seeing right now that is completely changing the scenario and the dialogue for China next year.
And to put a compare and contrast on this, folks, is what we do. IHME of Washington made headlines and got a lot of grief from the White House, I might point out, except for Dr. Fauci, when they said 80-some thousand U.S. COVID deaths in 90 or 120 days back in 2020. So take a number like 80 or 100,000 and compare it to the mathematics of 1 million infected and what that death size is in China. We're just literally, folks, into this holiday weekend, beginning to gauge the scope and scale of what we see in China.
And the psychology of it. We've gone from lockdowns. We've gone from state testing. We've gone from not being able to go into a public place without having some sort of official document saying you've been cleared on a regular basis. We've gone from quarantining to nothing, to not being able to get tests in stores, to having to have state-run manufacturing of Tylenol to combat the mass infection that's ripping through the population. How does that affect the psyche? Xi Jinping has been quiet. We have not heard from him. What is the response
Well, maybe
going to
we'll
be?
in the slowness of the holiday season. May I state that the place that tested me early and often through all of COVID, and literally 12 months ago, I think I had COVID, is now a wedding dress store on Madison Avenue.
That sounds about right.
That's where we're going, folks.
Have you seen the new tests where you have 4 quadrants, where it's COVID, RSV, flu?
No, but that's a serious issue.
I know.
There's a heavy inflection of that in Western Indiana right now. West Lafayette crushed with a triple infection. It's just terrible.
It is.
Probably a visit to Harry's Chocolate Shop will get it done. Futures in -7. Stay with us. This is Bloomberg.
Lots happening on Wall Street.
I'm quite encouraged. The center is holding.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights
A lot of these areas still have very, very good valuations.
from businesses most influential and instrumental.
It's knocking it out of the ballpark.
Now's not a great time to be speculative. It's time for a pivot.
We're talking about a significant hit to our standard of living.
Bloomberg Wall Street Week, live Friday with replays all weekend on Bloomberg Television and Radio.
What do you say to the cynics that say, look, it's all nice and fine, but a lot of it is greenwashing, and you're not a good company, you're just a less toxic company than some of the other oil majors?
Well, the first thing to say is that, you know, I'm a big believer in we need to put ourselves in other person's shoes in life in general. And so I understand that point of view, and I get that people have that perspective. I don't agree with that, obviously, but I understand where they're coming from. We have an enormous challenge as society, which is to provide the world with reliable, affordable, and clean energy. That's what society wants. That's what society needs. And I believe in my heart that a company like BP is actually one of the few companies in the world who can actually make that happen. We can talk about the things that we're going to grow and over the coming years, and I find it hugely exciting and energizing for our organization. But that's what the world needs, and you simply can't go against the grain of society. You can't defy gravity, and that's why we're making the change that we're making.
The top names in business are on Bloomberg.
I think you have to assume that we have some bumpy times ahead, and you have to be a little bit more cautious with your financial resources, with your sizing and the footprint of the organization.
So what can you do near term? Test to make sure you see at the margin you can move things around, manage your expenses very carefully and invest in efficiency and effectiveness, but also continue to spend money where you have competitive advantage.
Nobody covers business like Bloomberg, your global business authority. The markets count down in Europe from the financial centers of the world. Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis, weekdays.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
We are not forecasting a deep and very long recession, but let's not be too optimistic.
This year has been historically difficult, to state the obvious.
I think central banks really need to be careful here.
There's room, I think, for the Fed to step down.
You look what the bond market's telling you. It's telling you the Fed is going to win the battle against inflation.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Good morning, everyone. Jonathan Farrow, Lisa Abramowitz, and Tom Keene. We welcome you on a Thursday. Claims here coming up an hour and a half. We'll get to that here over the hour and into the next hour as well. John Farrell on assignment at Heathrow, trying to get Southwest.
On assignment? On assignment to what? Relax?
Well, you can't relax if you're taking a bus to Cornwall.
Fair point.
I mean, you know, the helicopter won't go in the London cold as well. We spent a real long hour in international relations. We're going to go stock market for a year. This is going to be must watch, must listen. And Lisa, part of this is the recovery in the markets. June up, down we go again. September up, now we go. I'm sorry, I got a VIX 19 print 20.16. Things aren't all that bad out there.
Here's the big debate heading into 2023. One of them, there are many of them, but one big debate is, will resilience in the economy be good for stock markets or bad for stock markets?
Well, is that it? That's the length of your question today? We have to have
to me,
longer
that's the
statements.
question. No, okay.
Fill time.
Whether it's basically, if you get a resilient economy, all of a sudden people are looking for an earnings downturn, say, great, we buy stocks. But then others say, well, then the Fed has to jack up rates by a whole host of percentage points. So suddenly we're looking at a sudden halt to the economy. Which is it?
The Gospel of St. Martin Adams, and Gina Martin Adams stating forcefully, economic analysis linked to stock market analysis fraught with risk. They don't move together. They move different ways, and some would say the equity market is out front on that as well. What I would suggest is profit is at hand, and that's when you hear this word quality, and that people are looking mostly there. Are they making money? Is just, you know, are they making money?
It's the haves and the have-nots. I mean, it's the have and the have-nots, not just with individuals and households, but also with companies. You have, on one hand, the companies that are coming out better than expected. Nike, FedEx, and then Micron yesterday, after the bell came out with disappointing earnings, saying they were going to cut thousands of jobs and have to really retrench and not see profitability next year because of the glut of semiconductors. It is just a very bifurcated kind of world with different stop-start recoveries.
Let's bifurcate to the view that you have this morning here, because we got to get John Golub in here. What do you say?
All right, 8:30 a.m. You mentioned this. We get the third reading of the U.S. third quarter GDP, initial jobless claims. That'll be interesting just to see whether we see another unexpected decline, downside surprise in the number of people filing for unemployment benefits. 11 a.m. We get the Kansas City Fed's manufacturing index for December. Do we see the optimism we saw for consumer sentiment yesterday bleed into manufacturing activity? And I am looking at the weather today just because, first of all, there's not a lot going on.
This is the first day I said yes.
I mean, honestly, this is going to affect heating costs. This is going to affect travel plans. More than 1,000 flights have been canceled ahead of the holiday weekend. A bomb cyclone is coming. And I knew you were going to make fun of me for saying that, but I've got to be honest. It's a technical thing, and it's a sudden shift.
They played Grand Funk Railroad like no one.
Bomb Cyclone
was so great. You'd get a Jenny 12-horse ale in your hand, and Bomb Cyclone would start in.
So for all of you who have garage bands, Bomb Cyclone is a fantastic name, which apparently is available. I do think, though, this is relevant because it is going to affect people's view, also in heating at a time when gas prices have gone down so much, but diesel still remains elevated.
We bust the chops of John Farrow, who can't take the cold of America, but really, this weekend, 19 degrees in New York City. It is going to be bitter cold coming in from Fargo in the west.
Okay, look, Fargo weather, let me just tell you, it is a whole other degree of cold.
You
come out, you can't breathe. Your car dies. You can't use pens because the ink freezes. You can't be outside with exposed skin because you get frostbitten. It's a different reality. But if the wind doesn't blow, you're okay.
And what's important here is, as you mentioned, Bomb Cyclone and what they did with Grand Funk Railroad. That takes us back to 74, 75 and the equity gloom back then. Someone who studied that, he's way too young to remember it. Jonathan Golub joins us, Chief U.S. Equity Optimist at Credit Suisse. We're thrilled he could join this morning. I'm going to get to your revisions, your markdown on earnings in that. But the answer's after 74, I believe it was. We went up 38% the next year, and critically, then a year after that, we went up another 18%. Is that the great surprise out there? Is an equity liftoff out there somewhere?
Well, I think it gets to something that Lisa was saying is what's good news. I mean, right now, the backdrop is just becoming much more positive with respect to this idea that there's no recession coming in the next 2 or 3 quarters, and the market getting their head around that, which is why the VIX has fallen and why stocks are racing ahead. Now, the problem is eventually this does bite us in terms of 2 things. First of all, companies are, as inflation is falling, companies are losing pricing power, and that's not good for margins. So a resilient consumer is actually a little bit of a headwind for profit margins, which is strange. And then ultimately, this inflation doesn't magically go away, which is also a problem.
You marked down earnings, okay? You're doing tweaks here in the Outlook. You got a 50-page Outlook. I didn't read it all. I read part of it. Do you know the watermark that they have for us so that we don't steal their research?
Yeah.
Do you know what his watermark said? If this research gets out, we take away my eggnog. I couldn't believe Credit Suisse did that. The compliance department at Credit Suisse did that. I want to know if profit's a place to hide. You were way out front in the bull call of selecting certain sectors, certain stocks. Does profit save me if I have to own stocks?
I don't think that's the way you should be looking at it. And you're talking about, Gina's comment that what happens in the economy doesn't necessarily happen in the stock market. What happens last year, corporate profits, the outlook improved throughout the year, and the stock market had a terrible year because interest rates rose and other factors like that. I think this year is going to be a little bit different. I think that you actually have margins. Margins are going to get squeezed, and I think it's going to be tougher on profits. But I think the stock market is going to be a little bit better on it.
Like how much better? Double digit or week?
No.
John, it's a slow day. I need to make some news. Let's go.
No, I think it's going to be a more modest returning year because I think that you're looking at something like down 4 or 5% profit growth, even if you don't have a recession because of a margin squeeze that's coming.
Have the companies that have already done the layoffs, and I'm thinking of tech, I'm thinking of certain industries, even the banking industry is starting to do some bigger rounds of layoffs, and of course the semiconductor industry. Are they going to be in a better position, or are they just a tea leaf for what's to come?
Well, first of all, when you look at and a lot of guys on Wall Street talk about all these layoffs because they're looking at tech and financials, but in reality, the job market is just swimming in unfilled jobs, and demand is incredibly high. But what the story is on tech in particular is that, and Tom was talking about profits. It's not one profit picture. The tech universe, if you include the Amazons and the Googles and the Facebooks and the like, it's been a horrific environment. They've substantially lagged the market. Their estimates are being revised lower and lower, and they're missing the lowered estimates as a group. And their outlook for growth, it was weak. This is since the iPhone came out in 2008. This is the worst year for tech-related companies that we've seen. The expectation is that next year we're going to get this big bounce in tech earnings as we get, we had this big pull forward. We're all staying at home. We're buying stuff. That lull afterwards is going to last longer than we think.
Are you telling me to sell Apple? I mean, I don't know, Neil. I'm in the triple leveraged all cash fund. We know that. But are you telling people to sell Apple along with all the other challenges Kathy Wood has?
What I'm saying is I think that this problem that we've had in tech is not a sentiment problem. It's an earnings problem, and it doesn't last for 3 or 4 quarters. It lasts for 6 or 8 quarters. And a lot of these big tech companies that 2 or 3 years ago we said they have moats, they're impenetrable, and we talked in those terms. A lot of those companies are getting closer to total addressable market, whether that's in handsets or advertising or other things like that.
So how do we get to 40-50 by the end of next year, given that you're expecting perhaps a bit more softness and tech not leading?
Well, there's other areas. So I think that energy, where there's this expectation that you're going to have a weakness in energy profits, I think is going to be totally wrong. I mean, we're seeing this right now that in the last 6 months, the earnings estimates for the energy sector keep getting revised higher and higher, even though oil prices are falling. So, where's the magic there? And it's a lack of refining capacity. And if we do end up with oil prices rising, a bit because the economy is a little bit stronger and China reopens, then these companies soar. Right. So I think that's an area of strength that's probably underestimated. Tech, on the other hand, to the downside.
I didn't know this. I mean, folks, years ago, Credit Suisse was absolutely definitive on energy infrastructure in the United States. His name was Mark Flannery. He's over with Steve Cohen buying New York Mets bodies at 0.72. You guys own the high ground. I don't think a lot of people know this. What does the subsets you have of energy tell you about the great energy bet in the stock market?
Well, I mean, and we're talking, it's interesting. If you look at U.S. energy company or North American energy, you have each of the pieces separately. So you have companies that do refining and companies who do distribution and E&P. If you're looking at the big majors in Europe, they're just big fat oil companies, and you have less of that granularity that you see in the U.S.
His next trip to Paris is going to be great. I'm here with the big fat oil companies.
No, listen, you have the same thing in the U.S. with our big integrators. But we have a lot of, and you can see that those refining businesses are just levitating on lack of refining capacity, and nobody's putting it in. So if you do have oil lift off, and then you actually get some upside in the more commodity-sensitive stuff like the E&P name and the service names, the sector is going to be a really big surprise. It's absolutely our top pick. The second area, at least we're talking about, is the consumer. Just think about what's going on. Their wages are staying higher, and the inflation on the things they're buying is falling, and there's an abundance of jobs. Right. Consumer confidence, and we've seen this now since June and July, the consumer confidence data is ripping, and people aren't appreciating that the consumer is going to spend a lot more money. It's going to keep us out of recession, and that's another area.
That's a gallop optimism I see, and as you mentioned, he only gets to 40-50.
Yeah, but that's exactly it, right? I mean, even with optimism, the case is converging on some of the bearish sentiment that we're seeing from elsewhere. I will say, America's going to shop. That's basically the takeaway that I heard. They've got money, they're going to spend it.
Okay. John Golub, thank you so much. I guess we'll see you soon if you're not in Paris being beaten to death by big fat oil companies, is what he said.
You make the holiday season sound like so
much
fun.
They have big fat dividends over in Europe, to be honest.
And they're coming back to the U.S.
It's an extraordinary policy. Jonathan Golub is with Credit Suisse, and we thank him this morning. Futures -6, a VIX with a 19 print, back to some form of optimism, 20.18. Please stay with us. This is Bloomberg. Good morning.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. Bloomberg has learned China plans to cut quarantine requirements for overseas travelers in January. Under the new rules, the requirement to spend time in a quarantine hotel or isolation facility would be scrapped, and arrivals into the country instead subject to 3 days of monitoring. Overseas arrivals currently isolate for as many as 8 days. U.S. authorities allege fallen crypto titan Sam Bankman-Fried defrauded investors in his FTX empire, stealing billions of dollars over years for his own benefit. Now, top Bankman-Fried associates Caroline Ellison, former CEO of Alameda Research, and Gary Wang, co-founder of FTX, are accused of helping him. They've pleaded guilty to federal criminal fraud charges and are cooperating with prosecutors. The U.S. Securities and Exchange Commission and Commodity Futures Trading Commission also announced separate lawsuits. More than 3/4 of UK businesses surveyed say the government's Brexit deal has not helped them increase sales or expand. According to the British Chambers of Commerce, Brexit has damaged the ability of companies to compete in the EU, with businesses, quote, banging their heads against a brick wall. Well, the research is published on the second anniversary of the agreement between London and Brussels. And Tesla is offering a $7,500 credit and 10,000 miles of free supercharging to U.S. customers who order a new Model 3 or Model Y by December 31st. That's according to its website. The carmaker was previously offering a $3,750 credit, which certain Teslas were expected to be eligible for as part of changes to the Inflation Reduction Act made to federal tax credits for electric vehicles. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Lisa Mateo. This is Bloomberg.
Innovation strikes. Bloomberg Technology is there with the news and analysis you need. Every weekday, only on Bloomberg.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
In a multi-trillion-dollar industry, there's a lot of ground to cover.
Commodities got absolutely crushed.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg. The top names at the Fed are on Bloomberg.
I do see growth slowing, but remember that's part of the mechanism of getting demand into better balance with supply and alleviating those price pressures.
We're clearly not in a recession right now based on the data. It is an economy that is growing only modestly, and I think it's an economy that's really seeing the imbalances between supply and demand diminishing and inflation coming down.
Nobody covers the Fed like Bloomberg, your global business authority.
The Southern District of New York has filed charges against Caroline Ellison, the former CEO of Alameda Research, and Gary Wang, a co-founder of FTX, in connection with their roles in the frauds that contributed to FTX's collapse. Both Ms. Ellison and Mr. Wang have pled guilty to those charges, and they are both cooperating with the Southern District of New York.
The gentleman of the legal system in New York, Damian Williams, U.S. attorney there. The phrase in the zeitgeist this morning, not from Bloomberg News, but from other sources, is the throwing under the bus, with two more people brought in on this scandal, if you would. And Mr. Bankman-Fried, somewhere, is he in the United States?
Yeah,
Lisa?
he's arrived in the United States after agreeing to be extradited.
Okay. You know, I have to be honest, I have not followed the last 24 hours, but it is a movable feast, and we're going to get an update and briefing. Lisa Bramlett and Tom Keenan, New York, John Farrell on a sabbatical somewhere between Heathrow and Cornwall. Anna Herrera joins now, spearheading our coverage on crypto off the London desk, and that's important, folks, because this is not a U.S. story. It is truly a global story as well. And I want to get to Binance in a minute, which is fermenting, but on FTX yesterday, simply, what did we learn?
Well, obviously, we learned, first of all, we learned that, you know, he wasn't doing any of this alone, right? His top lieutenants pled guilty. And we learned a bit more about what was going on behind the scenes. And it seems that, you know, as other firms, they got swept away by the collapse of Terra, which was this big stablecoin project. And Alameda Research, Sam Bankman-Fried's hedge fund, sort of got dragged down, didn't have any more money to repay lenders. And so regulators alleged that they got money from FTX customers, and that there was really never any separation between the funds of the two firms.
It may not be language you would use, our reporters in New York, but the phrase is thrown under the bus. Are the legal authorities setting up these secondary officials to, and I'm saying this, folks, with quotes around it, to get Bankman-Fried, or is that too unsophisticated of an analysis?
Well, you know, you obviously will get more if the people that worked with him talk, but they've also said in the same video you were showing later on, the district attorney reminds people that also work there, you know, if you know more, now's the time to come talk. Our patience is not unlimited, which is quite eerie sounding, right? There were other people that work there, and so I guess the more information they can get will be good. And we're waiting to see if Bankman-Fried, that now is in the U.S., will plead guilty too, or what will happen.
Anna, how much pushback is there to this idea that Sam Bankman-Fried will get a bail deal, will be able to go out on bail once he comes to the U.S., which my understanding was one of the ideas of returning to the United States?
Well, I guess it depends pushback where. Obviously, if you look at where the crypto crowd expresses their feelings on social media and Twitter, mostly, I imagine a lot of people won't be very happy because, you know, for many, this was the latest hit. A lot of people in crypto had money in FTX. And so, you know, this was a big shock for everyone. So they might not be super thrilled if he gets to go out on bail, and the bail isn't very high. But, you know, we have to see what happens.
I'm going to ask an unfair question because it's something that's been fascinating to me as I've read through all of the documents. Someone who was raised in a privileged home, the son of Stanford professors, had every privilege available to him. What was the psychology that people are talking about through why you would perpetuate a fraud like this? What was the purpose?
I wish I had the answer to that. I don't know. You know, we wrote about some of the conflicts or potential conflicts we thought between the two firms in September, and we'd spoken to Sam Bankman-Fried and Carolyn Ellison, and they assured that there was separation between the two firms. So now to see what was going on behind the scene is quite jarring for us too. But, you know, I'm not a psychologist, so I don't know what was going on.
And I want to get out front of next week, and next week to me is Binance. I've been following this, frankly, folks, far, far larger than FTX. I've been following the Binance story unfolding. You have the advantage of being in London, where we don't even know really where Binance is domiciled. There's, you know, talk of Cayman Islands, but who really knows? Should we be focusing on Binance?
They're the biggest exchange by far now, right? And historically in crypto, big exchanges have had ups and downs. Some of them have resisted. So obviously it's kind of legitimate to start asking questions about Binance. Not because necessarily there will be something bad, but because it is fair to ask questions. And even as we've seen, clients have started pulling money from exchanges because they're concerned that something will happen like it happened with FTX, Celsius, Voyager, all these other firms before them. So, you know, it is perfectly legitimate to start for you know, for the public to look at what remains standing.
Anna, thank you so much. Anna Herrera with us with Bloomberg News in London. A brief here on crypto forward. Lisa, I think this is a huge deal. You and I have to be so careful about the innuendo, the speculation, the rumors out there. We're not in that business. Bitcoin 16,800. I guess like a rock is how I'd put it. But I'm intrigued by the adults out there in the zeitgeist are writing about Binance as much, if not more, than FTX.
Especially because they've just acquired the bankrupt crypto lender Voyager Digital.
Saw that. Yeah.
And, you know, how much is this trying to be a show of strength that they can continue to be an acquirer, a consolidator of market share? And how much is this something else? Also interesting with the accounting firms pulling away, one of the biggest accounting firm saying that it was going to step back from the crypto industry.
Well, they're doing proof of reserves. This is Mazer of South Africa, which is respected. And they did a sort of audit, I'm going to say as an amateur. And then folks, they just stepped away 5-6 days ago. They just said, no, we're not going to do that on Binance. And, you know, again, I go to, the name is not in front of me, the esteemed former SEC official now at Duke University, who said, look, here's the red flags, let's count them. And that's sort of where we are this morning within our reporting. Katie Greifeld, Kaylee Lines, Matt Miller, I think is involved as well. And the crypto show will get there. I guess they do a crypto show next week.
Well, it's the day
How
after
do you plan
Christmas.
for it? You start planning Monday, I think, for the story's moving so fast.
Can I shift gears a little bit?
Please,
While we were talking, CarMax.
It's shift gears
My
Thursday.
hard pivot Thursday. CarMax actually earnings came out, which was a huge shift. Those shares are down almost 13% in pre-market trading after reporting quarterly earnings that were well short of expectations. And this follows on to your question about why is it so expensive to rent cars, right? And this doesn't give the answer, but it speaks to the massive and quick decline in prices of used cars and how that's filtering in to one of the biggest used car dealership operators out there.
So 10 to 150, back down to 50, back down to where it was 6, 7, 8 years ago.
Yeah, we're talking about adjusted profit, 24 cents a share. The estimate of analysts was 65 cents a share, so pretty significant underperformance, even after downgrading how much they thought they were going to be earning.
Are you front-running your equity report in 6 minutes?
There's plenty else to talk about. I honestly, I find this really interesting because I've been talking about, sure, and we'll just keep going through the break with lots of equity calls. The reason why I find this interesting is because we've been talking about the disinflation. It is coming in pockets. And used cars is one of the biggest pockets and one of the biggest inputs. Vehicle sales are one of the biggest inputs into CPI print. So we might see a deceleration now. And this could be a big part of the reason why.
I'm amazed with the buys and the outperforms on the street.
Are you being snarky?
No, I'm not being
It's
snarky.
holiday season.
I know it's holiday season is I got to get to February in my employment. I'm trying to do that, but you know, on Car Dog, I've got 13 buys, 6 holds, 2 sells. And there's some people that have recently stepped into this thing.
Well, people were thinking that perhaps we'd gotten to the lows, that perhaps we are set next year for car prices, used car prices in particular, to pick back up and new car prices to roll over. Well, this kind of flies in the face of that a little bit, and it's a surprise to a lot of people.
Chris Bottiglieri, BNP Paribas Exane. He looks like a genius right now.
Well, Chris.
He's lonely, but he looks like a genius right now.
Lonely, but a big stocking.
Futures -10, Dow futures -84, the VIX 20.26, yields churning, everything churning, dollar churning, yen on 132.11 as well. Mark Cabana for Global Wall Street, an important brief. We will do that. Mark Cabana, Bank of America. Good morning.
CEOs are reshaping the C-suite. Bloomberg's chief future officer shines a spotlight on these dynamic leaders.
Today's CFO has to be much, much more than a bookkeeper.
One of the most important things is looking around the corner.
We have to let go of the traditional legacy department store.
Their impact goes far beyond the balance sheet. And on Chief Future Officer, they focus on much more than just revenues and margins.
You also have to be credible business leaders in order to really impact the business and steer the direction.
We are like biologists. We need to deeply understand the financial DNA of a company.
People just come with a playbook and say, okay, we're going to roll that. Don't do that. Think longer term.
It's an amazing time to be in this role. It's a lot more than the profit today. It's building the future of tomorrow.
Get passion, perspective, and more from the chief future officers of some of the world's most influential companies. A new episode every month, only on Bloomberg.
Surveillance. John emails in. He's 10 miles outside Heathrow on his way to Cornwall. Good morning, John Farrow. He says, Tom, do a full data check for me at least. Let us do that right now. Futures -10, Dow Futures -81, the VIX 20.26. I'm looking at a Bloomberg Financial Index, which screams accommodation. We'll talk to Mark Cabana of Bank of America about that in a moment. Dollar's given me a churn this morning. Yen, focus there, 132.10. A stronger yen, but not through the 131 handle, which was yen strength off the shock of the week, the Bank of Japan. Oil with a lift. This is important. Lisa touched on this earlier. I'm going to round it up. West Texas Intermediate, 80 a barrel. Brent Global Crude, $84 a barrel. Gold well out over 1,800. Good morning, Dennis Garvin, 1824. The ounce is how they quote that on gold. And curve is really not part of the story. The real yield, not part of the story. That'll about do it for a data check. The 10-year yield, 3.65%. They're individual stories. Lisa demands that we redux CarDog from 7 minutes ago. Go.
So I don't know if you've heard about this company, but there's this company called CarMax.
Really?
They just
I didn't know
reported
that.
earnings, and the earnings came out way below what people were expecting. And this is interesting because the reason why this talks to your two Americas. You talk about the deciles
Yes,
of American
thank you.
incomes, affordability issues. It is getting so expensive for many families to afford used cars, especially when you finance them at rates 10, 11% at this point. You are seeing those shares plunge by at one point 18%, now down 12% ahead of the open after that report. Micron also coming in below expectations yesterday, talking about how they weren't going to make a profit next year because of the inventory glut, the sort of push-pull, the start, restart, stop kind of pandemic reality, and those shares are lower by 3%. Western Digital, a competitor, those shares down in sympathy 1.2%. You're seeing that for some of the other competitors as well, including AMD. How much is that going to really be the story that the tech pain continues, kind of like what John Golub was talking about, through a year, even though a lot of people are expecting some sort of rebound?
Is that it?
Yeah, do you want me to keep going? I can keep talking.
You
I can
nailed
go
it. You give me
on
some
and
good
on.
news. Do you have like a Nike good news story today?
Nike is still good. If you want to buy Air Jordans for my son, go for it.
Well, I saw I was going to get a pair of the Mbappe, the French.
Yeah, how much were those?
You can't get them. Farrell, I think, got the last pair. He was seriously looking at them. He's looking at the Diodora red sneakers. I remember those.
He's reprising his childhood dreams
He
in
is.
terms of his
He is.
gifts. And he's not alone. A lot of people do that.
I'll look those
Wait,
up. We'll give you an image of those
what
folks
was
on
your-
radio and TV.
What was your childhood dream for a gift?
Oh, it was bow ties.
Little Tom Keene with little Hermes.
No, it
bow
wasn't
ties
Hermes.
No, it was not.
Yes, I didn't start. I wore a clip until like 2 or 3 years ago as well. Right now, and this is really important, as we talked to John Golub earlier, there are 219,000 people at the Bank of America And Mr. Moynihan called in this morning. Only Mark Cabana is working today for the Bank of America. He's global head of U.S. short rate strategy at Bank of America. Thrilled he could find time creeping into the holiday. Let me go to short rates first, Mark. What is the efficacious way to play the fixed income market into next year if I'm scared stiff? How do you do it if you're afeared?
Yeah, well, we think that the path of least resistance is still going to be for the market to try and nudge up the terminal rate at the front end. The market right now is about 25 basis points below where the Fed's dot for the end of 23 will be. And if you're a little worried about the outlook, we think that you want to be leaning long the back end. We think that that is going to be a way to protect yourself against a slowing economy, likely declines in employment, likely higher unemployment rate, moderating economy, and that's going to give the curve still a bit of a flattening bias, at least in the near term. So
Mark,
again, we do think that. Go ahead.
Well, your charm is you speak in English. There's a lot of people in fixed income where you can't understand it, lining up behind Bramo here. The number one question I get from people on the street is how long is it going to take to make up a 15 or an 18% loss in fixed income? And you've got an encyclopedic knowledge on this. Is this a 12-month exercise, an 18-month exercise? How do I get back to break even on fixed income? How long will it take?
Well, it depends on what your benchmark is. But look, we do think that fixed income is going to have increased value for investors over the course of the next 12, maybe 24 months. And that's simply because, again, you're going to be seeing yields that are probably going to be moving lower. You're going to be seeing yields that have value in portfolios again, as they serve as a hedge to risk off moves, where yields, when we see risk off, will go down as opposed to up. So prices will increase, not decrease, as we saw over the course of 2022. And that is going to mean that investors should be thinking more constructively about fixed income broadly, simply because you're going to see that risk off value return to fixed income, which it really lost over the course of 2022 with very, very elevated inflation. As inflation moderates, we do think that that increases the attractiveness of fixed income and portfolios. And the way that we've been recommending clients play that is by being long towards the long end of the curve, viewing the long end more constructively. You could still see yields rise at the front end to some extent if the Fed has to keep hiking over the course of next year. But we do think that the long end, you're going to be somewhat protected because we expect that most yield increases are going to be bought by investors who see long end yields as increasingly attractive around 3.75, or should we push back close to 4%? We think that there's going to be a lot of interest from fixed income investors around those levels.
If the word of the year in 2021 was transitory, the word of the year in 2022 probably was pivot or step down or whatever you want to call it when everybody groaned. You could argue there are a couple other words in there. What's the word of the year in 2023 that everyone's going to kind of hang on to as the holy grail?
Yeah, I mean, I think the market's looking for a pause from the Fed. That's going to be at least what the market's looking for from the Fed. The word of the year will probably be recession, or maybe not a recession. Certainly, it's quite consensus that we're going to see the U.S. economy and likely the global economy slow down over the course of next year. And how quickly or slowly that happens is going to really be the focus in markets. Right now, the market is looking for a turn from the Fed, looking for a turn in the economy, it seems, around the middle of next year. And whether or not the labor market cooperates, we think, is really the question of 2023.
So Michael Hartnett, your colleague over at Bank of America, put out a note today where he was talking about the 60-40 portfolio hanging in there, how he likes small cap stocks. And he talked about how bonds should do well in the first half and not so well in the second half. And it sort of coheres with this idea that stocks will do badly in the first half and better in the second half. What happens to that call if the recession is pushed out, if there is this momentum driven by consumer sentiment that has come in much stronger than expected?
Yeah, then the value of fixed income is going to be deferred for a time. Certainly, if we see the economy that continues to do reasonably well, again, you're going to see the front end continue to sell off as the Fed is biased to keep hiking, keep moving terminal more elevated. And with that, you'll probably see the back end nudge up a little bit. The curve will become more inverted in that type of environment. And you'll have to wait a little while to really see that performance in fixed income that we anticipate. Look, the market believes that the Fed is going to be successful in engineering a slowdown. It's just a matter of how high does the terminal rate have to go? How long does it take to achieve that outcome? but we ultimately think that they will be successful, and that's why we continue to have a constructive view on long end duration. We continue to think that 10s are going to be rallying to about 325 or so by the end of next year. And it may take more time for long end fixed income to really perform well. But we do think that you're going to see that performance over the course of 2023. Right. We certainly saw it in the last few weeks of 2022.
Mark, one more question, if I can. Buried in your note is really the tone of the moment. I'm really taken back by this from fixed income strategists. You guys are becoming closet economists. You're looking for, quote, labor cracking. Have we ever done this before? Have we ever modeled our fixed income space off the dynamics of the American labor economy?
I think that probably implicitly we have in the past. But what's different about today in 2023 is that we're all anticipating a recession. We're all anticipating a slowdown in the economy and the labor market. And in order to really see the front end of the curve start to perform, in order to see Fed rate cuts that are going to be pulled forward and justified, you really need to see the labor market moderate. And that's not happening yet. So in many ways, this is the most expected, most anticipated recession ever. And really, you need to see the labor market begin to moderate in order to think that the Fed will be able to pause and eventually then move towards rate cuts.
Mark Cabana, thank you so much with Bank of America. And Brian emails in and says, no, Tom, there's a few more people working at Bank of America today besides Mr. Cabana as well. Long ago and far away, there was a reporter at Bloomberg, and I would go, oh, she can write. Her name was Lisa Abramowitz.
Never heard of her.
Lifetimes ago. The brethren of Abramowitz, the reporter, have a shocking story out of Europe today with a small bank named J.P. Morgan. This is Donald Griffin, Laura Benitez, and William Shaw. This is the kind of small story that comes out in the cold of December 22nd. Lisa, if you're in CDS and you get the direction call wrong with leverage, bad things can happen.
Yeah, right. What goes up big can go down big. And basically, this story is about a $70 million loss, at least, of credit write-downs on J.P. Morgan's books that a lot of people are looking at and kind of grumbling about. And to be fair, it just came out, and I'm looking through it right now. But on my first read, it seems like the real story here, the meat, is a relatively illiquid market and a very big market maker, J.P. Morgan, that can push things around. And that is some of the allegations that people are talking about in terms of transparency and ability to put marks that accurately reflect where they would trade in a free market.
The reason I highlight this, besides it's Bramo's wheelhouse, like seriously, this is the day job for her, is the idea that it's not a lot of money for Mr. Diamond. I'm going to assume he's not staring at the ceiling at night worried about Mr. Canepa and what's going on. It's a rounding error. But this is the game, folks, of price up, price down, yield up, yield down. When you provide it over to CDS, credit default swaps, we don't have time to explain that here. Bad things can happen on a micro basis.
There's also a bigger story about liquidity, and it's an important one, especially in the European credit market, which is becoming a lot less liquid, especially in light of the sudden withdrawal of free money. If you start to have more pockets of illiquidity, people without the willingness to buy and trade to the same degree that they have been, who are the people who push the prices around?
Who's on the other side of the trade?
You start to get some more questions around that typically come out. We heard about this certainly in 2009 and 2010 with portfolios of CLOs and mortgages, and also just in general high-yield bonds, and who is selling them, who is on the other side, who is working together, et cetera, et cetera.
That was really, I haven't seen Bramo that fired up, folks. Well, send in your emails and tweets, folks, as you can. Bramo to the core religion of debt structure. Thank you to Donald Griffin and all in London for that report. Stay with us. This is Bloomberg Futures, -12.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. UK household income fell for a fourth straight quarter, leaving Britons on course for the worst period for living standards in memory. Adjusted for inflation, disposable income per person declined 0.5% in the third quarter, according to the Office for National Statistics. Gross domestic product also fell. Pubs and restaurants in London say last week's rail strikes cut their sales to almost half pre-pandemic levels. Trade group UK Hospitality says revenue was down 46% compared to the same week in 2019. Industrial action is sweeping the UK with walkouts by workers in the Royal Mail, health sector, airports, and various parts of civil service, as well as those by rail and bus staff. And more transport disruption is expected over Christmas and into the new year. Japan approved one of the world's first blood test kits to detect signs of Alzheimer's disease. Seismix Corp says its test measures an abnormal protein that jams nerve cells in the brain and is a marker for Alzheimer's. Now, the kit will give doctors in Japan an easy, inexpensive, and minimally invasive tool to screen people quickly for the disease, which is currently done through PET scans, MRI, or painful spinal taps. In Spain, one of its most iconic events, the bumper Christmas lottery known as El Gordo, is underway. The most sought-after prize shells out 400,000 euros to holders of winning 20-euro tickets. The incredibly popular lottery will dish out a total of 2.5 billion in prizes, much of it in hundreds of smaller prizes. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Lisa Mateo. This is Bloomberg.
When you think space, you probably think one space agency that travels under the radar is ESA, which is surprising considering what the European Space Agency has achieved and how vital it is to the global space industry.
We've collaborated with pretty much everybody who is involved in space exploration.
But ESA wants to be a leading force in furthering humanity's mission into space.
Commander Ground, do you copy? Copy.
If we want to have successful human missions to Mars, we are going to have to learn to live and work off-world in a different way. The place where we are going to learn to do that is on the moon.
Can ESA help humanity take its next giant leap?
The top names at the Fed are on Bloomberg.
I do see growth slowing. But remember, that's part of the mechanism of getting demand into better balance with supply and alleviating those price pressures.
We're clearly not in a recession right now based on the data. It is an economy that is growing only modestly, and I think it's an economy that's really seeing the imbalances between supply and demand diminishing and inflation coming down.
Nobody covers the Fed like Bloomberg, your global business authority. Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question. Great question. Best question I get all night.
Bloomberg, top experts, great questions.
I still think the preferred habitat is in the U.S. I think Europe has their struggles, of course. They're fighting a different inflation monster. I think the U.S. is, much more on the path of normalization.
Greg Peters on fire yesterday. He is esteemed in the fixed income space. What did we learn from Greg Peters yesterday, Lisa? I thought that was really good.
Just the difficulty, frankly, and the idea of how tough this year has been and how tough next year will be. This idea going forward that there is value in bonds, but it is not wholesale and it is not just rearing to go at the start. It's the sequencing. We keep hearing that. It's the sequencing. First sovereign, then investment grade, then high yield.
I didn't really pay attention to Greg Peters yesterday because I was doing my Christmas card list. I send out one Christmas card.
I was about to say, how long is the list?
It's just one card. It's one card.
Who's it to?
I take the pen. I'm writing here. Dear, should I call him Mike or Mr. Bloomberg? Dear Mike, comma, thank you. Santa.
Yeah, exactly. Well, thank you for revealing that, Tom. I appreciate it.
It's one card.
Well, it was. I was listening.
Can do 2 cards.
I was listening, and I thought it was interesting. Sequencing might be the word of the year for 2023. That's my suspicion.
What we've got is to look at the Fed and the economy now, and we do that. We slow down here for a moment with Rabila Faruqi, who slices and dices domestic American dynamics for Carl Weinberg at High Frequency Economics. Their notes are absolutely brilliant and deep. And yet there is a headline, Rubila, that just stops you dead in your tracks. Chairman Powell is not sufficiently restrictive yet. How far away from yet are we?
Thanks for having me. The Fed has made it very clear they're not done. They still need to move rates higher, and they need to keep them higher. So, from all indications, we're going to end up slightly above 5%. We are following the Fed's lead. We don't believe in fighting the Fed, and we think that that's exactly where we are going to end up. Is probably another 75 basis points from here after over 400 basis points this year. So 75 basis points, maybe even a percentage point, depending on what happens with inflation and in particular the labor market.
The hallmark of your work and Dr. Weinberg's work is to study crisis and calm down. Carl Weinberg is steeped in this, folks, back multiple decades. What I hear from you, Rubila, is we're going to get out to whatever restrictive is, and we're going to continue. Talk to the people now who are scared stiff of this path of higher interest rates. How do we survive it? How do we move on like that as Carl Weinberg has moved on from 7 other global financial crises?
But if you look at what the U.S. economy, how it has performed, how wrong we were about inflation, how wrong we were about the Fed, and how wrong we were about the economy and the resilience of the consumer, really we should be humble about what we think what 2023 is going to bring. Our baseline is that the U.S. economy will avoid recession. We're going to go into a very sort of below potential growth rate scenario, but there is enough momentum, there is enough support for households that the U.S. economy is going to avoid recession in 2023. Again, as I said, we need to be humble. Right now, the labor market is very tight. The Fed is not going to back off in its inflation fight because inflation is just way above where it needs to be. So this is the scenario. We've seen the economy perform. We've seen the economy do okay. We expect to slow down, but I think there is enough momentum in the labor market, in underlying strength in U.S. households that's going to keep this economy growing over the next year.
Where is the humility right now in the 4.8% terminal rate that's baked into market expectations versus the 5.5% expectation that you're talking about, and a whole host of other strategists coming out and saying the exact same thing that you are? Look at the economy, look at consumer confidence, look at sales. Everything is still going very strong, too strong for the Fed.
Well, I think from the market's perspective, it probably has to do with the fact that the Fed, the lagged cumulative effects of policy, right? I mean, we've been waiting for this economy to respond to rate increases. It hasn't happened. The labor market certainly hasn't responded. It is going to happen. We expect a pretty substantial step down in the first half of the year. And I think that's probably what the markets are pricing in. And then also there's the belief that the Fed is going to blink, right? This Fed is not the pre-pandemic Fed that was looking at a long period of low inflation. This Fed is very resolute. They have made it very clear. So I think there's a disconnect between what the markets are thinking and where we're actually going to end up. But I think markets are probably expecting the Fed to sort of back off once the economy starts to slow.
Can the Fed reach its goal if the market does not cooperate, if we don't see a tightening in financial conditions?
I think that's a great question. I mean, that's where, how does the disconnect get resolved? And we really don't have a good answer to that. If you look at financial conditions, if you look at what's going to happen, what's already happened with, lending standards, what's happening with rates on auto loans, and what's happening with rates on credit cards. Financial conditions for households have already tightened. Now, and you've seen the equity market, it's not as weak as it was, but I think the Fed is looking at a broad array of conditions. I'm not really sure how this disconnect is going to get resolved, but, we need to be clear, the Fed is not, this is not a Fed that's going to back off, what they intend to do, which is to bring inflation back to 2%.
Rubila, what does trade dynamic do? I mentioned this yesterday, folks. There's a domestic side of the core GDP function, and off the back end, there's exports, good stuff going out of the country versus all the stuff coming in, including petroleum. What does exports minus imports do next year, Rubila? Is that something germane that we need to study?
Well, I think first of all we need to understand that trade is not as as impactful on the U.S. economy as it is on, let's say, European partners. But what we have seen, what we saw this year was imports were just so strong, and then we went into sort of a huge push from net exports in the third quarter. We think that this is going to start normalizing. We think goods demand, especially as imports are going to start normalizing, and then exports. That's where the uncertainty lies. I mean, if our trading partners are as weak as we expect them to be, then we're going to see that drag from the trade part of the equation. But I think that the impact is going to be a little more subdued compared to what we've seen. Those huge swings that we saw this year in 2022. I think that's probably going to dissipate in 2023. Again, it's a difficult call to make, especially if China comes back online. But this is what our baseline is for now.
Rubila, thank you so much. Rubila Faruqi with Carl Weinberg at High Frequency Economics this morning. Surveillance apology, and I'm also getting heat. I'm getting massive shade when I say Bitcoin BitDog. Okay, that's not a scandal, but that's like what it is. And then I mentioned lightly, and sometimes I misspoke, and I apologize for those that I offended about CarDog. Except I had no idea. I'm so ignorant on this, folks, and I need to apologize that there is CarMax and Carvana. One's out of Richmond, Virginia, one's out of Tempe, Arizona. But to your good wisdom, you smarter on this than me, Lisa, they both, I think I can use the phrase cratered without offending anybody. Well, I mean, it's a statement on the used car business, right?
There's a whole host of issues here. Okay, CarMax shares year to date down 54%. Carvana shares down 98%. That is a whole story unto itself, a question about the sustainability of an online used car sales dealership at a time when everyone is becoming a tech company and going online, and you're seeing that with other dealerships as well. CarMax is more of a clean read on the state of the used car market, how much you end up with a situation that you see a continuing devaluation of some of these prices. This, to me, is the fullest read on how difficult it's getting for people who have to use credit to buy big items, how difficult it's getting. If you're talking about an 11% interest rate to finance a used car, which prices have surged tremendously over the past 2 years, it becomes punitive, it becomes impossible, and that's why you're seeing demand decline pretty significantly.
These are high revenue companies. I mean, folks, this happens. Every once in a while, I'm like wicked ignorant. That's where I am on this. I mean, and they dominate this business of I can never afford a new car. It's out of reach. And this is the digital combination of the 4 gazillion used car lots that we've all been on. And you can't afford the financing.
Well, they can't afford the financing. You also have a glut of cars because there had been a lot of fleets from rental companies that they were now selling. And so the prices went down quite a bit. This is really important, though, for overall inflation metrics because the disinflation that we're seeing, the deflation in used cars.
How does a girl that takes a crosstown bus know so much about this?
Things happen. One thing led to another. I think this is fascinating. This is such an interesting pocket of the inflation story.
The Brammo's on fire today, folks. CarMax, Carvana, forever. Stay with us. This is Bloomberg. Good morning.
So now you've been at JP Morgan for about 25 years?
Yes.
Okay, and now you run one of the most important parts of JP Morgan, which is, I say, is the asset and wealth management business. What actually is wealth management and how is that different than asset management?
Great question. The two are often used interchangeably, but they have distinctions. The asset management business is where we manage money on behalf of individuals, institutions, sovereign wealth funds, pension funds. We manage them in mutual funds, we manage them in ETFs, we manage them in single stock, single bonds, hedge funds, private equity, and the like. And that is the heart of the fiduciary business that we run here at JP Morgan. Wealth management is that plus understanding someone's entire balance sheet. So for the individuals where we manage money, we also help them with their mortgage. We help them with a loan that they might need. We help them with their basic credit card. And so wealth management is trying to help someone with their entire life, both their assets and their liabilities, their planning, their gifting, the legacy that they want to leave for their families, the 529 plans they need to prepare to get their kids to go through college. And it's a great insight into people's, entire journey.
Lots happening on Wall Street.
I'm quite encouraged. The center is holding.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
A lot of these areas still have very, very good valuations.
From businesses most influential and instrumental.
It's knocking it out of the ballpark.
Now's not a great time to be speculative. It's time for a pivot.
We're talking about a significant hit to our standard of living.
Bloomberg Wall Street Week, live Friday with replays all weekend on Bloomberg Television and Radio.
Steve's ability on the course may not be etched into any record books, but following him around, it's clear that it's not for lack of trying.
Jeez.
We were constantly hustling behind him as he caught up with executives in the portfolio companies and reminisced with former and current players.
He's a day trader. He taught himself, self-made day trader. Yes. And so he's on the bus after a game in New England, and he's day trading on the bus, and Bill Belichick sees him and cuts him on the spot.
In many ways, it's a convention, right, of the people that I don't see maybe once a year. And so it's kind of all come together. My firm, our charity, fundraising efforts, and then the friends that are around. My dad and my brother, it all happens right there as a confluence of all these parts of my life that have found its common center.
The top names in business are on Bloomberg.
I think you have to assume that we have some bumpy times ahead, and you have to be a little bit more cautious with your financial resources, with your sizing and the footprint of the organization.
So what can you do near term? Test to make sure you see at the margin you can move things around, manage your expenses very carefully and invest in efficiency and effectiveness, but also continue to spend money where you have competitive advantage.
Nobody covers business like Bloomberg, your global business authority.
Every Friday with 30 minutes dedicated to fixed income, I'm Jonathan Ferro. This is Bloomberg Real Yield.
The pivot will come next year, but not until risk assets have given up a little bit of the gains.
We think there is a recession both in the US and in Europe.
Every central bank is doing quantitative tightening next year. They're hiking pretty aggressively. We've really never seen this environment before.
They're going to stick to the course, and therefore we have risk of more serious recession.
By the traditional frameworks of how you would call a recession, we're just not there.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowitz.
Stumbling to the end of the year with car talk and concerns about disinflation. Welcome back. This is Bloomberg Surveillance. I'm Lisa Abramowitz, Tom Keene. Jonathan Ferro off evidently on a bus. Where is he now right now?
He's just left Heathrow.
Oh,
he's sort of south of Bath, as they say. They say Bath.
Okay, well, I'm sure he'll be
he's
very
on his way to Exeter, and Cornwall. There's like palm cheese. I guess that's where he's going. He said to his family, "We're going south."
Well, they're not driving themselves, and
no,
perhaps in the U.S., if you are driving and it is getting more expensive to borrow money, but it is getting cheaper, evidently, to buy a used car, and that is a terrible thing for some companies that have seen a huge inflation on the bubble that you've seen in prices up till now.
This is the anecdotal that's so important as we stagger into the new year, and it happens, Lisa, with your reporting on Nike and FedEx. Yesterday, FedEx, massive logistical litmus paper, but we're sort of very new car, used car here today, and what's great about this is we got listeners in Manchester. A guy sends in, he's got a photo of Manchester United jersey. Joel says they call him Ford Old Trafford, which has something to do with a stadium in Manchester, England. They called him up to buy back his new car that he owned or he bought like a year ago or something.
For more money.
I've never heard of that.
I know. This is
I've
something,
never heard of that.
but it speaks to the bubble in prices. and it's deflating. And this is one massive component. It's something like 10% if you put used and new cars together in terms of the component
Which is a big
factor
part of our budget.
for the CPI, for what the Fed looks at for consumer price inflation. Suddenly the bubble has burst, right? And you are seeing some sort of disinflation because people can't afford it. They can't afford it. Well, financing, they can't afford the prices after how much they've climbed.
You know, you're going to do the data. We're going to go to Lee Farage here. But the bottom line to me is, is inflation dynamics and frankly the rest of what we do every day now as great a mystery as it was 12 years ago when we were very transitory. I think it is.
It's inconsistent. And I'll give you the other side of the story, which is the new car story. And this speaks to the many Americas, the many residents around the world that have very different fortunes. Used car prices are still rising. And that is because people can buy them and they can buy them in cash. You are seeing this with home prices yesterday coming out higher than people expected, increasing even as sales plummet, people buying in cash. It's the haves and the have-nots. Put that together, what kind of inflation picture do you get?
We don't know, and the answer to me it's complex, yet others go to the aggregate. What I do is listen to the great David Rosenberg, who I think slices and dices like no one, and he says, look, we're in a disinflationary trend. That's what Rosenberg is.
And that's what we've seen in yields. If you take a look at what's going on in markets today, there's a little bit of a decline in two-year yields, despite some of the increase that we've seen in consumer confidence. Again, I'm trying to pair this, Tom, with all of the discussion we hear about how the Fed is going to have to curtail the optimism, the dynamism, the momentum in the U.S. consumer.
Do we agree that's a consensus right now?
That seems to be an increasing consensus. Two-year yields lower, 4.2% after being substantially higher earlier this year.
As Peter Hooper said with Deutsche Bank, Lazzetti's got a 5.1% terminal rate, and we're all going to die.
Yeah, exactly.
That's the theme.
Exactly, and you're seeing 0.2 of a decline on the S&P, but really it's been resilience heading into year-end, especially in the face of a lot of negativity. 3,897. Crude higher, a bit higher for consecutive sessions now, 1.4% increase on WTI, $79.37 a barrel.
China opening?
China opening.
Even with the heartbreak of COVID we covered an hour ago?
Where is that story in this crude price? That is my question. Do we see the reopening of China in that crude price, or is this just basically people shrugging it off because you're not seeing the real increase in economic volume yet?
You know, an 80 print on West Texas Intermediate, a lot of people, Jeff Curry, Francisco Blanche, and others, push against Ed Morrison. They say we go back to 100. I guess they're opening. Bloomberg News reporting this morning, folks, of quarantine lift in China. Q+3, I think, is the new phrase. I'm not sure on that, but you know, there it is, and that's how you get oil up.
Meanwhile, we are looking at this disconnect with what the market is seeing with respect to rates and what the Fed keeps saying. Lee Farage joining right now, head of macro strategy for North America at State Street Global Markets. I want to start there, Lee. Why is the market not listening to what the Fed is selling?
It's a very good question. I'm not entirely sure. I think it goes back to what you've been discussing. You know, we have got these pockets of weakness. We have these areas, you know, some people believe we're in a disinflationary trend, and to some degree we are. So the assumption is, well, the Fed's being too hawkish. They're not going to deliver on what they're saying. And so the market is basically ignoring them. I mean, and don't forget, you know, the last Fed meeting last week, there wasn't much left of the trading year. You know, it's been very quiet this week. I do believe in January, though, the market's going to have to get closer to where the Fed is. I mean, we have a terminal in the market of 485. The Fed's at 5 1/8. You look at the end of 2023, there's a 75 basis point gap between what the market has and what the Fed has, and that's got to close.
How violently could it close? This is really the issue that I see heading into year-end, given how much is hinging on this rate and how wildly different these estimates are.
Yeah, I think once we get into the new year, I think it could close quite sharply, and this is why I think it's going to be a rough start to 2023 for risk generally in asset markets, because we have to get some sort of move in the market towards where the Fed is. You look at the data, there are pockets of weakness without a doubt, but look at that consumer confidence number yesterday. Expectations 82.4 were the highest since January. So the consumer looks forward in the economy and is most confident he has been, or that they have been, since January. And that is a problem for the Fed when they want to curb excess demand.
Can they do that? Do they have the tools, Lee? John Golub at Credit Suisse agrees with you strongly on this as well. There seems to be a belief a central bank can, quote unquote, curb excess demand. Is there proof of that?
Well, they can do it, but can they do it without causing the recession is the bigger question. I mean, they can do it, The problem is in the US, because we have such a high degree of fixed rate borrowing, the only real way the Fed can curb excess demand in the US is through higher unemployment. And you mentioned that the used car market is interesting. Yes, new activity in the car market, the used car market, has plummeted because loans now are, at a significantly higher rate. If you look at, the housing market, new activity has plummeted. But if you have your house and you have your mortgage, if you have a car on a fixed rate loan, your monthly payments have not changed even as the Fed is raising rates. So what's that done to your aggregate demand? It's not changed it. Whereas if you look at other countries, you look at the UK, 90% of mortgages are floating.
That's right where I wanted to go. And, John Farrell, folks, we bust his chops on this, but this is a huge UK distinction, a floating rate paper. Does that change the script for Governor Bailey and President Lagarde versus the fixed rate world of Jerome Powell?
Absolutely it does, yes. If you look at market pricing, the terminal rate for the Bank of England is only 20 basis points below the Fed's terminal pricing. That makes no sense. When you have the consumer in the UK is suffering significantly. You look at the GDP numbers we had this morning. So, personal consumption was down 1.1% in the quarter. That's the weakest since Q1 2021. But Q1 2021, the country in the UK was locked down. Nobody could spend anyway. So you're seeing the consumer really start to suffer because their mortgage payments are going up. Real earnings squeeze is greater there as well. Whereas here, as I say, if you have your house, you're not going to move, so new transactions will plummet, but your mortgage payment has not changed. 90% of US mortgages are fixed for 30 years. That is a big problem with the Fed when it comes to wanting to curb excess demand, a problem not faced by others.
So from this tangible reality of housing to the macro, how this factors into what your call is for next year, does this mean more dollar strength? Because there is this greater resilience to higher rates when it comes to housing, when it comes to cars, than, say, in the United Kingdom or even broader continental Europe.
Absolutely, Lisa. Yes, that's exactly what it means. What we're going to start to see divergence in the first sort of quarter, the first half of next year. The Fed is going to have to keep going because of this fixed rate environment we're in. Whereas you look at, the Bank of England going to fall by the wayside. We're seeing the Bank of Canada get towards the end. The RBA, huge amount of variable rate mortgages in Australia. The RBA are getting close to the end, maybe at the end. But the Fed has got more work to do. So that's going to be the thing that drives the dollar higher again in the first quarter. And I think probably the first half of next year, you're going to see the dollar sort of rally further and bounce back because you're going to get this divergence in policy.
Lee Farage, thank you so much. Greatly appreciated this morning with State Street Global Markets as well. I want to dovetail on the horrific weather we're seeing. It gets ice cold in New York City, days behind the rest of you across this nation. Good morning. On Bloomberg Radio. And Lisa, we've got some important imagery from our trip to Jackson Hole where you and I and John was really freezing. It was ugly. And it's like literally 42 degrees or 38 degrees in August there. And Adam Posen shows up in a short sleeve shirt from the Peterson Institute to talk a 3% inflation level.
Yeah.
Negative 26 this morning.
Okay.
On that same deck.
So just to be clear, this isn't live. This is a screenshot of a live frame from that moment that we look to be floating in a very cold space. And there is this question of the 3% inflation. There's also a question about the weather and why Adam Posen did not bring a jacket, but we'll get into that another time. Right. This is going to be one of the issues. Is there a stealth allowance of 3% inflation by the Fed next year?
This is to review this, and folks, this is the academic debate led by Olivier Blanchard, a colleague with Adam Posen at the Peterson Institute, off of research at West Virginia Commonwealth, Virginia Commonwealth, VCU. And the bottom line is where does inflation mentally change our behavior? That's the heart of the discussion. And Blanchard, off that research, is suggesting racing back to 2%, or as Bill Dudley says, below 2%, maybe doesn't change our behavior. We need some inflation higher to change our behavior.
The problem with this is if the Fed acknowledges out loud that their target is now 3%, get ready for 4% inflation to become the norm, right? That people will basically think that they aren't going to necessarily have the credibility to fight some of the inflation.
One of our interns this morning got that from the assistant director. It's amazing.
One of our staff.
From Georgetown, I think.
Yeah.
Oh, good morning, Georgetown.
40 people.
Futures at -9. Good morning.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. The Kremlin criticized the outcome of Ukrainian President Volodymyr Zelensky's visit to Washington and warned that Russia would continue to target weaponry supplied to Ukraine by the U.S. and its allies. A Kremlin spokesman says Moscow followed Zelensky's meeting with President Joe Biden and speech to the U.S. Congress and saw no sign of a willingness to listen to Russia's concerns. Meanwhile, President Vladimir Putin says that Russia has no limitations on military spending for the war in Ukraine. U.S. authorities allege fallen crypto titan Sam Bankman-Fried defrauded investors in his FTX empire, stealing billions of dollars over years for his own benefit. Now, top Bankman-Fried associates Carolyn Ellison, former CEO of Alameda Research, and Gary Wang, co-founder of FTX, are accused of helping him. They've pleaded guilty to federal criminal fraud charges and are cooperating with prosecutors. The U.S. Securities and Exchange Commission and Commodity Futures Trading Commission also announced separate lawsuits. Bloomberg has learned China plans to cut quarantine requirements for overseas travelers in January. Under the new rules, the requirement to spend time in a quarantine hotel or isolation facility would be scrapped, and arrivals into the country instead subject to 3 days of monitoring. Overseas arrivals currently isolate for as many as 8 days. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Lisa Mateo. This is Bloomberg.
Countdown in Europe. From the financial centers of the world, Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis. Weekdays.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
When innovation strikes, Bloomberg Technology is there with the news and analysis you need. Every weekday, only on Bloomberg. The top names at the Fed are on Bloomberg.
I do see growth slowing, but remember that's part of the mechanism of getting demand into better balance with supply and alleviating those price pressures.
We're clearly not in a recession right now based on the data. It is an economy that is growing only modestly, and I think it's an economy that's really seeing the imbalances between supply and demand diminishing and inflation coming down.
Nobody covers the Fed like Bloomberg, your global business authority.
Bloomberg Surveillance. Good morning, everyone. Jonathan Ferro on assignment. Lisa Bramwitz and Tom Keene with you on a Thursday. Coming up 15 minutes, I'll say claims. That's an important distinction. Also, I believe a third or fifth look at GDP will do that. Coming up as well, Henrietta Trays on when politicians in Washington will leave for the mother country. There's still much at work, as Mr. Schumer out with headlines here, and we'll get to you in a moment with Henrietta Trays. We're making light of it. It is not funny. There is brutal cold across this nation, the kind of cold that kills livestock and causes real risk to people. We don't mean to make light of it. And one of the things as well, maybe for my youth, Lisa, because so much of citrus production is moved to Brazil, moved offshore, but nevertheless, we're on the citrus watch in Florida.
You and I have been Googling where the weather of Florida orange production. I'm looking right now. Daytona Beach actually has a pretty big orange grove. The weather gets down to 27 degrees tomorrow. It gets down to 28 degrees on Saturday. Tallahassee, Florida goes down to 18. We're looking at temperatures of 12 degrees in Dallas, Texas. This is unusual weather for areas that have relied on warmth and raises some questions about infrastructure, heating costs, as well as crops that already have seen elevated pricing.
Yeah, and I go again, and to bring this over to Europe, where there was a warmer autumn, I'll call it, and it just seems to be drifting away. Can you imagine this cold across Mr. Zelensky's Ukraine and, frankly, the adjacent nations?
I hope
it's just
that
unimaginable.
It's unimaginable, and I hope that everybody stays safe during the holiday season, because it's going to be ugly. There's going to be wind. There's going to be ice. I was looking at the conditions.
A looser broadcast of Bloomberg Surveillance than normal, because economics in the markets are pretty quiescent right now. I would suggest that the Bloomberg Financial Conditions Index shows accommodation out there, as we saw with a smart equity market yesterday. The VIX 20.23, signaling that good news in equities yesterday. Futures -10, Dow futures at -58. Right now, we continue on Washington, but digress from where Anne Marie Horton was on this historic moment yesterday, and we look forward to the domestic ugly politics of which Henrietta Trays is truly expert. She's director of policy research at Veda Partners. Henrietta, Senator Schumer out with headlines here off the morning shows, and they've got to get business done. What actually happens in those rooms on December 22, 23? What is the horse trading that actually goes on?
Yeah, absolutely. Great question. They're working with the parliamentarian right now and trying to coordinate with Senator Mike Lee, a Republican out of Utah, to get an agreement on something called Title 42, which is a controversial immigration component that President Trump put into effect back during the height of the COVID crisis, and which expires. So they're trying to horse trade a vote on that amendment in exchange for passage of a $1.7 trillion omnibus spending bill. And every senator and every House member wants that in their stocking this year. I expect they'll get it, but these fights take until the bitter end. I'm hoping that votes will start at around 30.
So to the imagery that we see in the South, and I will state, folks, I'm as guilty of this as anyone, removed from my life. But the imagery that we're seeing down South has shocked Washington and, frankly, shocked the nation of all political persuasions. How does that story change once this agreement is made? What is the new immigration policy, dare I say, of December 27th?
That's a great question. I mean, honestly, speaking with staff on both sides of the aisle, Democrats and Republicans, there are a handful of bills out there, and all of the business community and every economist is looking at the labor shortage and saying we need everything from seasonal workers to high-skilled workers. And there are bills out there to accomplish all of those things while simultaneously addressing the border. But we are too far into, unfortunately, the 2024 presidential election cycle to even get close to having an immigration bill passed in the next 3 days, let alone the next 2 years. So quite frankly, I don't think there's going to be a material change at the border. I imagine they'll find some sort of convenient off-ramp to get around Senator Lee's amendment, but it probably will not change a whole lot. And I'm not anticipating anything material to come out of reform, either at the executive level or via legislation on immigration before this year is out. And then again, as I mentioned, probably not for the next 2 years either.
Henrietta, after the midterm elections, people were talking about a move to the center, that there would be more of a collaborative kind of feel, more of a rejection of the truly hyper-partisanship of Washington, D.C. over the past decade or 2 or 3. How much does that actually fly in the face of what's actually happening as we count down to a deadline and are getting gridlock?
I mean, right now we're going to get a bipartisan deal on the surface, but you're going to see this bill pass with almost exclusively Democratic support in the House and hopefully something in the range of about 70 votes in the Senate. So the Senate will be bipartisan. The House will not be. And, you know, if you want to tie it into the speech yesterday from President Zelensky, it is notable that there were only 85 Republican members of the House there. There are 213 of them at least. That incredible event, coupled with partisanship at its most extreme, I think was really well illustrated. And that's what next year is going to look like as well. They're trying to tie in Department of Homeland Security funding. There are going to be impeachment trials. I'm not expecting any legislation will pass. It's remotely material until we get to the Farm Bill, which will have material implications for SNAP benefits, and then the debt ceiling, which we'll have to deal with around September, and will probably be a very ugly fight. And the reason we're getting this omnibus now is so Kevin McCarthy can wait to deal with the debt ceiling until September instead of having to fight that fight right out of the gate in 2023.
I'm glad you mentioned the debt ceiling debate. It has particular poignancy as you see borrowing costs rise to the degree that they have. How much do you think that will actually get a growing number of Congress members on board to reduce the deficit, to really pull back on some of the issuance?
None. There's no way you're going to see any fiscal austerity actually come to pass. There will be no spending cuts. There will be a lot of jawboning about it. They'll talk about it extensively. I imagine there will be headline risk, and we'll probably get down to the wire. But when you talk with staff, it's pretty clear they already know the path forward. And it's not even going to be via finding a new number to replace the $31.4 trillion in debt ceiling authority Treasury currently has. We already know it's going to be a suspension, which was a Boehner era development that would suspend the debt ceiling, give Treasury a blank check to operate through X date, because it's a lot easier to vote for a date than it is to vote for a $32 trillion debt ceiling. And they don't want those optics. So I'm not expecting any austerity from this.
Henrietta, you said the presidential race has already started for 2 years from now. You're a grizzled veteran at this. When do we hear from President Biden? When do we hear from President Trump? And when do we hear from another 10 worthies? Is that really what January awaits?
I think so. My latest conversations with administration staff were suggesting that right after the holidays, President Biden is geared up and ready to announce. That's contrary to what my original expectation was. I thought former President Trump would not announce, and that President Biden would therefore also not announce. But the incredible showing that Democrats had in the midterm elections has materially changed that trajectory. And from everything I see, Democrats and President Biden in particular are geared up to launch right after we get back from the holidays.
Henrietta, thank you so much. Henrietta Trey's Veda Partners here as Congress staggers, is typical, I should say, to a year-end closes. What are you looking at, Lisa? You're over there typing away. You're pounding things. What do you got going?
I'm just smashing on my keyboard like nobody else.
Future's -12.
What I was actually thinking about was what she just said, this question of the jawboning about bringing down the deficit, but no action would be taken and that they were going to continue to spend freely. How that's going to play into this belief that there would be a change, a shift, a lack of a fiscal response is interesting to me. I don't think that that's something that's talked about as much as perhaps it should. Other than that, the market's pretty quiet. People are settling in. It feels like the first day ahead of the holiday after what had been a really busy week.
Well, yeah, I mean, okay. First of all, we got blindsided rather by the Bank of Japan. I mean, am I right? No one saw that coming. I think that's a safe phrase.
Yeah, there were some tea leaves about a week earlier that perhaps they were open to some changes, but it took the market definitely by surprise.
Are we going to be surprised by claims here in 4 minutes? Make it 4
minutes? I think we have to wait and see. Stay with us because we're going to be looking at claims. I don't know.
Michael McKee, he's on a bus to Cornwall as well. Michael McKee looking at continuing claims. This is Bloomberg. Stay with us.
Teslas and the like make for good headlines, the reality is that even if every car on the roads today went electric, it wouldn't be enough to curb global emissions to avoid catastrophic climate change. Greenhouse gas emissions from transportation account for about 29% of total U.S. greenhouse gas emissions. So what about the other 71%?
Buildings across America burn fossil fuels to operate. What we want to do is make that all electric. Instead of burning oil and gas to give us the energy and electricity we need, we want to do 100% clean energy, all electric. We want to turn buildings into Teslas. Just like a Tesla or an electric vehicle is all electric with no fossil fuels, we want to do that with our buildings. And if we can do it in one building, we can do it in all buildings. And if we do it in all buildings, we'll reduce 30% of U.S. greenhouse gas emissions.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Bloomberg Surveillance, we welcome all of you here to Economic Data. Yes, Economic Data today, and coming out here on claims and such. We'll have that for you here in a moment. Claims is important. That is a weekly data. The 4-week moving average is something on the Bloomberg as well. But critically, there is continuing claims. Michael McKee with John and Augusta Cornwall says I should really focus on continuing claims. He said these are much bigger numbers. Initial jobless claims, let's call it 220. We'll get the number here in a moment. There's a number. Right 216, a more constructive number on claims. Don't have the 4-week moving average in front of me. But continuing claims still steady there, and maybe to watch in the weekly data to come. And then there's the third blush of GDP.
Can I just point out that the market really moved on this data, on the initial jobless claims, and perhaps it's just a nudgy Thursday ahead of the break, but if you pull up the 2-year yield, you see that pop, real boom, and you can tell that people are concerned about the tightness in a labor market that seems to be confirmed by this. Yes. How many downside surprises can we get? It is a strength, it is a resilience in a labor market, people not filing for jobless claims. That belies this point that people are looking at for some sort of downturn.
I've got a shock number as well, and that is GDP. This is really important. The third look at third quarter GDP ending September 30 is not 2.9%, and this is demonstrably more buoyant, 3.2% with personal consumption, a big lift. And what I do, Lisa, is I take 3.2% and I add it to the GDP price index, and I've got a nominal GDP of 7.6%, which is that buoyancy that John Golub, among others, was talking about.
And core PCE coming in revised upward to 4.7 from 4.6%. Again, all of this speaks to this strength, this willingness for consumers to keep spending, even though people are expecting a recession. If it's going to happen, where is it?
Well, there it is, and of course we've got curve inversion moving. It's a 2 basis points, not all that much, but negative 57 basis points. And we have the perfect guest to speak of this as well as futures roll over, futures in negative 20, Dow futures negative 122, and the VIX comes out immediately to 20.39. Suddenly, it is an interesting Thursday. It has been an interesting 2022 for Andrew Hollenhorst and Veronica Clark, economists at Citigroup. They were way out front on a terminal rate above 5%. I give them credit with Anna Wong of Bloomberg Economics as well, and they reaffirmed that this morning. Veronica Clark, I don't know if you've seen this data. We've been chatting about it, but to be very direct, this data confirms the Hollenhorst rate, doesn't it?
Yeah, it's a bit interesting to see markets move on a third release of GDP. You know, we've gotten this data a couple times already. These are revisions, but they were pretty big revisions. Yes. Both the headline growth number, stronger consumption, you know, that's all where you want to see the strength and activity is consumption and investment. And then I think especially that core PCE number revised higher. Markets are really hoping to see softer inflation now, and we're really not getting it yet.
What is your interpretation where the chairman desperately needs a lousy labor market? He's not getting it. But what is the study that you have of the disinflation path forward? Do you see a greater disinflation, everything considered?
Yeah, I mean, I think we will get some overall softer inflation prints in 2023, but it will be initially because of things like goods prices that are much weaker. We know that shelter prices in inflation measures should be softening with housing market that's already softer. But yeah, you really do need to see a loosening in the labor market to be convinced that third component, that non-shelter services, will come back down to 2%, because we really don't see a path for that to happen until the labor market loosens.
And we were talking about this with Lee Farage. There's a real disconnect here between your outlook for what's going to happen, between his outlook for what's going to happen, between the Fed's outlook with what's going to happen next year, and what the market is saying. And I'm almost surprised that the market didn't respond more, albeit this is the third read of a GDP for third quarter, and this is also initial jobless claims. But still, the evidence keeps coming in that you are seeing strength, you are seeing resilience, and that the Fed will make good on what they're saying. What will it take to trigger a reset in terms of market expectations?
Focused on the last two CPI reports, right? We've had two softer reports. If you just listen to the CPI data in 2022, it would tell you that the Fed was going to be more hawkish than they thought, than what most economists were thinking. So maybe that's the right move now. But I would really caution against that, because we could get into 2023 and we'd still have some upside risk, even things like used car prices, which wholesale measures are rising again there. And you do have a lot of upside risk to those non-shelter services. If you look at where wage growth has been, it's telling you that those prices should be higher still.
I'm glad you mentioned used cars. We've been talking about it all morning because CarMax came out with their earnings report well below what people were expecting. You're seeing those shares plunge. It's also raising concerns about its peer Carvana and other used car dealerships, and just generally this idea, this is where you're getting the disinflation. Prices for used cars that were sky high, where some people were saying were a bubble, are disinflating, are deflating. How much further does that have to go? Is that a 2022 story, or will that deflation continue next year?
Yeah, this is a really tricky component, because it's not necessarily telling us much about underlying inflation trends. This was the supply-driven type of inflation that we had as early as 2021. And we have had pretty big declines for the last two CPI reports. That's been a big reason why we've run below 0.4s, or that we were running. I mean, you see some of that, I think, again in December. But the best measures we have of where used car prices are going are some of these wholesale measures. We got data earlier this week from the Manheim Index that showed those actually are starting to increase again. So it's not a clear downward trend as we're getting into 2023. I think the issue there is, inventories of cars are just still very short, and that's keeping dealers from cutting prices too dramatically.
Veronica, if we get a Hollenhorst rate, there's just this belief out there the world ends as we know it. Now, I know Citigroup Economics doesn't believe that, but what does our world look like with a 5% plus terminal rate? I think into the outlooks of next year, there's a huge mystery to that.
Yeah, I mean, I think our rate of 525 to 550, is not necessarily the most dire situation. We do have the unemployment rate rising. That is enough of it's a high enough rate to cause a mild recession. But we're not talking, 7-8% unemployment. We've got it getting to a bit above.
Wait. Do you see evidence of a labor market troubled? I don't see the evidence other than the flash of tech and maybe the flash of every financial institution except Citigroup. I just don't see the evidence.
No, we wouldn't yet either. But I think, if you start with the assumption that the Fed will do what it takes to control inflation, and in our view, that's getting rates at least to 525 to 550, potential upside still. That means that they need to see a loosening in the labor market. And we're not seeing it yet, for sure. But as we're getting into the middle of next year, we would expect that you're seeing starting to rise in the unemployment rate.
Veronica, stay with us. Radio and television, good morning to you. An economic set of data at 8:30 here that moved the markets, no question about that. Yes, it's a Thursday before the holiday. Yes, it's boring. No, it's not. Futures deteriorate, -20 Dow futures, less or so, I'm going to call it, down 121. NASDAQ down 0.7%, excuse me there. 20.36 on the VIX. And Lisa, you earmarked now out 3 basis points, the 2-year yield, higher yield 4.24%. I guess it's a Jerome Powell, he is going to raise rates feel.
It's a feel that perhaps we can't be complacent in this bet that we're just going to continue with a disinflationary impulse. And Veronica, when we start going into the granularity underneath it, it becomes very interesting because we can see that some of the disinflation in goods changes course next year. Are there other areas like that where some of the aspects of the inflation read that have brought down inflation this year will reverse and go the other way next year? I think about oil prices, gasoline costs. I think about what you're talking about with used cars. Are there other components as well to cause more goods inflation next year than people are currently accounting for?
Yeah, I think there definitely are still some underappreciated, maybe upside risks to goods prices. I think most people expect that, supply chains have, been correcting, goods demand is much softer. Yes, commodity prices are lower too. And that means, softer core goods prices. But there are some upside risks, if we're, getting into a cold winter, higher energy costs, China reopening, if there's, a lot of people who are falling ill and not being able to work, and that creates new supply issues, that there's definitely some upside risk to goods broadly, not just cars.
Veronica, thank you so much. Greatly appreciate it. Veronica Clark with us at Citigroup as we have moving markets here off buoyant GDP as well. I guess it's claims in, a fully employed America, Lisa, that gets it going. But I'm sorry, a 3.2% statistic on GDP is stunning, ending September 30.
And what's it driven by? Personal consumption up 2.3% versus the initial read of 1.7%. But this isn't just an initial read. This is the third revisiting of the data. It kind of speaks to what we're talking about, how complicated it is right now to get a clean read on what's going on, given all of the different inputs that are moving at different paces.
Tom Purcell publishes moments ago with RBC Capital Markets along that line. The consumer, how resilient, and I think we heard today that surprise from Peter Hooper at Deutsche Bank, from John Golub in strategy at Credit Suisse. That's the surprise here into the season, and with what I have to cook for Christmas dinner, I'll be adding to the consumption.
Oh yeah, I thought you were doing the ham.
I think I've got to make like 3 stops at 4 grocery stores or something. Can you imagine what the lines are going to be like at the grocery store?
I guess you're going to find out. You'll do some frontline reporting.
Do you read the magazines when you're in line and put them back? Do you do that?
I haven't done that since I was about 15.
Okay, well, it's,
so no,
that's how I get briefed on the market.
Yeah, exactly. No, look, this is going to be an interesting holiday moment because people still have jobs, and the sentiment read that we just got that was higher than expected speaks to that. People are levering up, yes, but they're also getting wage gains. How do you parse this into the consensus maybe a month ago that we're going to have a recession next year at the beginning?
I'm looking at 7% plus nominal GDP. I'll defer to the experts. 3.2% GDP against all that gloom of last summer as well. And I go back, and dare I say it is not 2 Americas, it's 3 Americas. There's an America that all the politicians, everyone has to decide is a lost America. It's always been there. I think it's grown as my op-ed for the day. But then there's an America dealing with their recession, dealing with their inflation in spades without wage growth.
I will say that probably the quote of the morning comes from Bespoke Investment Group is market participants try to parse through all of these vagaries, make a game plan and stick to it. Unless it's not working, Yogi Berra. Coming up, we're going to discuss that. We're going to discuss the multi-tiered aspects.
Steve Cohen's efforting Mr.
Exactly.
Berra for next season.
Peter Scheer of Academy Securities and Mike Katopoulos of Richard Bernstein Advisors. As I take off, I'm going to leave, and we'll be together.
Are you leaving
tomorrow.
now?
I'm going to leave, yeah. I'm going to take off.
I'm going to brief. Staff of 28, and nobody tells me you're leaving?
Here, I'm going to brief you right now. I'm taking off.
Well,
I'll see you tomorrow.
Good.
Have a wonderful afternoon.
Yeah. I have to be here tomorrow?
You do.
Oh, okay.
We'll brief you on that, too. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. UK household incomes fell for a 4th straight quarter, leaving Britons on course for the worst period for living standards in memory. Adjusted for inflation, disposable income per person declined 0.5% in the 3rd quarter, according to the Office for National Statistics. Gross domestic product also fell. Economists say the cost of living squeeze has likely already pushed the UK into a lengthy recession that may last until the end of next year. A new analysis shows China is likely experiencing 1 million COVID infections and 5,000 virus deaths every day. That's according to Airfinity, a London-based research firm that focuses on predictive health analytics. Now, COVID is making its way virtually unchecked through China. Hospitals are overwhelmed, and patients and crematoriums are being pushed well beyond their capacity. And JP Morgan Chase is upping its climate ambitions. The firm is announcing a slew of new emissions reductions targets for its financing to carbon-intensive businesses, including airlines and cement manufacturers. The largest U.S. bank said in this year's climate report published today that it plans to reduce the carbon intensity of its aviation financing portfolio by 36% by 2030. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Lisa Mateo. This is Bloomberg.
Today's CFOs are reshaping the C-suite. Bloomberg's chief future officer shines a spotlight on these dynamic leaders.
Today's CFO has to be much, much more than a bookkeeper.
One of the most important things is looking around the corner.
We have to let go of the traditional legacy department store.
Their impact goes far beyond the balance sheet. And on Chief Future Officer, they focus on much more than just revenues and margins.
You also have to be credible business leaders in order to really impact the business and steer the direction.
We are like biologists. We need to deeply understand the financial DNA of a company.
People just come with a playbook and say, okay, we're going to roll that. Don't do that. Think longer term.
It's an amazing time to be in this role. It's a lot more than the profit today. It's building the future of tomorrow.
Get passion, perspective, and more from the chief future officers of some of the world's most influential companies. A new episode every month, only on Bloomberg. Multi-trillion-dollar industry. There's a lot of ground to cover.
Commodities got absolutely crushed.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ. Monday on Bloomberg.
This is Bloomberg Daybreak with Lee.
On Bloomberg Radio.
Welcome to Daybreak Australia.
This is Count Under the Close.
Welcome to Bloomberg Crypto.
The traditional frameworks of how you would, call a recession, we're just not there. There's room, I think, for the Fed to step down because the inflation data probably gets better over the next couple of months.
Neil Dutta, he has been optimistic, and he just got it in a third quarter GDP report. Granted, a look back to September 30 ending, but nevertheless, the consumer resilient has been a message on this Thursday, and it speaks to the pushing away from recession fears that Mr. Dutt has provided leadership on. We'd also note Peter Hooper at Deutsche Bank, who had a recession call, but said everybody's wrong about tomorrow. It's out there somewhere. We're going to finish the hour strong here with the markets moving. Futures negative 15 are now negative 30. A real deterioration in futures, 0.8%. A stick on the NASDAQ 100 down a full 1 percentage point. VIX is going to get a 21 print here pretty soon. And this deterioration is off buoyant claims, a good number, a fully employed America, and a stunning 3.2% Q3 GDP. All of that makes for a good economy, and Anthony Dwyer at Canaccord Genuity is someone who has steadfastly been bullish, waiting for recession. Well, the